right, good morning, everybody. 9 o'clock here in New York City on this Tuesday, February 2nd, 2021. Welcome to Yahoo Finance Live. I am Miles Upton, joined as always by Julie Hyman and Brian Sazi. Snowy morning here in the Northeast as we continue to dig out from that snowstorm, but it is, of course, Groundhog Day. Punxsutawney Phil this morning did see his shadow. We are getting another 6 weeks of winter. Not a surprise, I guess, for folks who woke up this morning with a couple of feet of snow on the ground. Snow expected this weekend. Temperatures falling into the 20s here in the New York metro area over the next week or so. So, what else does 2021 need but a long and tough winter? Phil, thank you for nothing this time around. All right, let's take a look at futures this morning. We do see that stock index is pointing to a higher open across the board. Dow, S&P, and Nasdaq futures all up about 0.8%. And we've got a bunch of earnings out this morning. We're going to talk about a bit later in the program. Exxon, Harley Davidson, Alibaba, all out with their results. And in the 10 o'clock hour, Brian Sazi is going to talk to the CEO of UPS about that company's latest quarterly report. But let's begin this morning with what is going on in shares of GameStop and other heavily shorted names. And we can see not great. GameStop shares off some 44%. And I think starting maybe to form the outlines of an interesting broad market impact on GameStop. And, Julie, I'm not sure exactly what it means, but this is now the fifth day in a row that we are looking at GameStop shares going one way, the broader market going another way. Obviously, the sell-off this morning quite pronounced in shares of GameStop, but we saw this yesterday. Stock was down about 25%, and we saw the markets rally. Once again, the broad markets look like they're in good shape this morning as the GameStop trade kind of starts to unwind a bit, perhaps.
Look at that. You can now use GameStop as a negative correlation to the market and make your trading decisions accordingly. As we wondered yesterday when this would sort of be coming to a close, one of the things that I've been bringing up is, well, part of it just be people getting bored with the thing and getting out for that reason. And you wonder if there's a little bit of exhaustion or burning out of the enthusiasm over this trade. Part of that is reflected in the waning short interest also. S3 Partners, which has consistently been updating folks on the short interest in this stock, says it's now at 53%. It was at, 140% last month. So clearly, a lot of those shorts have been now burned out. And so, at a certain point, a fire burns itself out. What is the fuel that would keep this going up? It's not going to be the short squeeze at a certain point because you just have fewer shorts on GameStop. So, yesterday there was a lot of speculation about where will Redditors turn their attention next. There was talk about silver, although interestingly, the moderators of the Wall Street Bets board on Reddit said that they really weren't seeing a lot of enthusiasm for silver on there. They seem to suggest that, that perhaps hedge funds were trying to drum up interest in silver. I haven't seen anything conclusive that says what was going on there. But as we know, we saw Comex say that you're going to have to put up more margin in order to trade silver. So that's something that put a damper on that trade pretty quickly.
Well, as I would say back in high school, way back when, guys, this story is just played out. It's been played out really extensively. And I think you are seeing the burning out of this trade. But I will add this. If we have learned anything from the past 2 weeks of frenzied activity, this stock can very easily go back up another 100% or 200%. And I wouldn't be surprised if these Reddit traders could be thinking along the lines or trying to do that, send the stock down now and then send it back up very sharply and again go back out into the mainstream public and regain the focus of the country that they had just a couple days ago. Not that they don't have it now, but regain it and just show their continued power. I do want to add that we're also seeing some interesting activity in GoPro. GoPro shares are short, another not as well shorted as GameStop was at the start of all this frenzied activity, but about 14% of the outstanding shares are shorted. Stock was up 18% yesterday, indicating up close to 10% in the pre-market here. Again, it's another one of those consumery companies that really have been struggling for a long time, and that the retail investor could get behind, they understand the company, and the stock is shorted.
Yeah, and that silver point, Julie, is interesting because I saw there was some folks saying that, and I got some off the record data on this suggesting there was less than a quarter of the posts on Wall Street Bets yesterday were about silver. Wall Street Bet Mod came out on Twitter, said it was about 3%. There's some data out from RBC about how many people have been added to that subreddit, though, and so 3% of chatter on Wall Street Bets yesterday about silver would equate to about half of a full day's chatter just a couple of months ago. And clearly, half of a full day's chatter on Wall Street Bets a couple months ago was enough to start getting people interested in some stocks. So I don't think we can and the Wall Street Bets sort of phenomenon clearly is not something that's controlled. This is kind of a freewheeling internet-based frenzy around a thing. I don't think there is any one person, maybe Roaring Kitty, but probably not even him, who is quote unquote in control of this. So it is odd to then have the community come out and say, we are definitely doing one thing or another, because I think this story has certainly kind of moved beyond the control of any one person. But it'll be interesting to see kind of how this thing opens. GameStop we're looking at here on the screen, because I will say that just eyeballing it, most of the content on Wall Street Bets yesterday was about GameStop, continues to be about GameStop. We're not selling. I'm never selling. Buy more, hold the line, et cetera, diamond hands. We all know kind of the slang at this point. And so what happens here, considering that anyone who is in for a fundamental reason at 15 is still more than pleased with their returns, when do those folks start to maybe think about getting some stuff off the table? All right, let's stay on this topic and think a bit more about what it means for market structure, where we go from here in terms of regulation, how short sellers think about events like this. Dan David joins us now. He's the founder over at Wolfpack Research. And Dan, I'm just curious, as someone who likes to play on the short side of the market, how you've looked at the last couple weeks of Andrew Left getting chased out of Dodge on this thing, and the role that the narrative around shorts that has kind of developed as a result of this.
Well, I think there's a lot of confusion in the market about what a short seller is, the difference between a long short fund and possibly a short activist. And I really don't think the Reddit rebellion or army cares. I think what they saw, and what really doesn't get described, is that there are some very sophisticated people on that chat board. And they saw a setup with GameStop that showed, hey, look, there's really only 4 million shares we need to push around. And it shows 70 million shares in the float, but between what insiders own and passive investments who aren't going to sell, they're in fact the ones loaning out the shares, right? And when they loan out those shares, short seller sells it to the market, creates a synthetic share. That's how you get to the 140%. And we're seeing that contract as that happens right now, right? And the stock's going down. But when you have a situation where you can really just have to push around 4 million shares, it's quite a different thing. As this thing opens up and there's 10, 20, 30, 40 million shares that are kind of free trading, maybe not locked up in passive or with insiders, they're not going to be able to do that. So that's what happened.
And I guess, Dan, this also gets to a question about the way the market has changed as a result of passive flows, which, I think for the average consumer are a positive thing. But the dynamic you're kind of outlining is that liquidity doesn't really exist in the way that it seems to exist, even in pretty big names. I mean, GameStop wasn't a penny stock. It's still at a couple billion market cap. And the shares that are actually able to trade in large names still don't amount to all that much.
Yeah, I mean, look, you look at GameStop, and it was a speculative bet. I mean, at $20, it still is, right? It's brick and mortar, and it's not doing great as a healthy business unless they completely morph themselves and Hail Mary. So you've got to ask yourself. I'm asking myself, why are Vanguard, Fidelity, BlackRock, all of these passive institutions taking up 70% of the shares in GameStop before all of this started? And really, it's because of the liquidity that we're throwing at the market. I mean, $5 trillion just this last year, with maybe another $2 trillion on the way. I mean, putting this in some perspective, Miles, I mean, taking dollar for dollar stacked on top of each other, $7 trillion will take you to the moon and back physically. So what does money mean anymore when you're throwing that kind of liquidity at the market? These passive investments have to invest in everything. They are invested in massive frauds that I see out there today, some that have been called out this year, and they're still going up because money has to be thrown at the market. And it's not going to be put in the bank, because at a cost of living of 2% and you maybe get 1% at the bank, you're losing 1%. So the government has set it up so the only place to put our money is the stock market. That's where it's going. What's very dangerous about these passive investment vehicles is, you're right, they don't sell until they do. And when they do, that is a very, very serious situation. And I'm not sure how we're going to put a stop to it. Well, I am sure. That's what we do.
Dan, who do you think is selling GameStop this morning, and what do you think the trigger point was?
Well, the short interest coming down is definitely part of the trigger point. And you have to understand that many of these passive investment vehicles are kind of like a Robinhood platform, right? They're free. If you are in this passive investment, it's free, but you have to know that we make money lending shares. So being in GameStop for that reason made a lot of sense to these free passive investments, free to the end user, because they made enormous fees on GameStop, right? The borrow rate was huge. And they get in these tightly held stocks for that reason. And as they start to unwind, that's going to be the reason this thing comes down, because there's just more in there in the float, and there's not enough money in that Reddit room to start pushing around a stock like that. And I heard somebody say before that, like, look, if you're in this at 15 or 20 bucks, you're still really happy at 150 where it's sitting here today. I don't know. I mean, I think a lot of people that are, whatever they're in it for, and they see it at 450 and now it's down to 150, they're like, I missed it. I better get out now. Well, I still get a very good profit. And I think that's part of the momentum. Momentum up, momentum down.
Hey, I just finally wanted to ask you, Miles mentioned Andrew left a few minutes ago, who was a well-known short seller, definitely not a mainstream Wall Street guy, right? But he said, I'm not going to be doing short selling research anymore. What kind of mail are you getting? I should say email. What kind of email, what kind of comments are you getting? What is it like? What's your mindset right now as an activist short seller?
Well, I mean, as an activist short seller, where, and the distinction being that we come out publicly and we talk about what we're shorting. I'm usually shorting something that's a fraud. And we've always gotten threats and online, mail. It's really ratcheted up this past week. I've had no position in GameStop, long or short, have not been in it at all. And I got threatened every day last week. And I mean, literally, that's just for my family. So not even talking about other people sending stuff in. It's pretty awful out there. I would ask this, that if anybody's going to follow through on that, please do it before I finish shoveling my driveway, not after, because this is ridiculous.
All right, well, Dan, we'll let you get out there or at least start the process of thinking about digging out down there in the Philly metro area. I know they got hit pretty hard, as we did up here. Dan David of Wolfpack Research. Dan, always great to get your thoughts. Thanks so much for joining the show this morning. I know we'll talk soon.
Thanks, Miles. Good to be back.
Yeah, appreciate it. All right, let's take a look at some breaking news here. Uber coming out with an acquisition this morning, buying alcohol delivery app Drizzly for about $1.1 billion in stock and cash. Looks like the deal's about $900 million worth of Uber shares, and then a couple $100 million worth of cash. So again, we get a deal here where Uber, Brian Sozzi, can use their stock as a little bit of currency, and I think makes sense considering the way the Eats business has been such a strong performer for them this year.
I'm going to dig into this deal a lot more, Miles and Julie, but can Uber just reach profitability before they go out and spend $1.1 billion to buy an alcohol delivery service? I mean, come on. I know they have this grand vision of becoming a super app, but get some profits first. What are you doing?
I think this is how you get the profits. You're going all in on the food. I mean, the margins, the growth there. Oh, not the margin, the growth.
Is known as a higher margin business, right? So if it's higher margin at a bar, I wonder if it's higher margin when you're delivering it to your house too.
I think Well, so I should correct myself. The margin on an Uber ride is actually adjusted EBITDA positive, and a margin on a delivery of food is not. But the growth has been there. Maybe the product itself is a beneficiary. Here's an interesting story in the Journal over the weekend about people buying higher end spirits because they cannot go out. Americans do like to drink at home a lot more than their global counterparts. Perhaps that's part of the trade as well. But I think that given the margins on an Eats delivery, you need to have more density within the network. So I guess, Saz, next time you want a six-pack of Miller High Life along with your Big Mac, you can now get that all in one place from Uber Eats instead of having to do two separate orders.
I'll get my 40 ounce from the 7-Eleven, guys. I'm not using this app.
He's a simple man. Simple man appreciates a good local bodega like a 7-Eleven. All right, a lot more coming up here on Yahoo Finance Live on the other side of this break. Futures 22 higher open on this Tuesday morning.
Boat maker Brunswick Corporation reported its earnings last week. In the fourth quarter, sales were up about 26.5% to just over $1 billion. And the company predicted that net sales for this year will be between $4.75 billion to $5 billion. So, in other words, the sale of boats is going pretty well. The stock's up about 14% year to date. Dave Folks, the CEO, is joining us right now to talk more about it. Dave, thank you so much for being here. As I said, the sale of boats is going well. You guys sell a lot of boat engines as well. That's a big proportion of your business. Who's buying boats right now, and at what price point? I'm curious what the character of the boat market looks like right now.
Yeah, good morning. Yeah, certainly retail is extremely strong, and as you probably know, it really became strong in the second half of the second quarter last year, and that momentum was carried through the whole year in 2020 and then continued into early 2021. I think, we had more first-time buyers than typical in the market last year. And so about 40% of the boats we were selling in the middle of last year were to first-time boaters. First-time boat buyers, I would say, because they're often boaters who have boated with a family or friends before. If you look across our portfolio, we have a lot of brands. We sell boats from about $10,000 to $1 million. People are coming in at the lower end. I would say that, about 80% of the boats we sell for less than $50,000. So I'd say there's a broad range of people entering at different price points, typically at a slightly lower price point than average, I would say.
David, you mentioned on your earnings call, several brands are sold out into 2022. Really, that was a pretty stunning stat to me. So what does it mean as a consumer? If I wanted to buy a Boston Whaler right now, I couldn't get that boat until next year?
In a lot of cases, that is true. Boston Whaler in particular is a very strong brand. Sea Ray is another of our brands that's really strong, that's really sold out most of this year and some models into 2022. A lot of people who buy a Whaler, though, already own one, so they're prepared to wait. It's a very prestigious brand. But you're right. I would place an order right now, and then obviously we'd fulfill it as soon as we can. One of the things we are doing, you may have seen that we announced a very large expansion to our Boston Whaler manufacturing capacity. We're bringing online a whole new plant, 225,000 square feet, on top of the 550,000 square feet that we have already dedicated to Boston Whaler. So we recognize that very high demand for this very prestigious brand will continue, and we're bringing on as much production as we can.
How many people will you hire this year just to meet this demand?
We're trying to hire about 1,000 right now. We hired about 3,000 in the back half of last year. Obviously, in the COVID environment, that is tougher than normal. You know, virtual job fairs, onboarding is not as straightforward as possible. But we have COVID-safe protocols in all our facilities, and we're doing it, maintaining the quality of our product, maintaining the quality of our hires and talent, and being cautious, but we need to be pretty rapid to meet this kind of demand. So about 1,000 new jobs this year, based on our understanding of demand.
And, you know, Dave, you mentioned how that order book pretty solid really through next year. How different is that environment than the kind of runway that you guys often have, the visibility, I guess you would call it, into what future demand looks like? And how are you, I mean, certainly you're ramping up investment now, but how wary are you of becoming, you know, having overcapacity in a couple years if the market maybe levels out?
Yeah, the capacity that we're bringing on right now will progressively add about 10% to our total capacity, so it's not a huge amount, and we do it at a very efficient investment level. So of the 3 plants that we're investing in right now, really 2 of them don't require brick and mortar. It's just more machining capacity and other things inside the facility. And then the new plant that we're bringing on is a plant that was idled. So we're not buying a plant there, we're simply reactivating it. So we're very conscious of maintaining an efficient investment level, even as we bring on production capacity. I think one of the things that we're looking at here is even running full out in this year, we will not restock the pipeline. We won't even make a big dent in it. So it's going to be a multi-year cycle to rebuild wholesale pipelines in the field. They're depleted by about 40% at the moment versus where they were a year ago. So that is going to be that's going to require all the capacity we bring online for some period of time, and I think we're investing efficiently and appropriately to achieve that.
You know, Dave, it feels like we're talking on a near daily basis here about the various technological innovations in the car industry, right? Electrification, autonomous driving, lasers to help them navigate. Whereas when I have my mental image of a boat, it's, you know, the footage we've been showing with a motor on the back. What's happening on the technological level in the boating industry, and what are you guys expecting in the next few years?
A lot of the trends that you see in the automotive industry are carrying through to marine. Our boats are pretty sophisticated already. They have, if they're a larger boat, they have radar, they have sonar, they have GPS and chart plotting. So actually a lot more sensing than most typical cars have. But you're seeing some progress towards autonomy or driver assistance in our field, just as you are in automotive. We demonstrated an auto docking system last year that we're progressing productionization of. We're investing more and more in electrification. Electric is a little trickier in marine. The physics are more difficult. We don't have brakes to regenerate energy. It takes more power to push a boat through the water than it does to move a car on a road. But there is going to be a progressive move to electrification in some parts of marine. And then interestingly on connectivity, which is another big technology play in automotive. All of our boats above a certain size now go out as connected products. So when you get the boat delivered, you also have an app on your phone that allows you to remote monitor and do various, actions remote from the boat, understand the status of the boat. So a lot of the same things on technology are happening in marine as are happening in automotive. Another kind of not really a technological trend, but more of a business model trend that's happening for us as well is shared access. We own Freedom Boat Club, which is the biggest shared access business model in marine. 253 locations now, 38,000 members. You join at a club in your local area. You book on an app. It's very, very convenient. So whether it's technology or business model trends, you're seeing the same things evolve in marine as you do in automotive and other spaces.
All right. Interesting stuff. Thank you so much, Dave. Good to see you. Dave Folks is the CEO of Brunswick Corporation. Appreciate your time this morning.
Thank you very much.
Thank you. All right. We'll be right back with the beginning of trading and the opening bell. Stay with us.
All right, welcome back to Yahoo Finance Live. We're about 2 minutes away from the opening bell on this Tuesday morning. Stock futures are higher. All the attention, however, remains on some of those heavily shorted names, seeing a lot of pressure in that space this morning. And let's stay on everything that's happened in the markets of late. Jeremy Bryant joins us now. He's a senior portfolio manager over at Gradient Investments. So, Jeremy, let's just start with how you're thinking about what we've seen the last week or so. Not so much does it change your view on the market, but do you think these kinds of retail bids are here to stay and something that you need to think more seriously about as part of your process?
To be honest, no. In my opinion, I have no idea how long it's going to last, and what it will rotate into next. Our concern is much more, and our philosophy and process kind of has stayed the same, right? At the end of the day, we're not going to chase these kinds of things just simply because they're going up aggressively. We monitor business fundamentals and businesses in general, and this really doesn't fit with that in that regard. But where I do look at this and where we're paying attention to is let's say we do have an issue where, you're going up the elevator and then down the elevator, right, for these stocks. Does that bleed over into the more traditional stocks, your Intels, your AT&Ts, your Home Depots of the world? Do people get concerned about the markets in general if these retail names that have been chased up very aggressively begin to correct very aggressively as well? So that's what we're a little bit more cautious about. We want to understand how that works, and if that becomes the case. But it'll also provide some opportunity if that's the case, if things get overly cheap because of that.
And just wanted to mention we are, of course, looking at the opening bell. Zim Integrated Shipping ringing the bell this morning. Jeremy, a lot of the stocks, I think all of the stocks that have been involved in this whole short squeeze trade have been small cap stocks. And I know you guys are kind of shifting your positioning a little bit on small caps. Does it have to do with what's been going on, or is it more just general performance?
More general performance, but this trending has been a little bit. It started in September, is that we got overweight in small caps in around that area, September, October area, because there was a very large dispersion of performance at that time, where large caps were really dominating the performance. That corrected itself really quickly. Usually these things play out over maybe even 1 to 2 years, or usually at least 6 months, but in this instance, that correction in the small cap stocks really happened fast, and valuations and performance have not only caught up, but they've superseded that of large caps at this point now. So especially in small cap growth, we're a lot more cautious than we were before, but we just thought it was prudent to pull that back after having some outperformance as a result of our call there, which we were happy about. We just don't see it. It's more of a continued momentum play now than it is a reversion to the mean or a catch-up trade. And we just don't know if that's there, considering a lot of the small cap stocks are trading at over 30 times earnings now. So they're expensive. They've gone really far, really fast. I think it's just prudent to take a little bit off the table now.
Jeremy, GameStop shares hit a intraday high late last week during the frenzy, about $438 a share. Right now, I'm looking on the Yahoo Finance platform. The stock's at 150. I mean, do you think that type of pullback is a buying opportunity?
No, I mean, I don't. I don't. Look where it was a few months before that. It's what we look at is it has the business changed. I think in this opinion, with GameStop and with some of the other stocks that we're seeing out there, I don't think anything fundamentally has changed with regard to the companies before this started or right now. So in that regard, I mean, in our opinion, it's better to just really just ignore these stocks for the most part, these ones that are having parabolic moves, because trying to time this from that perspective, in our opinion, usually ends up more in pain than in prosperity. So in that regard, there's a lot of different stocks out there that have strong fundamentals that are trading at reasonable valuations that we can take a look at. And we'd prefer just to kind of stay out of the fray of the GameStops of the world, because frankly, we can't assign value to this because we don't think the movements that are happening in these stocks have anything to do with fundamental value of the business at all.
So, Jeremy, we've talked a lot about things you don't like. What do you like in this market right now, then?
Yeah, great question. Really what we've been going back to is what's still relatively cheap out there. And the two areas that we're seeing is that real estate is one. In a regard of what we're looking at right now is a higher probability of interest rates. That's of interest rate rising over time. We think that that's a higher probability. And if you do get stimulus measures and you get subsequent inflation as a result of that, usually asset prices rise as long as it doesn't get out of hand. And in that case, real estate should look pretty good during that period. So we like that positioning. We like secular growth names in there, like the towers and the data centers. We think those are just good plays. They were recovery plays before, and so they've subsequently corrected pretty hard. We think now is a pretty good opportunity to get involved there, and we actually have positioning there now. The other ones we really like, just from a perspective of valuation and under that same kind of economic growth, potentially higher interest rates, is financials. I mean, they've had a pretty decent run. They've pulled back a little bit, but they've had a pretty decent run, but they're still at 12, 13 times earnings compared to a market at 20 plus earnings, so we think there's still an opportunity there if they can grow earnings in the double digit range over the next couple of years based upon just loan loss provisions coming down, better earnings, better loan growth, these kinds of things. We still think there's an opportunity there as well.
All right, Jeremy Bryan is a senior portfolio manager over at Gradient Investments. Jeremy, always great to get your thoughts. Thanks so much for joining the show this morning.
Thanks for having me. Appreciate it.
All right, let's take a look at how markets have opened here on this Tuesday morning. We see the major averages are higher. Jared Booker, what is happening over in some of those short names?
Well, we'll get to that short screen in just a second. Let's check out the index action first. We can see a lot of green around the world. And in the U.S. here, we got the Nasdaq, S&P 500, and Dow each up 1.1%. Russell 2000 lagging a little bit down, up about 0.8%. And just looking inside the Nasdaq 100 at the mega cap names, guess what? Alphabet up 2% to a record high. Up 10% over the last trailing month here. Apple up over 1%. Amazon up 2% ahead of its earnings. Tesla up 1% here. The big story of the week, of the last couple weeks, here we go. Lots of red on our heavily shorted screen here. GameStop notably down 42%. So right now we were consolidating over the last day and finally broke down. We are at testing the 100 level. That's something that we saw about last Wednesday or Thursday, I believe. Also looking at AMC costs, those are each down about 30%. Express a little bit less. But guess what? We got a new theme today. HCMG, that's Healthier Choices Management. That was a story yesterday. That is up another 131% to $0.002. I guess that's 0.2%. But we got some biotech names as well. Artello Biosciences, we were tracking this yesterday, up about 50%. And then we have Vine, that's up about 10%, Vine Therapeutics. And finally, CRBP. This got on our radar yesterday. That's up another 8%, 92% over the last month. So Wall Street bets kind of shifting over to biotech today, guys.
And I have a riddle for our viewers. What company reported its first annual loss in 4 decades, but whose stock is up today by 3%? I know you know the answer, Jared.
Oh, I think it's Exxon here. And you're right. You have to go back to 1981, something about an oil embargo, oil prices crashing, I believe, back then. But let's just check out Exxon here. By the numbers, so first loss in 4 decades, that's because of a big write-down that was anticipated, $19.3 billion. That was well telegraphed. And guess what? I think the stock is up right now because the company is just flipping over backwards to protect its dividend. That's $3.7 billion per quarter. And they said that even despite the cash flow weakness, that if crude prices dropped to $45 a barrel, they're about $8 a barrel above that, it would sacrifice spending to protect the payout. And they have slashed CapEx across the board. And interestingly, we got the first reports yesterday that Exxon and Chevron were in talks over a merger last year. It looks like probably didn't go very far, but interesting to contemplate because these two companies together would still be just a shell of what they were maybe 7-8 years ago when Exxon was the biggest company in the world.
Yeah, and I think, we've talked about it on the show before, and it's not the most interesting daily news conversation, but is the point of a company not to just return capital to shareholders over time? And is that not what Exxon is doing, right? An orderly sort of wind down of operations in a dying industry. Terminal value of discounted future cash flows, that's what they teach. So, here we go, seeing the terminal value. All right, Jared, thanks for checking in. We'll talk to you later on this week. All right, a lot more coming up here on Yahoo Finance Live. On the other side of this break, all 3 majors up better than 1% on this Tuesday morning.
let's talk about some of the earnings that came out this morning and are seeing some notable moves in the market. One of them is Alibaba, of course, the Chinese giant e-commerce company. The company said revenue was up by 37%. And Alibaba's numbers tend to look good on the face of it. They had strong results, they said, from Singles Day. They sort of extended the promotions from that. That's similar to what we saw for Amazon and its Prime promotion event. But, most of this is being overshadowed by the regulatory situation, what's going on in China, Miles, with its Ant subsidiary, with Jack Ma, and with threats of regulation for this company, and also its pulled listing.
Yeah, I mean, I think, look, Alibaba has a fine business in its own right that I think people are excited about, but certainly its, 1/3 stake in Ant was a part of the company's value. And the company coming out and saying, on the call that they don't really know what's going on right now, or they're not able to provide an update, rather, to the markets. All they said is the IPO process for Ant is subject to, quote, substantial uncertainties. I would certainly say so when the Chinese government comes in and decides that Ant Group is not going to be able to, upend and, kind of be the main player within China's emerging fintech scene. Also, this comes as news, or rather a lack of news came out that, China listed some of its tech luminaries out with a big, splashy advertisement for this. Jack Ma, not a part of that. So the relationship between Alibaba, between Jack Ma, between Ant, between the Chinese government, certainly there was always some level of it being fraught because no one comes before the party, at least not anyone that she hasn't endorsed as being able to come before the party. But again, that would ultimately be no one comes before the party. And so a very strange dynamic developed there with Ma's wealth, his public appearances, the way that he spoke. Certainly we've covered at length his comments he made last fall, speaking negatively about Chinese financial regulations, the way there's been a crackdown on him and now his businesses. And that really remains the big story here, and what U.S.-China relations look like now that Donald Trump is not the president. We no longer have trade war by tweet, but it's not like everything is now all hunky-dory with U.S.-China relations as China worries about I guess we could say, displeasure within its own business ranks. So very interesting and strange geopolitical, business political story, however you want to exactly phrase it. And I think, again, certainly overshadows what was, to no one's surprise, a very strong year for the e-commerce company.
Yeah, so this is obviously much more complex than just the earnings. A story that seems a lot more straightforward is that involving Harley-Davidson, which reported an unexpected loss. The company has also, Brian, come out with a turnaround plan over the next 5 years, but it's had some turnaround plans before. Unclear what's going to be different this time. Look at that stock, down 18% here.
Yeah, Julia, I've followed Harley-Davidson for a good number of years, and there's been a lot of internal change at this company. I would say morale, just based on my conversations with folks familiar with the matter, the culture inside has really taken a hit during these challenging times, and it really, the morale is low, I would say, right now inside of Harley-Davidson. And what you're seeing today here is a stunning quarter by one of the most widely recognized consumer brands in the world. Of note, they came out on the press release, Harley-Davidson, this morning. They said they cut models, the number of models, by 30%. Dealer inventory down 59%. The core motorcycle division for Harley-Davidson lost $196 million in terms of operating profits. And what you're seeing, this is the reflection of really a review process by new CEO Joachim Zeitz, who officially took over in May of last year, but he's been on the board since 2007, so he's very familiar with the company. He has hit the complete reset button on this company to really wring out a lot of costs from the business, get when they release bikes out on a better trajectory, and just release hopefully more profitable bikes. And his 5-year plan is called Hardwire, and I think it really revolves around doing less and hopefully making more money per bike. But it doesn't change a structural problem in the bike industry, guys, that people aren't just buying bikes. Look, we just had Brunswick's CEO on, David Folks. People are buying boats. It's just the bike industry that remains very challenged. I know our producer, Nick Monti, is sad about that, but that's just the reality of it. I hate to be the bearer of bad news, and I don't know what gets people to buy more motorcycles. It's not necessarily a new Harley-Davidson electric bike.
Well, Nick will still be able to buy his bike, so that's all right. By the way, Harley's also said it's offering an equity grant to 4,500 employees, in other words, buyouts to employees to cut those jobs. And then finally, UPS, we got those earnings as well. Brian, you're going to be talking to the CEO, Carol Tomé, a little bit later on the show. And they're benefiting, as you might expect, from all of us getting packages to our doors.
Yeah, I'll just hit the high-level points here. I'm looking forward to catching up with Carol later. Sales in the U.S. domestic package business up 17.4%, and really that reflects what we're seeing during the pandemic. A lot of people obviously ordering online. Amazon is a major customer of UPS, no surprise there. They're coming out strong in the U.S. But also, too, one of Tomé's missions here is to do less at UPS, but do it better, be more profitable. And you're seeing that in their CapEx guidance for this year. CapEx guidance this year for UPS, $4 billion. That would be down about 30% year over year. Now, they just sold their UPS freight business for $800 million, so that will require, that will mean less CapEx. But you're getting the sense that the go-forward UPS business under new CEO Carol Tomé will just be simply better run and potentially a higher operating margin business. And I think that's why you're seeing the stock up this morning.
Looking forward to that conversation later. And coming up next, looking forward to our conversation with Klaus Kleinfeld, formerly of Alcoa, then Arconic, formerly Siemens before that. Now he's got us back. We'll be right back.
Former longtime Alcoa CEO Klaus Kleinfeld is back atop the C-suite. Kleinfeld is on the hunt for his first acquisition as part of a new SPAC he has launched called Constellation Acquisition Corp. Klaus Kleinfeld joins us now. Klaus, good to see you this morning. Thanks for taking the time. One key component, just going through your the prospectus on this one, ESG is very important for you. You're only going to consider companies that are ESG minded. Why is that important to you?
Well, actually, when you look at where the world is going and how many more people are understanding where the world is going, I think it makes absolutely no sense to invest into anything that doesn't qualify under ESG. ESG for us is what I would call a hygienic criterion, you know. So there are other criteria that the target has to fulfill in addition to that. I mean, we are looking for a target that we believe is on its way to show a proven business model, which for me stands for sustainable competitive advantage, a proven sustainable competitive advantage, and growth. Those are really the things that we are looking for.
Just going through the numbers and the perspectives, Klaus, a bit, it sounds as though you're more optimistic on finding a target in Europe as opposed to US. Is that correct?
Well, what happened is, I mean, the team that I built and consists of people that I know for a long time and have full trust, and lots of people with deal experience. So we started looking into this almost a year ago, and we built what we call a target pipeline. And we were fishing in both ponds. We were fishing here in North America, and we are fishing over in Europe. It just so happens that if I look at the target pipeline today, 2/3 of the target that we qualified, pre-qualified, basically are the ones that are in Europe, and 1/3 is in the US. I think Europe has a lot of attractive targets that fall into this category that I just mentioned before.
And Klaus, it's Miles here. I'm curious if you mentioned you started looking at this possibility about a year ago. Are you surprised by the speed with which the SPAC boom has accelerated here? I mean, we had the dislocation in the pandemic, but I mean, I think I've seen almost 100 deals or 100 sponsors come to market in January.
Yeah, how can you not be surprised by this, to be honest? But in a way, I mean, I think what happened, I have been looking and observing the SPAC market also for a while. And frankly, if we would have had that conversation in sometimes mid-2019 or so, I would have probably said, I'm not sure the SPAC is for me and the team that we have. I mean, kind of looking for sustainable businesses with great growth, you know, and opportunities and long-term investment opportunities also. What has happened here is a nice financial kind of toolbox has been built around the SPACs that allows people like us, you know, who have a long track record to see this works. This is good for us. It works for what we stand for, and we can do it. And I think it has attracted a lot of really top-level teams. And I think you'll see the flight for quality is going to happen also in the SPAC space.
Klaus, it's Julie here. So I'm curious just to drill down into this a little bit more. If you look at a SPAC versus venture capital, for example, or versus the other investment choices that you have when you put a group of investors together like this, why SPAC versus some of those other choices?
Well, I mean, if I look at our target list, I mean, it became crystal clear when we started to, because this is I think it's a good question, honestly, and it's a question that all of the target companies will have in the back of their mind. But when you look at some companies, for instance, you see the alternative in terms of selling to private equity. Private equity typically wants control of something. In our case, if the company is on the right path, we believe that we probably have to make a couple of tweaks, and then this company can become a public company. Some shareholders want to potentially cash out, some want to leave, some others want to reduce their position. There's a lot of flexibility in this, you know, and accessing the capital market instead of being dependent on a few financiers can be an advantage. Some situations will not work. I mean, for instance, I believe that if you have a target that has to go through a substantial restructuring, that might take a little while, and you can more easily do it if you're not in the public eye. This will not work, you know. So there are constellations where it will work magically well, and many, and that's the reason why you see so many SPACs, I believe, you know. And then there are a few where it's probably not the right choice.
Klaus, you really have a tremendous, I would say, a worldview, a really look at how economies are doing here in the U.S., but in Europe and even Asia, just based on your resume, leading these big companies, Siemens, Alcoa, Arconic. How do you see the economic recovery going after the pandemic? Because it's completely detached from the reality, I would say. And the stock market is trading really still near record highs, but corporate America it's still struggling.
Well, I think this is fascinating, and I'm already looking forward to 3 years from now, where we look at this from a hopefully relaxed perspective and the pandemic being behind us, you know. But what it really has been doing is a lot of these things that we're seeing today are accelerations of trends that have existed before. I don't think we've seen anything that is completely new. But for instance, one big chunk of interesting targets for us are in the space of online and logistics, you know. So, I mean, do we know that online is going to replace brick and mortar? We know it for years, but did we ever predict it to happen this fast? That COVID has accelerated it. You know, the same thing is true for data. I mean, the very fact that we do this interview not live, but over Zoom seamlessly, and the world is working, a lot of companies are working all together like this. I mean, did we know that that's possible? Yes, but did everybody accept it? No. But will we go away from the comforts that it has? I don't think we will. So I think that there are, I'm by nature an optimist, but I see a lot of potential positive changes that will stick around and that have been accelerated. I mentioned data. I mean, we understand now how important data is, and there are quite a number of very interesting companies, you know, who are capitalizing on this.
Yeah, it still amazes me, Klaus, how we can do these interviews even during these times. Well, we'll leave it there. Klaus Kleinfeld, really appreciate the time, and good luck with the SPAC. Look forward to having you back soon.
Thank you. Thank you. Looking forward to it. Thank you, Brian.
Thank you. All right, do stick around. Much more ahead on Yahoo Finance Live.
All right, let's take a look at the markets here about 25 minutes into today's trading session. We see all three majors are higher right now, but the real action is happening in some of those heavily shorted stocks, particularly over in GameStop. Shares have been off as much as 50%. The stock had been halted. On the downside, of course, we saw multiple halts in shares of GameStop on the way up, and we see here on the screen, bottom right of the heavily shorted heat map from the Yahoo Finance Interactive touchscreen that we have back in our studio. GameStop down some 50%. AMC also under pressure off 40%. Costs, Express, the BLIAQ, which is the Blockbuster Liquidation Corp, also under pressure here. The Killer Bees, BlackBerry, Bed Bath Beyond, they're under pressure. So again, a lot of that heavily shorted trade unwinding a bit, a little bit of green on this screen, but the stars of the show under a lot of pressure this morning. All right, we're off for a 2-minute break. On the other side, a lot more here on Yahoo Finance Live.
It is 10 a.m. on Tuesday, February 2nd. This is Yahoo Finance Live. I'm Julie Hyman alongside Miles Udland and Brian Sozzi. Let's take a look at what's going on with stocks today. We've got a rally going on, remarkably consistent across the three major averages, up more than 1% here. The Nasdaq lagging a little bit, the Dow up 1.4%. We've got big earnings coming after the close from Alphabet and Amazon, so we'll see what effect that has on the Nasdaq. Her firm manages the most popular actively traded ETF. She was an, at the time, controversial pioneer for her early decisive bet on Tesla, which she still has, by the way. Kathy Wood of ARK Invest spoke to our Jen Rogers. We'll bring you that exclusive interview this hour. UPS is riding the e-commerce boom to higher profits. CEO Carol Tomé talks to Brian on the heels of the company's earnings report. That is sending those shares higher, you can see, by 4.6%. And as Washington negotiates more aid for Americans battered and weary from the coronavirus, we look ahead to Friday's jobs report and we look at the state of the economy. And let's begin there with Annetta Markowska, who is Jefferies' chief financial economist. Annetta, it's good to see you. I want to talk to you about the stimulus checks that have already come out, because there was an interesting chart shared by RBC that looked at the sort of timing of the last stimulus checks and the retail trading that we have seen happening in the market. And so I wanted to ask you, as an economist, when people spend their stimulus money, is there a preferable way for them to spend it? We also know a lot of people are saving that money. But from an economic perspective, is there something that is more productive for them to be spending money on? Do you have a preference between stocks, hard goods, services, et cetera?
Well, the hope is that they will spend it on goods or services, because ultimately, the goal of any fiscal expansion is to create jobs, right? And the only way you create jobs is people buy products that allow the companies who sell the products to ultimately be able to expand and hire. And so, to the extent people are using some of the money to buy stocks, particularly, speculative positions, that obviously is not productive. I will say, though, that our tracking of real-time activity does suggest that at least some of the money has been spent. We saw a pretty sharp inflection point in card spending on January 4th, which was the precise day the Treasury deposited $120 billion into people's bank accounts. And you saw a particularly sharp inflection or acceleration in low-income spending. And these are the households who obviously have the most to gain from those fiscal support payments relative to their income. So we are seeing some encouraging evidence, in terms of the fiscal multipliers.
Annetta, certainly the amount of consumption folks are doing is a big part of the GDP calculation. So that's good for growth. But we did see the economy shed jobs in December. What are you expecting to see on Friday? And how concerned are you that we are not going to see, any kind of durable rebound in hiring, for several months here, a period where we may see that stimulus dry up?
So I think that this Friday, we're going to see another weak employment report. We're projecting a loss of 80,000 jobs. So not quite as bad as December, but obviously not great news. Having said that, again, our real-time activity tracking suggests that the labor market did inflect and start bottoming out around the middle of January. And we actually saw pretty significant improvement in the second half of January. Now, the problem with employment data is they really capture the situation as of the middle of the month. This particular survey week ended on the 16th. So it's just the inflection happened too late in the month for it to be captured in January payrolls. I think they will be captured in February. And I think February is actually going to be a pretty good month for employment. Keep in mind the reopening of California's economy is also pretty significant. We think that we can trace the entire 500,000 job loss in December in leisure and hospitality to California's restaurant industry. And so presumably, those jobs will come back by February. And I think we could see overall job gain perhaps even close to 1 million. So, we have 1 week data point still ahead of us, but I think we are pretty close to a positive inflection point.
Just based on your data, and which suggests we are nearing an inflection point, do you think the economy needs another dose of economic stimulus?
I think 2 trillion is a lot. I'm not sure that we need quite that much, but certainly, we need an extension of unemployment benefits. The current sort of program expires mid-March, which I think is a little bit too early, right? The economy is still going to be recovering, although momentum will be improving. We're still in a deep hole. So I do see a very strong argument for extending those. Stimulus checks, that's obviously not very targeted. Some of that is going to households that don't necessarily need the money. But PPP loans, I think that's going to be very helpful, and obviously state and local aid. So I'm not quite sure we need another 2 trillion, but I do think we need some additional stimulus, and we've factored another 1 trillion into our forecast, and so if anything, it looks like there might be further upside risk to what we've assumed.
So if there's upside risk to the economy also, if we're at this inflection point, what does that say about the Fed and where they are in terms of maybe being behind the curve? And are we going to see an unpleasant surprise then for the markets this year if the Fed has to catch up?
I wouldn't necessarily say they're behind the curve, but what they've articulated very clearly is that they don't want to be preemptive. So no, immediately after the Georgia election, for example, private sector economists rushed to upgrade their economic projections because it's in our interest to be, to try to get ahead of the market. Well, the Fed's sort of the opposite end of the spectrum, right? It's not in their interest to be preemptive. It's in their interest to be sort of reactive. They don't want the market to react ahead of the data and then potentially undermine that growth momentum. But keep in mind, they said they will react to the data. So if the data do surprise on the upside, and if we do get more stimulus, which by the way, most Fed officials had not assumed any additional fiscal stimulus beyond the December one. So, if we get another round, I would expect probably around the March FOMC meeting to see the Fed start to adjust higher their GDP projections. They're just 2.4% for this year. I think that's way too low. We're closer to 6.5%. So I do think we'll start to see a series of upward revisions as the Fed sort of internalizes another round of fiscal stimulus and then just sort of marks its forecast to market or to the data as the data surprise on the upside. And I think March to June will be a period where you're going to see significant upward revisions, both from the Fed and from consensus. And so, yes, that will be a pretty difficult time for the Treasury market, certainly. We expect the 10-year to end the year at 2%. So we do have a pretty aggressive forecast. And I think a big chunk of that repricing will happen in the second quarter.
Annetta, thank you. That's a really helpful way to frame sort of private economists versus Fed economists and what the motivations and framework are that they're operating under. Annetta Markowska is Jefferies chief financial economist. Good to see you, Annetta. Thank you.
Thank you so much.
Well, if those rates are going to 2% by year end, what does that mean for financial companies and financial earnings? We are seeing Treasury yields move up a little bit today. 1.1% is around where the 10-year is. And we've got the XLF, the Financial Spider ETF, that is rising as well today. Let's bring in Cheryl Page. She's a portfolio manager at Angel Oak Capital Advisors who looks at financial stocks. Good to see you, Cheryl. Thanks for being with us. So how are you thinking about rates this year and what that's going to mean for the companies you cover?
Yeah, good morning. We are expecting that the yield curve will steepen as we continue to get more stimulus, vaccine deployment, more PPP funds out there. A steepening of the curve will be great for banks. It'll be helpful to their net interest margins, which have been under pressure in the low rate environment. And so that we think starts to help around the back half of the year, should drive some better loan growth and some margin benefit.
Cheryl, you think the major banks are nearing a real boom in the first quarter in terms of trading activity, just based on everything we've seen so far in terms of volumes?
I think heightened volatility is certainly helpful to capital market segments of the big banks, particularly when we look at the trading revenues on the equity side. So that should continue through. That was a nice trend we saw in fourth quarter, and I think that continues through on the first quarter to date so far.
Sure. What about the regulatory side? We saw a mid-level tie-up finally come through just within the last couple of years. Haven't seen a ton of M&A activity on the really big money center bank side. What's your outlook there, and how does that factor in? And I guess if the sector does better overall, how does that factor in maybe to management appetite for doing some kind of deal?
We are looking for a pretty steep acceleration in M&A activity. We clearly saw a significant slowdown in 2020. Volumes were down about 60% from 2019, where we were running at a consolidation rate coming close to 6%. I still think the factors are in place for a pretty steep acceleration in M&A activity, not so much at the money center level, but at the regional and community bank level, where we're starting to see a lot of these super regionals enter into more merger of equal type transactions, as there's still a lot of focus on improving efficiency in what is still a low rate environment, and we're still not sure on the ultimate path of credit costs in the medium term here. So there's certainly incentive and cost saves for that trend to pick up in 2020.
Cheryl, talk to me about valuations with the financials, because this is a group that has been seen as potentially benefiting from a rotation into value, which has not entirely materialized as of yet. And so the stocks haven't really appreciated at the same pace as the rest of the market. When do you think we start to see a catch up? And presumably you think the valuations are pretty attractive here, given your outlook.
That's right. I think we're looking at a group that's still trading at a depressed level on a forward earnings and also a tangible book basis. As we start to get some comfort on the deployment of next round of stimulus, the vaccine, et cetera, I think you're going to start to see earnings estimates move up as we get a better handle on where credit's going, where reserve releases continue to come from. We saw a lot on the commercial side on the fourth quarter earnings. We're going to start to see some consumer reserve releases, and ultimately loan growth and NIM expansion will help move earnings estimates up. Plus the valuation gap should catch up as well. I think we saw a nice rebound towards the end of last year, and certainly it's been a bit of a pullback since earnings season. As we continue to get these data points and inflection points coming out, I think you will start to see that re-rating of the bank sector.
All right, well, we'll check back in with you soon and see if that starts to happen and if your outlook changes at all. Cheryl Pate is a portfolio manager at Angel Oak Capital Advisors. Thanks so much, Cheryl. Appreciate it.
Thank you.
When we come back, we'll be taking another check on GameStop et al. We are seeing a pullback in many of those names today. We'll be right back.
All right, welcome back to Yahoo Finance Live. Miles Upman here in New York on this Tuesday morning. Let's take a look at the heavily shorted names with the market here in rally mode and a real unwind of the trade that's so captivated, still continues to captivate markets. AMC, GameStop, both under considerable pressure. GameStop shares are off about 50%. And Julie, I'm struck by the relative stability of the trade. And I know it's odd to say that a stock that's down 51% right now is trading with any sort of stability. But, stock was down 40% pre-market. We had the trading halt early in the session, but over the last 20 or 30 minutes, things have really kind of based out. And it does feel like overall vol within the market is calming down. And honestly, it's weird to say it, but that's reflected in the major averages. The GameStop decline and the GameStop leveling off of sorts is certainly, at least to my mind, just kind of getting the feel for this market, certainly seems to be bolstering the case for higher overall stock prices now.
I mean, I guess so. Yes, for the moment. I just don't know how long all of that is going to last. I mean, what strikes me as I look at this list is, GameStop, obviously, part of the reason that it had created such a frenzy is because of the volume associated with it. But if you look at a lot of these names and you look on any given day over the past 6 months at pre-market trading and where the volume is, it's in names like ZOM there, so media. It's in Sundial Growers, which is on the list on a daily basis. So these are stocks that have been within this rotation, right? They're frequently on the trending tickers on yahoofinance.com even before all of this happened. And so you'll probably continue to see this marginal trading activity around them. It just won't be in the same size that we have been seeing as of late. So I guess that's going to be the big difference going forward as things calm down. The question I think that we now need to think about too is where the attention turns. It looks like it's not going to be silver, right? But are we going to see some other kind of bursts of energy around some of these small names where previously there wasn't a lot of attention?
Well, Miles, I guess, the return of fundamental analysis is coming back into play here. GameStop down 50%, AMC down 41%. Looks like these retail traders are getting positioned ahead of GameStop's late March earnings release.
Maybe that's it. Look, the GameStop story, we've said it a million times. It began with a fundamental case that GameStop was undervalued at $4 per share. Right now, the company's market cap right around $8 billion by my quick math. That's roughly 2 times last 12 months revenue. So that's something more reasonable. I think that's in the ballpark of a case you could make for GameStop. And I think we've all heard the fundamental case for how they can transform their business. Brian Sozzi, Ryan Cohen, a guy you know well, he's now involved in that. And I do think, funny to say, a stock that went from 4 to 400 is going to have a big earnings release because, the story is obviously not about earnings, but probably a big earnings release coming up for GameStop in just a couple of weeks. All right, we're back. Yeah, go ahead. I
was just going to say, Brian Sozzi this morning was talking about the GameStop stores, right? That if these various Reddit traders want GameStop to do well, they should be shopping in the stores. Are they shopping in the stores, Brian?
No, and we're going to look a little bit more into that coming up very soon. But I'm looking at my story right now on Yahoo Finance. The traffic to GameStop's 5,000 stores fell a little over 20% for the weekend of January 18th. So they're not going there, despite all the activity.
So and I know we really have to go. One of the guys who was in this trade on a fundamental basis, he was on a Bloomberg podcast last week, and he said that he figured out that GameStop's online orders are tracked sequentially, and he hacked into the back end and scraped it, and he saw that online ordering was actually through the roof. So that's the fundamental bull case. You don't have to go to the store, I guess. You can go shop online. And it seemed like people were. That's hedge fund stuff. That is that's back end Chase Coleman. Let's look at the satellite image of the parking lot to figure out how many people are there, kind of stuff. So that's the game these days, kids. That's who's out there. That's who's on Wall Street Bets. It's not just a bunch of clowns sitting around tweeting memes. All right, we're coming up with a lot more here on the other side of this break. Back right after this. Well, in this era where ETFs are now the hot vehicles to put your money, the mutual fund is out, the ETF is in, we wonder who will the stars of this new financial innovation be? And certainly Cathie Wood over at ARK Invest has been crowned as the #1 star of this early phase of the ETF revolution. A couple of years ago, Cathie Wood came out and said Tesla would trade at $4,000 per share. This is right around the time that we had that Elon Musk funding secured 420 tweet. Seemed like a crazy call at the time. And then the stock traded to $4,000 per share in just a couple of years. Jen Rogers, you recently sat down with Cathie Wood, someone that you and I have talked to for a number of years. Initially, it was like, who is this person who talks about CRISPR and gene editing and loves Elon Musk? And Cathie certainly is having the laugh now.
Yeah, Miles. I mean, that's actually how I started. I said, I usually have to give a much longer intro about you, but now I don't need to give any intro about you. I mean, by any measure, 2020 was just a banner year for her actively managed ETFs. Her inflows have been incredible. She has absolutely crushed the market. Her face is now on t-shirts that you can get on Etsy. So I know what I'm getting you for Christmas. Of course, I had to talk to her about what is going on with the story that is captivating everybody that you've been talking about so much on the show. And that's what's happening with Reddit, GameStop, and Robinhood. And here's what she had to say.
Well, I find it very interesting. I've been looking at millennials in the workforce, or we've been looking. So it looks like a third of the workforce is millennials, and that's going to 75%. I started in the business in the 80s when the baby boomers were coming of age. And there was a strategist, Stan Selvigsen, Merrill Lynch, may he rest in peace. He drew expectations for demographics, baby boomers as a share of the workforce. And what happened was he believed that meant they'd be much more attracted to equities and that they would drive equities up. Now, here we are, the millennials are going from 33% of the workforce now to 75%. There's a tremendous intergenerational wealth transfer, the biggest we've ever seen in history. So they're going to control a lot more than even the baby boomers did at the time. And I think it means positive, that there are positive ramifications for both the equity markets and the crypto markets, both of which millennials have taken, in which many have taken an interest. So the GameStop and, let's get the hedge funds. One of the interesting things about this is they're actually aiding and abetting, and I don't think you've heard this anywhere else, they're aiding and abetting the bond bubble. What is happening? What is happening? These companies that are left for dead by innovation, by the way, are selling, some of their bonds are selling at 25 cents on the dollar. They're dead as doornails in many, even bond investors' eyes. Once you drop below 75 on a bond, 75 cents to the dollar, the risk of bankruptcy looms large. So now some of these companies are refinancing. They're actually accessing the equity markets. They're not refinancing their debt. They're right now, they will. They're accessing the equity markets and their bond prices are skyrocketing. They're tripling. I think it was AMC. Their bond price has just gone from 25 cents to 75 cents. Now, if you ask me, a student of innovation, maybe there's a shot of survival here, and maybe more so now that they've been able to do an equity offering, which they could not have done 2 weeks ago, maybe. But I would not be putting my money there. I want to be on the right side of change. That's what ARK is all about. Do I like a two-sided market? I disagree. I agree with Elon Musk on almost everything, certainly in terms of technology. But on this point that short sellers are a negative for the market, and ARK who were terrorized during Tesla's plunge during 2019, if you have the courage of your conviction, and our courage comes from research, back then, what did we do during that plunge when many speculators were saying they're going to run out of money? Our simple question was, how can that be? The markets have not shut down. And sure enough, they did an offering. Was it at a lower price than many of us would have liked? Sure, but it was small compared to the ones they've done recently. We bought all the way down. It was a gift for us to have those short raids.
Everything you're doing is based on research. And I think with these meme stocks, people are saying, well, what's the research? Like, what are they doing this on, right? These companies, you want to be on, as you said, the right side of innovation. So has this exposed, I mean, some people think it's exposed a systemic risk to free markets, and others think it's the very definition of free markets.
Yes, well,
where does it fall?
Oh, yeah, no. Truth will win out here. And the truth is, history is not going to be on the side of those companies that didn't invest enough to move into the new world quickly enough, and probably are not going to be a big force moving forward. So one of the things that I did find interesting, I didn't know that a stock could be, or that 140% of the float of a stock could be short. That was a surprise to me. And so I think that hedge funds, or whomever is shorting, it's not just hedge funds, there are all kinds of investors shorting out there. It's going to be interesting to see if they will stay or if they will move to such what I believe was an outrageous position relative to the float out there. So kind of, in a way, they might have seen this coming. And I do know that the one firm that got in trouble was I guess the Reddit folks were focused on the listed puts of the, now what's unfortunate about that is they probably don't know much about OTC puts, over the counter puts. Those are opaque, they can't see them. All this move will do is push all of that market over the counter, which is extremely profitable for banks, but it's more expensive for the end investors. So it's a little unfortunate. As an investor, I always like to hear the other side of the argument. And that's the other unfortunate thing that's going on here, I think. There are people who are now afraid to talk about why they're bearish on certain stocks. If during our Tesla 2019 experience, if we didn't have the cacophony of investors, sell side, buy side, retail, institutionals, putting down Tesla, we wouldn't have gotten the opportunities to buy it that we did. And we wouldn't have understood how much those investors did not understand what was going to move the stock. That helped us. And if their voices are shut down, I think that will be doing a disservice to all investors, because I want to know, what are the arguments against this position? Clearly, we're missing something, but we weren't when it came to Tesla.
And Miles, you noted that big Tesla call that has proven so fruitful for Cathie Wood and for ARK in general. I think that it's also worth noting this idea of a bond bubble. So many people talking about the trading that we've been seeing popping up, a bubble in equities. That's not what she's seeing at all here. And also, Miles, Cathie Wood is still learning stuff. She didn't even know about the float there. So it's good. I feel like I'm learning things along the way as well.
You know, I think that that's really important for viewers out there who watch this episode, and I think there's a sense that, hey, I can do this too. I mean, we could do a whole another segment on the the Roaring Kitty guy, who I think is so interesting. He sits in his basement and he live streams stock ideas. I mean, I think the way that ARK approaches their investment of ballparking the numbers, saying we roughly think this is the dynamic at play. They don't get bogged down in, well, if margins expand 15 basis points, then we really like the stock at $4 per share more. I think that's a very practical and useful way to think about investing. Look, you and I can't do a full DCF analysis, but we can eyeball that certain things are getting more interesting, right? And that's basically what Kathy told us to do.
And then she adds some discipline on top of it, and it is working for her. I mean, look, her inflows just in January, they added about $8 billion. This conversation is going to continue throughout the day, Miles. Coming up at 12:30, I'm talking with her about Tesla and, of course, your favorite, Bitcoin. Later in the day, we're going to talk about Kathy Woods, what she does during the day, and a little bit more on what's happening with the market in terms of this frothiness. So stay tuned, exclusive all day on Yahoo Finance.
Did you tell her I'm sorry?
I did not. I know you told me that.
Well, there's
no, because I think she's fine. I think she's fine.
Yeah.
She's doing pretty well. She's pretty happy.
There was just one specific time Jared was there. I know you remember it, where she was talking about the gene editing, and I had literally no idea what she was talking about. But look, bygones leave bygones. All right, a lot more with Jen's interview with Kathy Wood coming up later on today. Jen, always great to see you stopping by. Coming up on the other side of this break, a lot more here on Yahoo Finance Live. Stocks in rally mode as GameStop taking it on the chin. Stock off more than 52%. We're back right after this.
A holiday season of ordering gifts mostly online during the pandemic really provided a jolt to UPS in the fourth quarter. The delivery giant trounced Wall Street profit estimates this morning and beat analyst projections in each of its business segments. Let's dive into the quarter now with UPS CEO Carol Tomé. Carol, good to see you this morning. Thanks for taking the time. I know you're just off your earnings call. Really big quarter from UPS here. What do you think the big takeaway for investors should be?
Well, Brian, it's such a pleasure to join you today. Thanks for asking me on. I think this quarter was proof positive of our better, not bigger strategy, where we saw our revenue growth exceed our average daily volume growth.
In that U.S. domestic growth up 17.4%, really driven by a lot of people buying gifts online during the e-commerce season. How sustainable is growth like that as we venture back out into the wild later this year when we get the vaccine?
Yeah, there's been a step change in the demand patterns, with e-commerce sales now reaching about 21% of total retail sales. We don't think that's going to change as we look forward. So we would expect to see continued penetration in our B2C business. But we are looking forward to the economy recovering at some point, particularly as the vaccines roll out. And we would expect our commercial business to start to show improvement in 21 as well.
Carol, as you know, I was no stranger to listening to your earnings calls when you were at Home Depot, when you were the CFO at Home Depot, and you would always share a GDP outlook. What do you think GDP looks like this year, and how do you think small businesses do inside of that estimate?
Yeah, it's a bit like walking on jello, isn't it? The forecast for GDP for the United States is a little under 5%, but it's so highly dependent on the rollout of the vaccines and the control of the pandemic. Now, what we're trying to do here at UPS is to provide the best value for the customers who have demand, and there are a lot of customers who do have demand. So we're leaning to that experience in a big way, improving our time in transit and eliminating friction in doing business with UPS.
How would you grade the health of small business right now?
I think it's mixed. We've seen so many people lose jobs, so many small businesses close. But for those businesses who've been able to reinvent themselves, they're actually doing pretty well. And you can see that if you look at the growth of platforms like Stamps.com and Shopify and eBay and others. We have a digital access program that leans into these platform businesses in a big way. And we've seen tremendous growth in this space in 2020, and we're expecting in continued growth in 2021. In fact, we think revenues on our DAP platform will exceed $1 billion in 2021.
Carol, I was just going through this quarter in the U.S. and international, but really in the U.S., I didn't get the sense that the U.S. consumer, maybe they don't need a new stimulus plan. Do you think consumers need that extra stimulus check? Just based on your results here, maybe they don't need it.
Well, Brian, it's tricky, isn't it? Because if we look at savings rates in the United States, we see that savings rates are actually up. So many people don't need the stimulus package. And yet we know that we have a problem in our country with many who do. There's a big food insecurity challenge facing our country. So we're counting on this administration to do the right thing to get the country moving again.
Speaking of administration, I remember just a couple weeks ago when that first UPS truck started leaving with the COVID-19 vaccines. Where are you at with building out your network to handle President Biden looking to get 100 million people vaccinated within his first 100 days?
Well, we've been in the healthcare logistics business for 15 years. And we know cold chain logistics better than anybody else. We've actually created a network within our network to handle the delivery of vaccines. And it's a very complicated delivery, as you know. But we're pleased with how we're performing. In fact, we've had about 225,000 shipments, about 36.5 million vaccines have been delivered by UPS, and our service levels are 99.99%.
This year, you outlined $4 billion in CapEx, and I want to dig more into that towards the end. But how much of that investment will be to support support the vaccine rollout?
So we've already invested in the capabilities that we need for the vaccine rollout. We've stood up command centers. We have 2 freezer farms, one in Kentucky, one in the Netherlands. We've introduced new technology, which we called UPS Premier, which is a labeling that we can puts on the package that we can track the package along the supply chain. So we don't need a lot of incremental investments to support the vaccines because we've been preparing for this. But as we look at the $4 billion of capital that we've allocated for 2021, about 40% of that is for just maintenance spending. About 50% of that is for growth, and that includes growth in the United States, outside of the United States, and in healthcare broadly, not just for vaccines, but in healthcare logistics broadly.
Carol, you've wasted no time really shaking up UPS. A couple days ago, you announced the sale of UPS Freight for $800 million. Talk to us about the cultural change inside the company, but also too the financial change. When you sell a business of that size, to me it suggests you really have a good shot of really expanding your profit margins this year and next year.
So this is really a pivotal time for our company, and it's an exciting time to be part of UPS. I was on the board for a long, long time. I joined the UPS board back in 2003. And what I learned when I came into the company is that UPSers, well, they are amazing men and women who take on any challenge. When you think about the challenges faced against UPSers as essential workers in 2020, well, I just give a huge shout out to the men and women who every day got up, put on the uniforms, they sorted and delivered packages. They were essential workers. But it's also an opportunity for us to really rethink our business model. This year is our 114th year as a company. What got us here isn't going to get us to where we need to be. Our competitors are changing, our customers are changing, and the rate of change is accelerating. So we're leaning into that change. And one of the changes was to look at the portfolio of assets that we owned to determine whether or not those assets were important to us for our future. I've known the UPS Freight business since we acquired it back in 2005. It was a company called Overnight at the time of acquisition. And from that moment, I'm like, I wonder how good a fit this is. And in fact, we impaired the asset shortly after the acquisition. I'm like, I wonder what kind of a fit this is. And as I came on board and really took a look at it, I'm like, gosh, this is a low margin, highly capital intensive business that we don't need to own to provide the solution for our customer. We can do that through a commercial relationship. So we went out to see if this asset would be worth more to someone than it is to us, and we found that with TFI. And so we're delighted to have reached agreement to sell UPS Freight to TFI. This is good news, not only for UPS, but also for our UPS Freight employees, because now they're now joining a bigger LTL company. So I'm excited what it means for them from a career development perspective.
Are you done selling assets? I was talking to a couple of my buddies on the street, and you have an investor day coming up later this year where a lot of folks I think are expecting you to come out with longer term targets. Will that include will UPS be smaller? Is that part of your plan?
So when I came on board in June, I sat down with the leadership team and we agreed on the things that would not change. And we landed on 5 key principles: our values, our commitment to our investment grade rating, our brand relevance, our dividend, and the importance of our dual class employee-owned shareholder base. We said those things won't change, which means everything else in the company is under review. It wouldn't be appropriate for me to talk about future asset acquisitions or divestitures, but everything else is under review. Now, to your question about our investor conference, we will have an investor conference on June 9th, and it's our intent to lay out our longer-term financial objectives as well as the actions that we will take to deliver those objectives.
Well, I am looking forward to talking to you around that event, Carol. And full and fair disclosure for me before I let you go, I actually had to write, and you can't see my notes. I wrote on my page, do not ask Carol about the outlook for gross margins on power tools and roofing granulars, because as you know, we always used to talk at Home Depot. So I had to remind myself not to do this in that particular interview. But you probably could give me an outlook if you wanted to.
Well, I'm so proud of the Home Depot team. They're just knocking it out of the park. They're just it's a great company and love them to death. Love my new UPSer family too. I'm really blessed to have worked with such amazing companies.
Well, it's good to see what you're doing there. We'll leave it there. UPS CEO Carol Tomé, good to see you. Stay safe and keep getting those vaccines out.
Thank you.
All right, do stick around. Much more ahead on Yahoo Finance Live.
Shares of Amazon and Alphabet are both up ahead of the company's earnings after the close of trading today. Good transition to go from UPS to Amazon, I suppose, since that's a lot of the source of UPS's demand is people buying stuff on Amazon. Our Emily McCormick is here to preview those numbers. And Emily, of course, we're going to be paying attention to the overall sales, which analysts say are going to rise 37%. And as always, we got to look at web services also.
That's right, Julie. Those really are going to be the two main points here for Amazon's fourth quarter results. Amazon is expected to post quarterly revenue of more than $100 billion for the first time ever, joining Apple, which just crossed that milestone last week. Now, specifically, as you mentioned, quarterly revenue is expected to soar 37% over last year to nearly $120 billion. Amazon's e-commerce business is really going to be the main driver of that, as we've seen consumer shift to mostly online purchases during the pandemic. But Amazon also had a number of key events during the fourth quarter that helped results. There was Amazon Prime Day in October this year, pushed back from its usual July due to the virus. And then there was also the regular holiday shopping season, including Black Friday, Cyber Monday, and all of the December holidays. And Amazon had already said in early December that its 2020 holiday shopping season was shaping up to be its biggest yet. Now, one possible metric that might detract from these possibly record sales is going to be Amazon's margins. The company has been investing billions of dollars back into the business to help with its distribution costs, as well as COVID-19 related costs like warehouse safety for its workers. So Amazon had said that operating income for the fourth quarter would come in between $1 billion and $4.5 billion when factoring in costs of about $4 billion directly related to COVID-19. So that's about double the cost that they had posted for the third quarter. So again, likely to see some rising sales here for Amazon as well as rising costs. So those will be the dynamics to watch for Amazon, Julie.
So let's talk Alphabet then, Emily. And here too, we'll be looking at the cloud business. And for the first time, I believe Alphabet is going to reveal not just the revenue of that business, but also the profitability. So that'll be something new for analysts to look at.
Absolutely. And remember that Alphabet and specifically Google Cloud has been lagging here when we think about market share compared to Amazon Web Services, as well as Microsoft Azure. But looking at that operating profit here for that segment is going to be important to see how the company has generated return here on this investment, since it has been pouring in so much capital into building out this business to become a competitor to Amazon and Microsoft. Now, Morgan Stanley estimated that Google's cloud EBITDA could come in at about $3 billion for all of 2020. So that would definitely be trailing Amazon Web Services, but possibly a growth area here for Alphabet. Now, overall revenue, excluding traffic acquisition costs, are expected to jump about 18% to $44.1 billion, still largely driven by the company's core search advertising business. That's been an area that did see some weakness earlier on during 2020 because marketers had been cutting spending on advertising, especially in the travel and lodging industries, but potentially something that will now see return to year-over-year growth. So they are looking, again, for an 18% jump there on that top line. Now, we are seeing shares of Alphabet as well as Amazon rallying into their earnings results, rallying here along with the broader market and up about 1.5%, a little over 1.5% actually each here in intraday trading. Julie.
Thank you, Emily. Appreciate it. And just to quickly mention one company that came out with earnings already this morning and whose shares are down, that is Pfizer. Those shares are taking a little bit of a hit. They're down more than 3%. This after Pfizer, even after Pfizer said it expects about $15 billion in revenue this year tied to its vaccine that it developed in cooperation with BioNTech. But one thing that may be responsible for the shares falling is that profit came in a little bit below what analysts had been anticipating. So we continue to watch those shares. All right, when we come back, another check on GameStop and delving a little bit more into something that Brian Sozzi talked about earlier, store traffic. We'll be right back.
All right, welcome back to Yahoo Finance Live. And let's talk a bit more about the GameStop story. And Brian Sazi, touch on a little bit of that fundamental discussion we had earlier about the health of their business. And again, the bull case that kind of started this whole saga was about the need to digitize the business, to lean into its growing e-commerce operations. But that doesn't mean that they haven't yet, in the parlance of executive management, right-sized their physical footprint.
No, this is still a company that's operating over 5,000 stores around the world, which is really borderline ludicrous in this age of digital shopping, especially off the quarter of UPS and what CEO Carol Tomei just told us about the sustainability of those online gains. But anyway, I have an article right now in Yahoo Finance looking at the store traffic in the month of January. And this data comes compliments of Placer AI. Not only has traffic worsened each week of January, I mean, for the week ended January 18th, traffic in these stores were down 20.3%. So it indicates that despite all this frenzy, this is not a fast food situation. You know, many times in fast food, they release a new item, people bum rush the stores, they buy all the items, they take Instagram photos. That doesn't appear to be happening right now with a GameStop because the stores look, at least by judging on this data, look like barren wasteland still. Now, Miles, you did bring up a very good point earlier on. Perhaps these people are buying consoles and games online, and that's all fine and good. But when you still operate over 5,000 stores around the world with all those lease obligations, with all those employee costs, you better be selling some video games and consoles out of these stores.
Yeah, and you know what? I think that GameStop management is probably pleased to some extent to see this thing cooling off. The stock is off about 55% right now, back to $90 a share. And I think that conversation, Brian, about what to do with the business, with activists joining the board, with earnings coming up in a few weeks, that can go back to the story here, because there's certainly an interesting business case here, but a few things need to change before we're really talking about, you know, GameStop being durably an $8 or $10 billion business. All right, on behalf of Julie and Brian, that's going to do it for us here, the 9 to 11 block on Yahoo Finance Live. The three of us will be back tomorrow, 9 o'clock Eastern. Zach Guzman and Kiko Fujita have you for the next couple of hours. They're coming up right after this break.
Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Zach Guzman, and we are seeing the broader market extending its gains from yesterday right now. Let's take a look at all three majors. The Dow rallying more than 500 points in the session so far. The Nasdaq up 162 and the S&P 500 up 57. The Reddit trade losing steam though. GameStop and AMC tumbling in the session, both down well over 50%, although AMC coming off of some of its lows in the session there. The deal or no deal, Republican senators meet with President Biden to counter his stimulus plan, but the two sides show few signs of compromise. Congressman Ed Perlmutter joins us this hour to weigh in on the competing proposals and discuss the prospects for cannabis banking reform and the vaccine build-out spurring big deals in real estate. We'll discuss the boom in the life sciences industry a little later in the hour with our real estate report. As we keep a close watch, though, on what appears to be this unwind in the Reddit trade. We are in the thick of earnings season, so we're going to start with fundamentals today. And let's start by taking a look at shares of Alibaba, because we have seen that slipping despite an earnings beat for the company reporting this morning. Total revenue came in at $34 billion, powered by its strength in its e-commerce business. Revenue there was up 38% year on year in core commerce. The cloud computing business, Zach, really the big story in the quarter. The company reported a profit in the segment for the first time, adjusted EBITDA coming in there at $3 million for the cloud. That's going to be a key number to keep a watch on, because CEO Daniel Zhang has said that could be Alibaba's main business going into the future. Of course, the threat of new regulation clouding the outlook. And on that front, we did hear the company saying today it has established a special task force to conduct internal reviews in light of Chinese regulators looking into what they have described as Alibaba's monopolistic practices. Let's also take a look at UPS right now, because shares are heading in the opposite direction on that front. Getting a big lift in the session today on an earnings beat. Adjusted EPS coming in at $2.66 a share on its earnings. Revenue up 21% to roughly $25 billion. E-commerce providing a big lift there. The domestic package business seeing an increase of 17.4%. But Zach, I thought it was interesting. Brian Sozzi, just a short time ago, speaking with the CEO of UPS, Carol Toom, weighing in on the vaccine distribution process. Of course, UPS has been a critical part of the vaccine distribution, the deliveries as well. Take a listen to what she had to say about how this has forced her to sort of maybe readjust UPS's business. Take a listen.
Well, we've been in the healthcare logistics business for 15 years. And we know cold chain logistics better than anybody else. We've actually created a network within our network to handle the delivery of vaccines. And it's a very complicated delivery, as you know. But we're pleased with how we're performing. In fact, we've had about 225,000 shipments, about 36.5 million vaccines have been delivered by UPS, and our service levels are 99.99%.
So, Zach, some interesting context there as we look to this process of vaccine distribution really accelerating moving forward. Some additional numbers she provided: 225,000 shipments so far, 36.5 million vaccines delivered by UPS so far. And of course, they've got a lot more work ahead because there just simply aren't enough vaccines that have been distributed to those who are in need right now.
Yeah, and we're going to get into kind of the more details there that we're learning from Pfizer on their vaccine plans as well. But always interesting to see how this impacts different sectors, including the shipping sector that UPS is obviously a large part of. But Pfizer revealing that they expect $15 billion worth of COVID vaccine sales there in 2021. So we're learning more about how big this operation is going to be, not just for Pfizer and the other biotechs, but also, as you're discussing there, for UPS. I think the broader trend, you mentioned Alibaba's numbers there, it falls into what we've seen from a lot of companies reporting earnings this time around, that really, even though you're beating, doesn't necessarily mean you're going to see shares pop. Again, Alibaba shares in the red in today's session. And that really has been kind of the theme we've seen play out. Beats are not delivering the way you would expect, at least historically looking at it that way. And I just think it again is worth stressing here that we've moved into this period where the market's just so forward looking. Of course, that's really when we're talking about fundamentals here, Kiko. When you look at some of the other stocks we've been checking up on as of late, you mentioned GameStop and AMC off the top there, giving back quite a bit of the rally that they've seen over the last couple of weeks here. GameStop breaking below $100 even as it wipes off $28 billion in value. Of course, we've been waiting for when this would happen. Yesterday, we saw, some weakness in the trade for GameStop as well. And we've talked about the way that these bubbles tend to go. Once you see that break, which we saw yesterday, it's really tough to maintain that momentum. And I think we've hit a turning point here. Of course, I don't want to come back and have to eat my words on later shows here. But generally, what we've seen in run-ups in the past is once you hit that point and you see a move as negative as the one we're seeing today, coupled with what we saw yesterday, that tends to signal a shift in sentiment that is really tough to get back here, which is kind of why we've been stressing, look, getting in at these levels is something that we kind of warn viewers about. But I don't know. We'll see what happens there.
Yeah, I'm not sure there's a precedent we could point to, at least in the way that we've seen the run up for both of these stocks. But let's try to break down the moves. Matt Lockridge is our first guest for the hour. He is Westwood Large Cap Value Fund's co-director of equity portfolios and senior portfolio manager. Matt, give me your take on this unwind, or what appears to be an unwind happening, at least in the Reddit trade. Is this, I guess if we're talking about these stocks as we would others, is this kind of an expected pullback?
I think so. I think, one main takeaway for us is there's a lot of folks out there talking about market efficiency. And I think this is some really good evidence and a reminder that markets are inefficient. And you've had some stocks over the last couple of weeks being bid up more than they probably should have. But there are numerous examples through the year of really good companies that are knocked down more than they should on a news event or a data point, whether it's earnings or another important fact. And that's the opportunity for active investors to get in and take advantage of some of these opportunities. And I think the other, real reminder from this period is the importance of risk management. I know a lot of folks are pointing out that, look, having a hedge on where short positions are over 100% of the float, in hindsight, that's not a good hedge, and that is true. But I think it's important for investors to remember how far we've come in the markets. I mean, since the bottom in March, the S&P is up close to 50%. And even looking back further, we've had double-digit returns in the domestic markets over the last 10 years. These are above average type returns. And so given that backdrop, it's easy for folks to really think about the return side of the equation. But I think it's important at this point, given the elevated valuation in a number of areas in the market, to focus on the risk side and how much money can you lose if you're wrong. And so we spend an enormous amount of time vetting a thesis on every position we own, and also understanding if we're just simply wrong, how much money are we going to lose? And so that focus on the downside to us makes all the sense in the world right now.
Yeah, that's why I think, earlier last week when we saw the move in GameStop, there were a lot of people talking about the potential upside in AMC and some of these other names mentioned in Wall Street Bets, just because the risk reward and some of the options plays out there. I don't think the market was really pricing in the likelihood that you could see other stocks rally the same way GameStop did. But when you look out beyond those names, out to kind of the broader market, for what investors should be bracing for here in the rest of 2021. Hard to believe we only have a month under us now. But what do you maybe make of the volatility that some of that triggered? Because again, it's the second day in a row we've seen those stocks, post massive losses down 50%, but the broader market rallying. Do you think that people are embracing maybe some of the normality returning to the market?
Sure. Yeah, it's, I think initially you had a lot of the short positions get blown out, and now you're likely to see some of the long positions get blown away as well on some of these names. So that volatility is rampant, as you said. To us, I think, as we look out to 2021, it's an opportunity for investors to, take a look at the landscape and understand that we're likely to see a recovery in economic fundamentals as we move through the year and as the vaccine rolls out. And so gaining exposure in your portfolio to some of those more cyclical areas that will benefit from that tailwind, whether it's industrials or financials, there's a number of opportunities at very attractive valuations. But at the same time, remembering how far we've come and that expectations are elevated. And so having a balance in other exposures that have tailwinds, some thematic themes that will add to earnings visibility as you look out the next several years. So again, that balance between economic sensitivity and what's going to recover likely through 2021, but also a longer term exposure that should benefit from some visible growth opportunities in the years ahead.
And Matt, regardless of where the Reddit trade, so to speak, goes, there does seem to be this sense that the retail investors are here to stay. If you look at the numbers last year, we're talking about roughly 10 million new brokerage accounts that were opened, at least according to numbers out from JPM Securities. In light of the larger retail presence in the market, does that change your thesis at all? Does that shift the way that you view your portfolio?
Well, for us at Westwood, we tend to focus on long-term fundamentals and businesses that are that have competitive advantages, that have conservative balance sheets, that have the ability to grow free cash flow per share over time and generate returns on capital well in excess of their cost of capital. And we're taking long positions, letting these businesses compound for our investors over time. And so I really don't see that changing, given some of the recent volatility we've seen come from some of the retail investors. I do think other market participants will likely change how they're executing certain hedging activities. There'll likely be fewer single stock hedges and more hedging on an index level. I think that's kind of the natural evolution you'll see from this. And again, I just think it's a reminder for all of us the importance of risk management and truly understanding your exposure both on the long side and the short side.
Okay, we'll be watching.
I mean, that's something that I've been watching too, Kiko, just because of the way that we've seen this all play out here, the VIX. We are always told by a lot of our guests here to keep our eyes on that, as I do. But Matt, appreciate you coming on here. Matt Lockridge, Westwood Large Cap Value Fund Co-Director and Equity Portfolios Senior Portfolio Manager for us here to kick things off. Kiko, I know you've also been watching. I watched the VIX. You watched some other movers here. One of those, Uber, with a big deal with Drizzly.
Yeah, and we are seeing the stock move in a big way, up well over 7.5% right now in this session. Uber announcing this morning that the company is acquiring alcohol delivery service Drizzly for $1.1 billion. This is a stock and cash deal. Drizzly's marketplace will be ultimately integrated with the Uber Eats app once the transaction is completed. The deal expected to be closed in the first half of the year. But yet again, Zach, we are seeing Uber really doubling down on the Eats side of the business. We've been talking for the last several months about whether, in fact, this is a move that is going to be really just during the pandemic, but clearly Uber trying to beef up its assets on that front, and now they've got a big presence with Drizzly.
Yeah, and we would talk so much about DoorDash making their inroads in the convenience space as well, working with 7-Eleven and other big names in that space, trying to build out their delivery portfolio as well. But a shout out to Corey Rellis, the co-founder of Drizzly, who's been on the show multiple times here. A big day for him and Uber for sure. Going to take a quick break here on Yahoo Finance Live, but when we return, digging into some worrying headlines coming out on the vaccine front as researchers try and figure out how effective those vaccines will live up to battling some new variants now spreading around the globe. We'll have those updates after this. Stay with us.
Welcome back to Yahoo Finance Live. There is little sign of progress over President Biden's stimulus proposal, even after Republican senators met with the president at the White House last night to discuss potential areas for compromise. Let's bring in Representative Ed Perlmutter. He's congressman from Colorado. Congressman, it's good to talk to you today. It feels like there's been a bit of a shift in the messaging coming from the White House. The president, of course, has said that he wants to push forward on this stimulus deal in a bipartisan manner, but also in recent days sort of hinted that even if this goes through the budget reconciliation process, it doesn't mean that's not bipartisan. Where do you think negotiations stand right now?
Well, there are negotiations. I don't know exactly where they stand, but the fact that there are conversations, I think, is really important. And we're still proceeding along the reconciliation line so that, only 51 votes are needed in the Senate. But on the other hand, the fact that 10 senators and the president met to discuss the outlines of a deal, I think is still positive news. But, the COVID is not waiting for anybody. And I think that's where Biden is coming from. He wants to negotiate, but things have to happen because people are still getting sick and the economy still needs a boost. And so he wants to move this thing promptly.
Yeah, it's kind of interesting to see, what's going to happen on that reconciliation front, because there's a big difference here. At least when you look into the stimulus, it seems to be what most Americans care about is what the size of the check's going to be for them, and it's a wide gap between Republicans wanting to phase that out at incomes for single earners above $50,000 and what Democrats had pushed for in their last one. Also, the amount of the checks. So, how important do you think that is to maybe see pushed through on reconciliation if that's what it's going to take for Americans out there who are hurting?
Well, I think it's important that the payments be sufficient to help people get started. This pandemic, this virus has really affected so many families and so many businesses. We need to make sure they're sufficient, but there can be some give and take, I think, with the Republican senators. And I think that's precisely what's happening between the president and those senators. So that's one piece. The vaccine development and production and distribution, that's a very big piece. Continued assistance to small businesses and providing for unemployment insurance, that's really important. Rental assistance is important, and state and local government. There are a lot of things in the reconciliation approach that need to be done. So there are a number of major topics to be negotiated. And if they can't be negotiated, move forward on the reconciliation front.
The give and take that you point to, no question, that's sort of what's going on here. The reality is there's also the urgency on the ground of those who actually need the stimulus checks, the schools that need the additional funding to be able to reopen safely. How patient do you think Democrats should be in this process? Republicans would argue that, look, if it moves forward on the budget reconciliation process, President Biden's already going back on his word in trying to move through legislation in a bipartisan manner.
Well, I think you can be patient up to a point. The urgency of the situation cannot be exaggerated. I mean, we have hundreds of thousands of deaths from this virus. Countless businesses have been closed. A lot of people have been laid off. We've got to get moving. And that's been something that Republicans, Democrats, unaffiliated, whatever, have known for some time. So this isn't like this is a surprise to anybody. So, obviously the urgency demands action. And I think the president wants to negotiate, but he cannot wait. The virus is not waiting.
Let's talk about another issue that we have been tracking very closely over the last week, and that's what's been playing out in the markets with the Reddit traders, the limited trades, the trades that were limited through the Robinhood app last week. We got news yesterday that co-founder and CEO Vlad Tenev will be testifying before the House Financial Services Subcommittee, which you serve on. What questions do you have going into the hearing? What are key issues you think that need to be addressed on this front?
I think we want to look at sort of three different fronts, or I do anyway. One, I want to look at how did the short selling develop, and was the short sale side oversold? How did that come to be? And so I want to look at the short selling piece of this thing. I want to look at the trading component, the Robinhood, and did in fact they limit it in a way that really harmed the retail investors. And to a degree, it seems like it did. And I want to understand better their reasoning for doing that. And then I want to understand the retail investor in this. I want to make sure that, it's usually the last person into a deal like this who ends up getting left holding the bag. And I always refer to Mr. and Mrs. McGillicuddy that live down the street. And I want to make sure that our laws, our security laws, are in place to give them some protection. Now, this was so volatile. There was an element of gambling going on here, and people were taking risks. But on the other hand, we have securities laws in place that to try to protect that small retail investor. And I want to see if they've been working or not.
Yeah, I mean, there are some McGillicuddies who probably were trading on Robinhood. There's also some McGillicuddies who are probably trading on some other brokers out there. I'd be curious to get your take on why Robinhood's getting so much attention in this too, because there are other elements that seem to be spilling over to other brokerages when you talk about payment for order flow, which, we talked to Congressman McHenry yesterday about, and he didn't seem too concerned with that practice, but it is something that's getting a lot of attention that kind of points to potential conflicts of interest and brokers' interest for their customers and some of these market makers out there. So is that a piece that you'd want to learn more about too?
Absolutely. So, we've been talking about the order flow of these in this process because first in, first out, you get to do things earlier, you can make money. And we've been talking about this process since the Obama administration, and I think it's something that has to be considered. Robinhood's name kind of leads to the special attention that they're getting, whether, Ameritrade, limited margins, whether some of the other platforms, limited margins. Robinhood is coming under real scrutiny here because so many people used that platform to do their retail trades.
Yeah, and they block buys too, and so a step beyond just margin, and for quite some time too, longer than some of the other brokerages out there. I want to shift though to another topic that you watch very closely, something you and I have discussed multiple times here in your Safe Banking Act, baby, that has been passed by the House. It got passed, got included in the HEROES Act. Of course, the HEROES Act didn't go anywhere in the Senate, but back again as we talk about stimulus yet again. Potentially also going to get pushed through here. So what are your estimations for those who don't know, safe banking to reform the cannabis laws out there to let the cannabis sector access banking? And we saw yesterday from Senate Majority Leader Chuck Schumer teaming up with Senator Wyden and Senator Booker to talk about the need to get some reforms pushed through here, saying that it's going to be coming at least a draft of some initial proposals early on in the year. So how does the Safe Banking Act fit into that as maybe a first step to get to some of the progressive agenda items? What do you see coming?
I think it can be, kind of a standalone or part of a bigger package, a broader reform package. So we really need to get the federal laws lined up with the state laws. And as you and I have talked about, the federal laws under the Controlled Substance Act say anything with THC more or less is illegal for all purposes. So whether it's medicinal or recreational or cannabis oil, whatever it is, we've got to align the laws because banking laws are generally under the federal umbrella, and the banking laws, it's difficult for some cannabis companies and cannabis-related businesses to have legitimate banking relationships. So we want to get that part straightened out. And then there has to be some criminal justice reform attached to that as well, because so many people over the years have been subject to different kinds of violations and crimes that have really, caused difficult records for these folks. And we need to clean up a lot of this. And so I understand where the majority leader Schumer is coming from. We passed the MORE Act in the House. We also passed the Safe Banking Act, which is narrower and really focuses on the banking relationships. But my guess is we're going to get some broader legislation.
Two quick questions then, just to follow up before we let you go. Do you see the Safe Banking Act going through with the effort here that we're expecting on this next stimulus bill as you see it? And then two, I guess, in terms of where it could go after that, how quickly do you think that they might actually get to something that looks like the MORE Act?
So your first question, do I plan to ask that the Safe Banking Act be part of the overall COVID reconciliation bill? Yes, I plan on asking that. Whether it gets in there or not, we'll see how that works. Plan on passing it as a standalone bill. And, the Senate may take up a broader version, and we'll deal with that. If they could ever move something out of the Senate, which is where the roadblock has been, because we passed the broader bill, the MORE Act, and we passed the Safe Banking Act, and the Senate sat on it. So the Senate's got to get busy and work on this subject.
Well, very different this time around with Democratic control. We'll see what happens there. Congressman Ed Perlmutter, appreciate you joining us here today to discuss all that. Be well.
Thanks, Zach. I'll talk to you later.
All righty. Going to take another quick break here on Yahoo Finance Live, but we'll be right back after this. Welcome back to Yahoo Finance Live. Today, well, technically yesterday, just before midnight, new rules from the CDC taking effect here in the U.S. for travelers to have to wear masks on planes, trains, buses, ferries, and taxis, rideshare vehicles, pretty much everywhere where you might have already seen them being worn, now kind of making those rules here official. And that coming as we also got updates about Russia's Sputnik 5 vaccine showing that it was well more effective than some of the other candidates we've seen here in Johnson & Johnson's and Novavax's as well. For more on all of those things, want to bring on our next guest here, Dr. Sejal Hathi is Massachusetts General Hospital physician and clinical fellow, as well as the host of the Civic RX podcast. And Dr. Hathi, when we look at this, obviously a lot of people were hoping that President Biden, when coming in, would make these changes. Now they're official. What do you make, though, of those in the face of some of the variants that we've seen now pop up here in the U.S.?
Well, Zach, thank you for having me on. Again, it's a pleasure to be here. And first of all, this is an excellent and an imperative first step, and one, in fact, that the CDC urged months ago when then Vice President Mike Pence blocked the effort. And the reason this is critical is that an overwhelming array of evidence attests the significant and outsized impact of masks in curbing transmission of this virus, particularly when compared with other, if equally vital interventions, such as a national testing strategy, contact tracing, accelerated vaccine distribution. And the Biden administration's two national mask orders, firstly, mandating masks on all federal properties, and secondly, on all public transportation, are possibly the most expedient and most cost-effective measures that they might have taken. And they're as close as we will likely approach to a national mask mandate as well. But we need to go farther. And you mentioned the new variants, and they are very concerning, particularly the South African variant and the UK variant, both of which are measurably more contagious than those we've seen thus far. And because of that, we need to invest attention, resources, energy in improving not only the universality of masks, but also the quality of masks. President Biden's executive order and the subsequent rule mandates only the use of single, even cloth-based masks. But the evidence increasingly indicates that for most indoor activities, we need either a double layer, two different masks, such as a cloth mask layered over a surgical mask, or a high-quality, high-filtration mask, such as a KF94 or an N95 mask, either of which is 2 times as effective in filtering respiratory aerosols as simple or even tightly woven cloth masks. And what we've seen is that several European countries, including France and Germany, have already started mandating these higher quality masks for their general public. And with regards to mask transit,
Doctor, if I can step in here, we're talking about taking all these precautions at a time when there's also this ongoing debate about vaccine distribution itself, whether in fact, in the face of these more infectious variants, the first dose should be prioritized instead of holding vaccines for the second dose because of how effective one dose alone can be. Where do you stand on that?
So I think that it's something we definitely need to talk about and invest more research in studying. And the reason is that right now, what's most imperative is speed. What we're seeing is that these variants, and particularly the UK variant, which is expected to become the dominant strain here in the United States by next month, because these variants are so much more contagious and more easily transmissible than variants past, it might be that altering the otherwise standard vaccine rules and administering a first dose alone or focusing on that is the way to go. Now, does the evidence indicate that in normal circumstances that is the best route? I don't think so, but we might be in a different situation right now, and so I'm glad that the national discourse is pivoting in that direction.
Yeah, well, speaking of pivots, it's interesting because Politico is reporting that the Biden administration is going to be working to, roll out vaccines directly to pharmacies. It's been one critique that a lot of people have brought up, saying, "Look, why aren't you looping in some of these, locations that people are comfortable with, that they know in their communities and can see that happen?" I know maybe some of the other states that have actually seen pretty strong rollouts of vaccines so far, like West Virginia, actually went a different route and did more local pharmacies rather than some of these national chains. But when you look at that, I mean, it's clear that we have quite a few candidates now that have at least shown effectiveness. Adding Sputnik 5, Russia's variant or candidate to that, 91.6% effectiveness according to the phase 3 trial data we got in the Lancet. So, I mean, there's a lot of those out there. We know J&J, Novavax coming down the pike. What do you make of the plan, though, to maybe lean in on pharmacies and how that might actually help what you're talking about, just getting it out there?
Yeah, I think that it is incredibly smart. Right now, what we're seeing is that we have just a small fraction of the vaccines that have even been distributed to states that have actually been shot in arms. And so we need an all-hands approach in figuring out how we can institute mobile and mass vaccination drives. And everywhere, we need to look into administering these vaccines everywhere. Pharmacies is one location, but right now we're simply not moving fast enough. And so anything that the Biden administration can do to accelerate distribution of these vaccines, including at our local pharmacies, is key. Other places we could look to are barbershops, libraries, mobile vans, even a door-to-door approach as some countries are considering. But we really need to buckle down and invest significantly in bringing these vaccines everywhere we might possibly, because right now thus far we've instituted too restrictive and slow an approach. And that's really dangerous right now when we have these other variants spreading rapidly.
Yeah, and we're seeing those spread continue to document cases here across the U.S. But appreciate you joining us here to chat all that. Dr. Sejal Hathi, Mass Gen Hospital physician and clinical fellow. Appreciate you taking the time.
Sure. Thank you for having me.
All right, coming up, we're going to be shifting over to another crisis that the U.S. and the globe is working to address here, from COVID to climate change, a practical look at what can be done to battle that on the other side of the break. Stay with us. Welcome back to Yahoo Finance Live. Right now, I want to spotlight what we're seeing play out in Australia here, which had normally been an exception to bring you, but now increasingly common scenes across the globe as we talk about drought. A wildfire burning in the northeast of the Australian west coast, the city of Perth. Here we're seeing scenes there of the fire that has destroyed at least 59 homes and threatening many more. Perth, just the latest region in the globe here to deal with the impacts of climate change. Scenes that we've seen, no doubt, hit us here in the U.S. as well. California repeatedly dealing with a lot of the same issues back here in the U.S. But for more of a practical look on what is being done to deal with the issue of climate change, I want to bring on our next guest here. David Pogue is the author of How to Prepare for Climate Change, as well as a CBS Sunday Morning correspondent, and he joins us here. And David, good to be chatting with you again, man. You used to be with us here at Yahoo Finance, and now it's very important to stress kind of the practical takes that you have in your book. And you talk so much about what needs to be done here beyond just mitigation efforts, but needing to adapt. So what do you make of what we've seen play out, and what is your advice to those out there?
Man, you nailed it. I mean, there are two responses to climate change. One is mitigation, which is trying to stop it. And in my experience, that is virtually 100% of what's been written and said about climate change is how do we stop it? Fly less, use public transportation, eat less red meat. And that's all super important. Yes, don't stop doing that. But hardly anyone talks about the second approach, which is adapting to the new climate. This stuff isn't a surprise anymore. Like every time there's a new wildfire record-breaking season, we shouldn't be like, wow, what an anomaly. It's not an anomaly. That's what we got. So yeah, the premise of the book is it's time to start preparing for the new normal.
Yeah, David, I'm glad you mentioned that, because so much of the discussion is about cuts that are being made, but also sort of not necessarily the concessions we have to make in our everyday lives too. There's a lot of viewers who hear this conversation and say, well, how much of my own action can actually change things? And I wonder how you set up that answer, because at the end of the day, you've still got a lot of companies who haven't put these mitigation measures in place, haven't necessarily put out their plan in terms of adapting.
Right. I mean, it is true. I've read that 71% of our greenhouse gas emissions come from 100 of the corporations. So in that regard, you might say, well, then why should I take any mitigation steps? And there are two answers. One is it all adds up. A lot of little people making little changes add up to big changes. And the second is what they call the social norms effect. They've done studies that show if there are more solar panels going on roofs in your neighborhood, you're X% more likely to put on solar panels on your own roof. In other words, you behave the way you see people around you behaving. But of course, the thrust of my book is not how to stop climate change, but how to protect yourself. So, how to insure and where to move and how to invest and how to talk to your children, that kind of thing.
Yeah, I think it's important too. I mean, you hit on it a bit there, but we've had so many guests come in here and talk about some of those changes, and we've heard it even in some of the press conferences in the early days of the Biden administration, kind of talking about what this will do to those on the other side, right? The people who are levered to traditional energy and the jobs that could potentially be lost. It's something Republicans stress all the time. So when we think about some of these, adaptations, clearly there will be some winners and some losers. So how do you kind of focus in on the real life impacts that are going to be hitting Americans differently?
That's the big one. I mean, one thing we can say for sure is that already in 2021, there are more jobs to be had in the solar industry than there are in the coal industry. The coal industry is actually, on the grand scheme, a small number of employees. So, I'm in favor of retraining, but, as you say, there will be winners and losers, but, the world is at stake. There needs to be progress. We need to start shifting. It's sad, but the winners will be both the former coal workers, if they can find new jobs, and their descendants.
It's certainly an important conversation that we will continue here, but the book is How to Prepare for Climate Change. David Pogue, it's good to talk to you today.
You too.
Coming up, the real estate boom stemming from vaccine and therapeutic development. Much more ahead on our real estate report. That's coming on the other side of the break. Well, the COVID-19 pandemic and emphasis on therapeutics and vaccine development in the U.S. has led to a big boon in life sciences real estate. The total amount of lab space jumping more than 12% over the last year. That's at least according to numbers out from CBRE. Let's bring in Adam Sickle. He is a managing partner at Longfellow Real Estate Partners. We've also got Yahoo Finance's Jen Rogers joining in on the conversation. Adam, this is a fascinating story for me because it isn't really just about the demand picture, but the government reducing red tape. You've also got this push to onshore production. It feels like really the perfect storm for this part of real estate.
Yeah. Hey, thanks for having me. It is. We've seen a rise in demand for life science real estate, which is really no surprise. During COVID, it really shined a light on the need for more vaccines and more medicines. And I think, investors were really paying attention to that. And so what we focus on at Longfellow Real Estate Partners is specifically R&D space for the life science industry. And we've seen a rise in demand for that space in all of our markets, which include Boston, Cambridge, New York City, RTP, North Carolina, San Diego, and San Francisco.
Talking about geographies, we keep hearing from different businesses, a lot from tech, though, that people are moving out of areas where we've seen concentration before. Is that happening at all in your space? Are you seeing the move to Austin or the move to Miami, or are companies doubling down where they are?
Yeah, that's a great question. We are seeing companies really continue to grow in the regions where they are. And that's because, this is a very talent-focused market. You can't do life sciences from a remote location. You can't do experiments in your kitchen or your living room like many people can in the office world. And really, what's driving the space is the great institutions, the MITs of the world, the Columbia universities, the Duke universities, the UCSDs, the UCSFs, the Stanfords, and those institutions aren't really going anywhere. We are seeing a rise in some emerging markets, but those are really around other good university and institutions across the country.
Yeah, you raise a really good point with the institution piece there, because we've been having discussions with Miami Mayor Francis Suarez about his push to kind of draw some of the tech talent here to Miami. But that was one of the pieces that he says Florida's got to do a better job with in building out kind of the talent base. But when you look at maybe the expansion opportunities from some of those areas to different parts of the country, how true is it that you can draw people who may be comfortable with those cities specifically to other ones out there? I mean, looking back at maybe what you've seen in your data.
I would say, it all comes down to the anchor institutions. If you've got the anchor institutions, then you've got a leg up. And so, in Miami, you've got the University of Miami. They've got some good research that happens there. You've got some other solid institutions in the state of Florida. And so I think that really what's driving the growth of this space is competition for talent and drug development. And that's really, we serve both institutions. So we've done lab space for institutions like Duke University. We've got a project with New York Blood Center in New York City that is on the Upper East Side of Manhattan, which is surrounded by great institutions there. But really, these companies are spinning out of institutions, number one. And number two, there's collaborations that's happening within the pharma world to collaborate with institutions and also these younger companies that are spinning out. So there's just a lot of activity in and around these institutional nodes.
This renewed emphasis on onshoring production, it feels like that has really accelerated during this pandemic. But of course, it takes much longer for a lot of these companies to plan out how to shift production back to the U.S. So when you consider that, how much more growth do you think there is coming from that, if you're talking specifically in the real estate space?
Yeah, that's an interesting question. So that's really, we do a lot of R&D. So we're focused on the lab spaces, but what you're referencing is the production, and that's really biomanufacturing. And I think that there will be some trends here over the long term of bigger companies
repatriating, some of their facilities from offshore back to the U.S. It's less important for those facilities to go into what I'll call the broader cluster markets that we've been talking about. They don't need the same type of talent to work at those facilities, given that they're primarily production related, and so those facilities can choose from more locations.
What kind of deals are you seeing in terms of the prices? Are they getting a better price than they would have before the pandemic because there's so much empty office space and what's happening with the economy? Or is there just so much competition in this area that the prices are, where they were or higher? What are you seeing?
So last year there was record amounts of capital that went into life sciences across the country. We saw record amounts of VC capital. We saw record amounts of public funding from the public markets. We continue to see trends of FDA approvals going in the right direction, and so there is significant demand in the space. For lab space, and there's not enough supply right now to meet that demand. So we are seeing prices rise. We're seeing competition rise. I would say that there's 4 or 5 large investors in our space, including us. Most of them are publicly traded. And the competition for the better locations has gotten very competitive. And prices have continued to rise because of the specialty of this type of space and the lack of operational knowledge that exists in the market.
Yeah, fascinating to hear you highlight all of that too. I mean, we've had Moderna CEO Stefan Bancel on the show too. Perhaps not surprising, it's a Harvard grad to see him operating that company in Cambridge, Mass. But appreciate you coming on here to chat about it. Very interesting stuff. Adam Sickle, Longfellow Real Estate Partners Managing Partner, alongside Yahoo Finance's Jen Rogers as well. Appreciate the segment. Be well, Adam. Going to take another quick break here on Yahoo Finance Live, but when we return, breaking down today's big moves, including that precipitous fall being seen right now at GameStop and AMC. We'll have that and more on the other side. Stay with us. Welcome back to Yahoo Finance Live. I want to spotlight the earnings action we're seeing play out in shares of ExxonMobil. That stock is up, despite the fact that the company reported a $20 billion loss in the latest quarter. For more on that move, I want to bring on Yahoo Finance's chart master, Jared Blickery, to break that down and more. Jared?
19.3 billion, almost talking about real money here, but it was well telegraphed. Why is the stock up right now? Up 4%, as you can see on the Wi-Fi Interactive. Well, they are protecting that dividend. They are bending over backwards, $3.7 billion each quarter. And they said even if crude prices drop to $45 a barrel, they're simply going to slash spending. Now, in the quarter, they boosted fourth quarter output in the Permian Basin. That is one of their big cash cows there. By 42% year over year. That is the equivalent of 418,000 barrels per day. And they want to get that up to, where are the numbers here, about 700,000 barrels a day by 2025. Now you can see the stock is up 37% over the last 3 months. And you take a look at what they've done this over the trailing year, they are still underwater by about 25%. So the comeback story here in progress perhaps, but not going to be over the hump until they get over this $55, $60 price level here, which could be resistance. And that's still quite a bit of ways. I want to pivot now to our Yahoo Finance premium investment idea of the day. That is in Chevron, which reported earnings earlier in the week. And we have a note from Argus Research. They are lifting their price target to $108. That would be in line with the January highs of last year, reaffirming their buy on the fourth quarter results that they just posted. And they're saying that the results reflected lower crude oil price realizations resulting from the lingering effects of COVID, a one-time charge associated with the NBL acquisition, and negative foreign currency effects. Chevron isn't providing any formal guidance, but in early December 2020, the company reduced its annual capital spending range through 2025 to $14 to $16 billion, below the guidance of $19 to $22 billion. So Chevron not slashing as much as Exxon here. Guys?
All right, Jared Blickery bringing us the latest there. Appreciate that. We're going to take one more break here, but when we return, digging into what we heard from Congressman Perlmutter earlier on optimism that cannabis legislation could be coming down the pike rather shortly. We'll chat the impact on the cannabis sector as a whole, as well as how the market is still reacting to today's big sell-off in those popular retail names. We'll break that down on the other side. Welcome into the noon Eastern Time hour here on Yahoo Finance Live. I'm Zach Guzman alongside Akiko Fujita, as we are seeing all three major indices see a nice pop here on the second trading day in February. It's already a hot start to the month here. As you can see, the Dow up nearly 600 points. The Nasdaq and the S&P also firmly in the green. Everyone bracing, though, for what could come tomorrow in what so far has been a tough slate of Wednesdays in 2021. That pain coming a day early for the Reddit crowd, with our daily check here of GameStop and AMC showing quite the pain here. Both shares off more than 40% in today's session, revealing what Wall Street bets giveth, the market can taketh away, as you see there. Also want to spotlight cannabis stocks. Canopy Growth and the wider U.S. marijuana ETF catching a boost in today's session after Senate Majority Leader Chuck Schumer signed on to a joint statement saying that it's time to approve marijuana reform at a federal level. We'll be chatting that with one investor who's hot on the cannabis space in just a second. But first, want to start with those wild swings we've been seeing play out in the retail space. Of course, we got the update that Robinhood's co-founder, Vlad Tenev, who we had on the show last week, is going to be going to Washington, D.C., or at least streaming into Washington, D.C. for a House hearing there. It's triggered a lot of maybe jitters, shall we call them, in the market, perhaps not today as we see things return to normal, but a lot of questions out there for investors about what it means for the broader market. And here to discuss that with us is Joe Percoco, the co-founder and co-CEO of Titan, an investment manager built for everyday investors. And Joe, appreciate you coming on here to chat. I know you guys offer kind of, this solution to customers out there who may or may not have played in this retail enthusiasm, maybe played individual names. You guys kind of help make it a little bit easier. So what are you seeing from your clients out there right now in terms of their investment take on all of this and where they're looking to put money to work?
Thanks for having me on, Zach. Yeah, what we're seeing is now more than ever, staying informed and educating our clients is particularly important. There's so much going on, so much noise, but importantly, it seems like an entire class of investors is trying to make their voice heard in a way that they were usually shut out. So right now, more than ever, we're telling our clients just to stay informed and stay educated.
Joe, the retail trade, of course, isn't necessarily new, but it did feel like last week we really hit a peak in terms of a surge in interest. What kind of spillover effect did that have for Titan? How many additional clients did you sign up as a result?
Yeah, we've been growing exceptionally fast. Our whole mission has been to democratize everything that we've been seeing in the media these days on these locked hedge funds and try to bring the elite of Wall Street to the everyday investor. I think last time we were on here, Kiko, here on Yahoo was last April, and we've 6x since then. So we're now managing close to $500 million in assets on behalf of tens of thousands of customers. And they're all sort of clamoring to get in the door because, you really do need in times like these an expert investment manager in your pocket explaining everything in simple English.
Yeah, it's interesting because we've seen kind of the surge of that and Wealthfront, Betterment. There's a few out there. What exactly does Titan bring to the table in terms of offerings that might be different than what's out there right now?
Yeah, well, we think there's a lot of really great products on the market. In terms of what we bring, our firm goal is to make sure we be an elite investment manager. So clients come to us for us to manage their capital in an elite way. We have two strategies, a flagship strategy, which is large cap growth focused, identifying 20 stocks. We have an opportunity strategy, which is focused on under the radar businesses. We just initiated a position today in Poshmark, for example. So for us, our goal is to sort of be that investment manager for our clients.
Of course, the popularity of Robinhood is, we have seen so much growth there because a lot of retail traders want to be in control of their own money. It feels like Titan is using what some would say is more of a traditional model. I mean, what's the pitch to some of those users who say, look, if I can do everything on my app, why should I come to you?
Yeah, really great question, Akiko. The big insight that we have is a lot of folks will dip their toes on these platforms. Maybe I'll put maybe I'll put 10% of my assets and then I'll pick and choose my own stocks, but I don't trust myself to trade the blood, sweat, and my tears of my savings myself. So I'm going to keep this either in passive indexes, mutual funds, you name it. And for that lion's share of their assets, that's what they give to us. They say, hey, maybe I do want to have a little bit of exposure trading things myself, but in reality, I don't want to screw this thing up. This is my life savings. Can I have an expert in my pocket do it for me? So in a sense, you're absolutely right. We take an old school approach, which traditionally has been locked for retail investors, and try to give that to them in a really powerful way.
Yeah, I'm sure after today's moves, those investors who may have been late to the game in GameStop and AMC might be rethinking whether or not they want to be the ones here calling the shot. But Joe Prococo, Titan co-founder and co-CEO, appreciate you taking the time here to chat today.
Thanks for having me, Zach.
Also want to spotlight what we opened with here in our first hour, a discussion with Congressman Ed Perlmutter, who was the co-author of the Safe Banking Act, which had previously passed in the House. Really that effort to really let the cannabis sector start to access traditional banking, which has been something they've been locked out of due to federal laws in this country around marijuana. But interesting to hear new Senate Majority Leader Chuck Schumer joining the forces of Senator Cory Booker and Senator Wyden in an effort to push for more progressive marijuana reforms. We heard from that joint statement that they would be pushing for some more progressive things earlier in the year, not just tying it to a federal level legalization, but also some of those expungements and equality we've seen in the way that the racial impact of America's drug war has been very different across racial lines. Also want to spotlight what we heard, though, from Congressman Perlmutter on the efforts to push that Safe Banking Act in the next stimulus bill here that we might see come through shortly. Here's what Congressman Perlmutter had to say on the new cannabis reform efforts.
So we really need to get the federal laws lined up with the state laws, and we've got to align the laws because banking laws are generally under the federal umbrella, and the banking laws, it's difficult for some cannabis companies and cannabis-related businesses to have legitimate banking relationships. So we want to get that part straightened out. And then there has to be some criminal justice reform attached to that as well.
All right, let's bring on our next guest here who has increasingly looked at the cannabis sector as a potential investment theme here in 2021. Want to bring on Ross Gerber, friend of the show. Gerber Kawasaki CEO joins us now. And Ross, I mean, we spoke with Trulieve CEO Kim Rivers before Congressman Perlmutter a few weeks ago, and she had stressed that she expected the Safe Banking Act to be roped into the next round of stimulus here. You heard the congressman speaking. How big of an impact would that be for the overall sector?
Well, I just want to also clarify what you said. We are heavily invested in cannabis right now. I am all in. I am pounding the table that this is one of the greatest opportunities for investors right now that I have seen in a long time in a non-tech business. So what is about to happen is just huge. It's a momentous moment for people who've been fighting for legalization and social justice on this cause. And what we're seeing is now a sea change move and a huge opportunity for investors.
I'm glad you pound the table on that one, Ross, because, you know, I cover cannabis here.
It's ridiculously good.
Well, talk to me about why you think it's so good, because I know the reform front's there, but I think a lot of people might not realize some of the smaller U.S. operators here, since they're not listed on major exchanges, they might not know, the fundamentals and the economics behind the thesis.
Right. Since we're talking about social justice and social equity, well, it's kind of absurd that Americans can't buy American cannabis companies. It's unbelievable you can't trade these stocks on Robinhood and other platforms. You can on some and not on others, and they all trade in Canada. So here we have one of the most amazing growing industries in America that's all listed in Canada, which is the stupidest thing I've ever heard. Okay, so many investors just can't even participate. Okay, number one. Number two, we have states like New Jersey that legalize cannabis, and they just can't get the laws straight right now. And they've arrested 55 people for cannabis. And I'd love to see the pictures of the people they arrested, because I guarantee you that it is a complete travesty what's happening in New Jersey right now, that they're literally arresting kids for this and ruining their lives. We must expunge people's records. We must make this something that we wrap our arms around and make right, because cannabis laws are Jim Crow laws. They are Jim Crow laws used to oppress people. And I'm tired of it. It's enough is enough. It's legal in most states now. It's a harmless drug that people use to sleep and enjoy themselves. And it's time that we legalize this and give investors an opportunity to participate as well.
Ross, we love to have you on the show because, when you put your money behind something, you are passionate about the investment.
I put a lot of money in this. Yeah.
I wonder if we can go a little macro here, because you heard the conversation last week on what was happening around GameStop, and a number of guests who came out and said, look, this is no different than the speculative behavior we saw around the cannabis space years ago. So walk me through your thesis. Why is this time different if the federal legislation isn't set yet?
Well, this time's different. Yeah, I call it the Tilray on Yom Kippur move. Yeah, it was I was in Temple. I was in Temple, and Tilray was going nuts, and I had vowed not to look at the stock market, or God would be unhappy with. And I didn't, So yeah, we've seen these kind of speculations often. So I don't see the GameStop thing as that unique. But that being said, moving forward, a lot of times when industries start out, they get this big boom, kind of like Bitcoin too, where everybody gets excited about it, but it's not ready for prime time yet. And so cannabis wasn't ready for prime time in the first boom. And now it's shaken out all the weak players, all the corrupt guys, all the poorly run businesses. And what we have left are some incredibly good, well-run businesses. Like you mentioned, Trulieve and Kim, she's just an incredibly good operator. What a great business, Trulieve. And then I'm working with the people at TerraSend and Planet 13, other great operators that I've dealt with personally. I think management's great and the opportunity is insanely good. So it would be nice if these stocks trade in the US and everybody could participate. And I see that as a social equity issue too, kind of what all the kids are complaining about. Like, here's this great opportunity that kids can totally understand and should be able to invest in, and most of them can't. So we see cannabis this time being different because it's matured and grown into a space kind of like Bitcoin, where now it's really ready to move to the next level as a major industry.
Yeah, let me also add this too, because we talk about the profitability here of the U.S. operators versus those in Canada, but also ways to play it. We were showing the MSOS ticker, the ETF there that includes a lot of the multi-state operators. That's one way.
Right.
But when we look at the broader volatility. When we look at the broader volatility, we saw MSOS and some of these other U.S. multi-state operators take a hit because they had run up quite a bit, I guess, to start the year. But what do you make of maybe how these names will trade relative to the broader market if we do hit another air pocket here, or maybe if it just continues today, could just be a one-day salvage, I guess, in the broader market?
No, I mean, I've become a bull again. I think the Biden future for America is super bullish, and we're making strides against Corona. And I think by the end of the year, we'll have a much better life. And as you move forward, the pent up demand is enormous, and cannabis is a huge winner in the pandemic because many people have been using cannabis to get through the pandemic. And I'm not going to lie, it's been pretty helpful. So, I think what we're seeing is the beginning of a boom for these businesses as they become legitimized through federal legislation, which I see happening in the short term. But I think also these are straightforward businesses too. It's not a complicated thing running a cannabis dispensary, and it's a retail operation. It's great for the economy as well, and job creation on all economic levels. So we just see this as one of the greatest opportunities over the next 5 to 10 years. But the volatility is going to be there.
Ross, we've been focused on the cannabis space, but I know you have a lot to say about what has been playing out with the Reddit trade, the retail investors that are getting into the market. What do you make of the run-up we saw last week and the significant pullback we're seeing today? Is this an unwind, or is this the beginning of more volatility that has been injected because so many retail traders have come into the market?
Well, I think what we saw was mostly a byproduct of a poorly run business called Robinhood, where they've allowed enormous levels of margin and speculation to manipulate markets and create a lot of, I would say, systemic risk in the system, which was then rectified by the clearinghouses, which decided they weren't going to let Robinhood destroy the system through absurd levels of risk, sort of AIG style. So actually what we saw was the market worked very, very well. It determined that Robinhood was a poor actor and then limited its ability to create chaos. And that's why we're seeing the market come back this week, is because the market was very concerned about what the systemic risks of allowing Robinhood nightmare trading to continue unchecked. And so this is a very healthy check. I think it shows that markets work pretty well. And the GameStop trading to me is legit. They caught a bunch of naked short sellers, real naked, and they killed them. And the stock will move back to fair value eventually, what all stocks do. So I think I typed it this morning, like earnings is the gravity that brings all stock back, and GameStop has to report earnings, and they're not that good. So, I would avoid GameStop at all costs if I was an investor.
I'm glad you mentioned earnings because we continue to get the updates there from a lot of companies. We got obviously a few more updates this morning, and generally the theme seems to be right now you're seeing beats, but not necessarily pops that also come off of that, which I guess would maybe signal that right now. Don't know if we're trading at fair value. We've been talking a lot about valuation for the broader market, but when you look at maybe some of the catalysts here, I know you say you're a bull, you're a believer in where we go from here, but on the stimulus front, I guess that would be the next catalyst here. So how do you see that shaking out and what it means for what moves we could see?
Yeah, I think you're hitting it on the nose. I think markets had anticipated the results that we're getting, and they're in line with what the market had anticipated, which were very positive by the PE ratio of the market and the growth we've seen in the stock market. So the market's very highly valued right now. So expecting like huge pops, I think, is a little bit unrealistic because we've already seen the growth, and now we're getting the confirmation from the earnings reports that growth was warranted. So really, the market's saying, "What's next? Where do we go from here?" And stimulus is a big part of it. We've created a country where the government, taxes you and then just gives you free money, and nobody seems to care, and rates are low. So nobody seems to care. So of course, if they have any stimulus at all, I mean, most of people in America are actually employed. They're just going to spend that money or invest that money, and it's going to be bullish. But it's bearish long term because we have to pay for it. And as much as everybody is really happy right now, the biggest risk we see is inflation. Inflation is coming back at the end of the year. When this economy opens up, it's going to be a floodgate of spending. I mean, just trying to take a trip to Hawaii is going to cost you a fortune. So I think the boogeyman's going to be higher rates and inflation that we're going to see when we actually do have the economy come back. But right now, I think we're in a sweet spot between, too much growth and too little growth. And there's an opportunity in here for investors that might get more difficult as things get better.
Ross Gerber, always enjoy having you on the show, the CEO of Gerber Kawasaki. Good to talk to you today.
Yeah, thanks for having me.
Coming up, we are breaking down the business model for commission-free brokerages that have been caught right in the thick of these Reddit trades. You've probably heard payment for order flow referenced over the last week. Brian Chung is going to break it all down for us after the break. Welcome back to Yahoo Finance Live. ARK Invest funds have been on a tear over the last year. Its ARK Innovation Fund alone has more than quadrupled since the low we saw in March. And now founder and CEO Cathie Wood has her eyes set on a new theme for innovation. Jen Rogers sat down with Kathy Wood and brings us this interview. Jen, there's always a lot of attention on what Kathy looking at specifically, because she has been so focused on a lot of these innovation names that have performed so well over the last year.
That's right. And as you said, she's done incredibly well. Her portfolio of thematic active ETFs raking in some 30 billion in inflows last year, 8 billion in January, returns above 100%. So she really made a name for herself early on, crypto, and then it was that Tesla call. Tesla, her biggest holding, the Tesla call going to 4,000. Look, she turned out to be right on Tesla. She's now talking about her big ideas for 2021, and electric vehicles are still part of her thesis on innovation and disruption. That's one of the things we talked about.
If we're right, this market is going to go from 2.2 million sales, that's units, in 2020, it might be 2.3, to 40 million in 2025. So all of these announcements have increased our confidence that the capital markets are going to finance this transition from internal combustion engine to electric. That's great. Who is going to be leading the charge, so to speak? We still think it is Tesla, certainly in the United States. Even in China, Tesla is the #1 brand. Now, the smaller vehicles in China, there is a company, I've forgotten its name. It might be associated with SAIC and GM, by the way, that is pulling ahead, but that's not counted as a true electric vehicle. These are the ones that go 25 miles an hour, golf cart types of things. So we think that China might hold the secret as to the next big winners. We know that NIO, we do not own NIO, it's a battery swapping company. So instead of charging, they swap batteries. That is going to win the day. We think that Xpeng, which we do not own, but which is emulating Tesla, might. We're seeing, and we do own in our more specialized strategies, BYD was a battery manufacturer to begin with, and Warren Buffett has owned for many years a piece of BYD. That has done very well. We own that. And then Geely, which bought Volvo, and I believe the chairman of Geely owns a position in Daimler. It is also doing a lot of interesting things in terms of partnering with various companies, including Baidu. So if I had to give you which of the Chinese names we have the highest conviction in, it's probably Baidu. And that had been a hard sell for me because their search business was falling apart. And it did seem to me, with more than 150 or 200 electric vehicle manufacturers, many being government subsidized, that there would be a bloodbath. And Baidu is, the government has deemed it the autonomous platform for China. We weren't sure whether to believe that or not, or if it would get caught up in the carnage, but it does seem to be doing something very interesting. And there's also another company called AutoX. This is more, they're working with Dongfeng, which is mostly involved in the trucking space. But we did take note that AutoX has gotten approval from California to go fully autonomous there. I didn't know that until very recently. So that could be another one to watch.
So big ideas 2021. First of all, I just want to remind people that all your research is on your website, along with all your trades. I mean, everything is there, people. So you can go and click and read the whole thing. We're going to go through a couple more of the big ideas, though. And I want to talk about crypto. We've got number 6 and 7, Bitcoin's fundamentals and Bitcoin preparing for institutions. So, you've got a lot of fans in the crypto space. I want to know what you think here. And of course, Bitcoin, some people think, look, it's already hit its highs for 2021, the high water mark of above 40,000. What's ARK's thinking here?
We do not agree with that. And what's been interesting this time around is if you look at Google search trends for Bitcoin or Bitcoin's price against the Bitcoin price itself, you'll find that there's not a lot of speculative activity by that measure. In fact, in 2017, they were 1 for 1 together, but it has been pretty quiescent until maybe very recently, but throughout last year. And so that gave us a lot of comfort. We believe that the institutional behavior and moves recently have been fascinating. We have been expecting institutions to start moving into Bitcoin and other crypto assets, but primarily Bitcoin, the most secure of the blockchains, because if you look at the correlation of Bitcoin's performance relative to any other asset class, it has the lowest correlation, meaning if you buy some Bitcoin, you will further diversify your portfolio and increase your returns with lower risk, right? So that's why institutions look for that low correlation. Bitcoin has it. And so that's clear. We have 10 years of history now. But what surprised me and us generally was to watch MicroStrategy, which has put all the cash on its balance sheet into Bitcoin, and even did another equity offering so it could put more cash on its balance sheet. And I think that's a little crazy, because I think the regulators will have something to say about this in terms of what is this? Is this company the MicroStrategy technology company, or is it like an ETF? So we don't know about that. But then you saw Square put 1% of all of its assets in Bitcoin. And I think you're going to see more of that. We didn't expect that. What we did expect was, because of the low correlation of returns, institutional investors to move in. The most surprising one to me thus far has been MassMutual. It put $100 million into its general account. Now, its general account is enormous. So $100 million is something like 0.001. But what that move told us is, MassMutual is very conservative and very highly regulated. And so it had to jump through many more regulatory hurdles than I thought would have been possible by now. So I think that is a seal of approval. And then, of course, you have the institutional infrastructure moving into place, whether it's with custody, and everyone knows a lot about Fidelity being out there in terms of wanting to custody Bitcoin in particular. You have the Intercontinental Exchange, and you've got the CME now with Bitcoin futures, one settling in kind, one settling in cash. And so we do believe that Bitcoin is getting ready for institutional. But when we actually think about this, is Bitcoin ready for institutions? Bitcoin is it's roughly a $600 billion market cap. So not even half the size of Apple or Amazon, right? Yep. Doesn't put it into perspective. And yet it is a very big idea. I think a much bigger idea than Apple or Amazon. It's the first truly global digital currency out there. And it is completely decentralized. There's no throat to choke. So unlike with Libra, you had Europe and the US and many countries saying, we'll never allow this. That's because there was one throat to choke. With Bitcoin, there's no throat to choke. And in fact, when China basically shut down the exchanges in China that dealt in crypto, especially Bitcoin, that activity just moved over to Japan, Thailand, and Korea, other countries that wanted to move ahead in this innovation space. They did not want to miss this next big thing.
So they have 15 big ideas for 2021. Aside from the two we just talked about, there is some healthcare plays in here, digital wallets, and also orbital aerospace and delivery drones. So you can read all of the research because Akiko, they give it all away. You can see all her trades and what she's moving into and out of. But it is interesting to get her take a little bit deeper on some of these big calls, and especially on Bitcoin. She says we haven't seen the high watermark for 2021.
Yeah, I mean, not just interesting to hear her takes, but they've actually performed quite well. So certainly worth checking that as well. Jen, thanks so much for bringing us that interview with Kathy Wood. We are off for a quick break, but on the other side, we are taking a closer look at the business model for commission-free brokerages. We'll be right back. The volatility around the Reddit trade and the popularity of Robinhood has placed renewed focus on the business model of commission-free brokerages and the potential conflict that could come with payment for order flow. Fortunately for us, we've got Brian Chung here to break that all down for us. And Brian, of course, Robinhood's taken all the heat, but their business model isn't necessarily unique.
No, it's not unique. And for that fact, brokerages, other types like TD Ameritrade and E-Trade are relying on order flow as well for revenue. But let's take a big step back here and just kind of think about exactly how all this works. So brokerages help clients place orders on securities. So these brokerages will be, like I said, TD Ameritrade, E-Trade, Robinhood as of late. Now, they used to charge a fee per transaction. People who have been stock trading for decades know that that used to be the case. And Robinhood stepped in with a very interesting model. They said, why don't we just cut the fees altogether? We'll make money by adding a middleman. And the middleman in that case are market makers or high frequency traders like Citadel or Virtu Financial, previously arcane members of this whole kind of paradigm here that had really come into view with the controversies around the GameStop stock and what's been going on Wall Street Bets. Now, the market makers group those orders together. They call that order flow. And then they dial into the exchanges like the New York Stock Exchange to actually make the trades. Again, the middleman there. So those market makers end up paying Robinhood or Charles Schwab or TD Ameritrade to get that order flow. So the question naturally is, how profitable is that of a model for Robinhood? And we've got some data that we can show you in a full screen here. This comes from AlphaCution in addition to the Securities and Exchange Commission, showing you how much money Robinhood has made through this scheme over the course of 2020. This only covers January through September, but you can see in total, It's about $466 million that they made through just selling order flow to the likes of Citadel. But also keep in mind here, it's not just Citadel. Look at all these other broker dealers that are involved in this as well. When you look at G1 Execution Services, Wolverine, Virtu, Two Sigma, even Morgan Stanley. Now, of course, Citadel, which is the purple bit of this, is quite substantially large part of their business model. About 46% of that order routing coming from Citadel right there. So definitely worth thinking about when we talk about the interaction between these brokerages like Robinhood, in addition to these high frequency trading firms. Very important to keep in mind as people continue to use these brokerage services. Zach, Akiko?
Yeah, not just them. As you said, TD Ameritrade making more than $200 million in a quarter here off of the same kind of model as we see them swoop in on the model that Robinhood really pioneered. But interesting stuff there. We'll see if the SEC comes out with new enforcements against all that. Appreciate it, Brian. Gonna take a quick break here, but when we return, digging into the efforts being built out on the vaccine front. A lot of focus there on Pfizer and some of the other names working on those vaccines. But we'll be chatting with another company working in that effort to build all of those out. The CEO of Emergent Biosolutions will join us on the other side of the break. Stay with us. Welcome back to Yahoo Finance Live. Earnings season rolling on here on the Tuesday. I want to spotlight the reaction we're seeing play out in Pfizer shares after the company clocked earnings here for the fourth quarter that slightly missed Wall Street's expectations. The company, however, did raise its earnings guidance for the full year 2021. We also got the update that Pfizer's expecting about $15 billion worth of COVID vaccine sales in 2021, and that news comes as we're seeing updates for some other vaccines out there, including Russia's Sputnik 5, showing about 91.6% efficacy, according to phase 3 trial data that was published in the medical journal The Lancet. That comes to join quite a few of other vaccines out there now when we look at Pfizer, Moderna, Sputnik 5, as well as Novavax and J&J's efforts. So a lot of attention's been placed on those companies that you might have heard of working on the vaccines themselves. But let's talk about one that's also working to build out distribution here. Emergent is one of the names that has been talked about in that space. Emergent Biosolutions here, you can see shares through the beginning here of 2021 has outperformed a lot of those names we've talked about. The stock's up about 25% to start the year. And I want to bring on the CEO of Emergent Biosolutions here to chat with us. Bob Kramer joins us now. And Bob, appreciate you coming on here to discuss. I mean, you guys are working here behind the scenes. I know you're working with AstraZeneca and Johnson & Johnson to build out some of those vaccines. So what have you seen in this? What do you make of where we're at now with all of these candidates coming through and showing some pretty positive results?
Yeah, thanks for the time this afternoon. It's a pleasure to be with you and provide a bit of an update to your listeners. So a lot of progress has been made over the last 6 months. I think last time I was on the show 6 months ago, we were talking about our efforts to stand up a durable manufacturing process and equipment to make a number of vaccine candidates in a very large scale nature. We also talked a little bit about our therapeutic program, but maybe just to stick with the vaccine front for a minute, we have already made significant progress in standing up that manufacturing capability at one of our sites outside of Baltimore. We are, in fact, today manufacturing both the AstraZeneca as well as the Johnson & Johnson vaccine candidate, such that we have a bit of a head start provided to them that when the FDA approves availability for their candidates under the emergency use authorization, they will already have some vaccine in the stockpile ready to deploy. So a lot of progress has been made, and in keeping, I think, with the U.S. government's strategy a year ago, let's have as many shots on goal on the vaccine front as we can. And clearly with Pfizer being out there, with Moderna, with J&J and AstraZeneca, those are 4 pretty important shots on goal.
It seems like there's a bit of a disconnect between the headlines we're seeing out of Washington versus the reality that's playing out on the ground. On the one hand, we're hearing from the Biden administration that they are in fact pushing forward with a ramp up in vaccine development, 200 million additional doses purchased. And yet from city to city, we're hearing about people who simply can't sign up for the vaccine, are being told there's not enough vaccine either. You've got really good clarity or visibility on the manufacturing side of things. Where do you think the bottleneck is, or what do you attribute the bottleneck to?
Yeah, I think first of all, this is an extremely complex and complicated orchestration of a number of events that really have to come together. So when you look at the development work from the clinical perspective, the manufacturing and development work that we are actively engaged in, and then on the distribution front, for all of those 3 elements to work in a integrated, cohesive way is a huge undertaking. I think a lot has been done to try and make that process as efficient as possible, while at the same time always ensuring that at the end of the day, we have safe and effective vaccine coming out the other end. So here at Emergent, our focus is in that middle ground of making sure that the supply of these vaccine candidates is made consistent with the overall objectives of the government and our collaborators. So I really can't speak to the distribution and administrative side of things, other than to say that our job here at Emergent is to make sure that we're supplying to our collaborators the appropriate number of doses to support their needs.
And of course, there's a lot of hope riding on that Johnson & Johnson vaccine, largely because it is a 1-dose vaccine. You talked about the manufacturing already underway in the stockpiling. Whenever the FDA gives the green light, that's ready to go. How many doses are we talking about?
So that's really up for J&J to decide. We have visibility, Akiko, into what we're doing as part of that supply chain solution for J&J, as well as AstraZeneca. They have other collaborators that they're working with as well. So I'll leave it to them to describe and discuss how many doses they could have available when they get EUA approval.
Yeah, and Bob, I mean, I guess if you look at kind of the landscape, it's gotten lost, I think, a bit because, we on this show, the broader financial news space was so intensely focused on what this rollout would look like. And then we had a little bit of market jitter come through here with a different story in GameStop and AMC. But when we look at what was playing out ahead of all that, it seemed like there was a lot of negative sentiment when you look at variants. and everything else, distribution bottlenecks that Akiko's referencing there. But now, as we move past it and got those updates from J&J, Novavax even, it seemed like things were moving in the right direction. So once you get those addressed, you have more, companies to work through. It seems like the number is going to be good. So what do you make of putting all the data together, looking at all the companies out there rolling these vaccines out, what you think about in terms of getting back to normal by potentially, the spring, the summer, the fall? What's your timeline?
Yeah, so first of all, our mission here and role in this at Emergent is to make sure that, again, we're manufacturing and making available the doses of both our collaborators' vaccine candidates to hopefully get to that new normal state whenever that is. I used to think it was going to be sometime late last year, early this year. It's looking more likely that it's going to be late this year. The first priority is to make sure that whether it's on the vaccine front or the therapeutic front, that these critically needed medical countermeasures are made safely and effectively and in quantities sufficient to really fight this pandemic and hopefully kick it to the curb quickly.
All right, well, we'll leave that there for now. Emergent Biosolutions CEO Bob Kramer, appreciate you coming on here to bring us that update. Thanks again.
My pleasure. Thanks.
Coming up, we are seeing travel stocks catching quite a pop here in today's session on some of those positive vaccine developments. Jared Blickery is going to break down the moves in today's trading session right after this. Welcome back to Yahoo Finance Live. We are seeing a big pop in a lot of the travel names tied to some positive vaccine development news. Booking Holdings right now up more than 5%, close to 6%. We had the CEO, of course, on the show yesterday. Glenn Fogel joined us. Not sure if the market's just watching our interview now or if it is that broader move we're talking about. Here to break it down, I want to bring in Yahoo Finance's Jared Blickery, who has the latest on Booking and all the other travel names we're watching. Jared?
Zach, it is indeed the YF viewers who are boosting the stock right now, perhaps. Booking Holdings up 5%. Now, you take a look at the other travel names here. We got Royal Caribbean up 3.5%. Some of the airlines popping nicely too. United and Delta each up over 1%. Standout here is American Airlines. But guess what? If we remember from last week, they were one of those heavily shorted names that got a pretty big boost. You look at what they've done after earnings. This is roughly that time period, still holding on to 8% gains. I think we can kind of call this this spike here an anomaly. Just looking at some of the other names here, Marriott's up 3.5%. And a lot of this comes on just positive incremental news on the vaccine front. A big stat that crossed today was that the total number of COVID vaccines have surpassed the number of positive tests in the US. And so it's just kind of one of those feel-good stories. Also have incremental news on the $1.9 trillion stimulus. Might not end up being that big, but we will have to see. Now, let's take a look at the broader market. Nasdaq, look at this. The big guys really popping here, especially Tesla, up another 4.5%, recovering all of this slide over the prior 3 days here that began this 5-day period. And then taking a look at some of the other names, Facebook's up over 2%. And then you have Amazon and Alphabet, each up 1.81% ahead of their earnings after the bell. And we will definitely be talking about that, guys.
And Jared, we can't have a hit without talking about Reddit. And we saw Reddit investors sort of rallying around this hashtag BioWar. You say today, biotech the most heavily shorted.
Yeah, let's take a look at that heat map right now. And what stands out is just the amount of dark red on the screen. But some of the smaller names in the lower right there are in the green, and we'll highlight them by sorting by performance. Now, some of these biotech names are pretty beaten down and also relatively unknown, so lots of volatility and danger there if you are trading. But this name, Artelo Biosciences, up 38%, getting a nice spike. Also NTN, this is NTN Buzz Time, up 70%. Not sure that's biotech, but let's check out this one. Kopin Corporation, up 13%. A lot of these names I haven't seen over the prior days. Some of them we just added today. Here's another biotech name that we have been tracking. Vine Therapeutics up 9% here. And just thinking about the moves in GameStop, because this is kind of the poster child for all of this. This is the 5-day price action. Doesn't look like much on the screen, but these are huge moves here. For instance, this was a 1, 2, 3. This stock doubled, tripled in this time period last Thursday. And even this muted action that we're seeing today, off the lows, we were up 100%. And that's after being down about 2/3 from yesterday's close. So still lots of action in these stocks, lots of halts, but the brokers seem to have it under control, at least with their own margin positions. And we'll have to see what names appear in the coming days, guys.
All right, Jared Blickery breaking down those moves for us. Appreciate that. I want to bring our attention to news that we have out on one of President Joe Biden's confirmed picks here in his cabinet. The Senate confirming Pete Buttigieg as transportation secretary. We've been watching those kind of come in here, but that has now been confirmed. Of course, the South Bend, Indiana mayor seeing quite a promotion here at Kiko up to transportation secretary. One of those names that a lot of people were wondering where he was going to play that role. Finally, now we can say that one is confirmed here by the Senate. All these pieces kind of falling together, that one being the latest for Team Biden. Also want to kind of wrap up the show here with a discussion on one of those names we've seen play out here. Kiko going to approach the public market. It's a name I know well. We are seeing Bumble in a new filing lay out what they're going to be doing to try and raise what could be potentially as much as $1 billion listing shares here, seeking to list shares here at $28 to $30 a piece. 34.5 million shares potentially in this IPO. But Akika, it's interesting because we kind of saw the steam come out. We saw two names in January double in a week in terms of their IPO day pop. Not sure what we're expecting here for Bumble.
Yeah, I mean, Bumble is seeking a valuation of nearly $6 billion. So we'll see if that holds. Of course, it's going to be interesting to me to see how the company performs or how investors assess sort of the outlook for the company in a space that has become increasingly crowded. Bumble, of course, Zach, as you've explained to us, is unique, at least among the dating apps, because it's the women who initiate the contact that has sort of been the attraction and allowed them to grow in a significant way. But they hit a bit of a snag last year, like so many other dating apps, because of the coronavirus and, of course, so many having to stay at home, sort of putting an axe in the dating scene. But we'll see where it goes through. To your point, the IPO market, certainly a very strong one last year, $168 billion in 2020 alone, at least according to numbers from Dealogic. And what we have noticed, and this is really oversimplifying it, but that the names that a lot of retail investors are very familiar with, like an Airbnb, like a Poshmark, like a DoorDash, have really seen a significant pop on the first day. Of course, other mechanics in question on why that pop was so significant, but we'll see if we see the same for Bumble when it actually does come to market.
Yeah, and I don't think that's oversimplifying it too, especially in the wake of what we saw with GameStop and AMC. A lot of those heavily shorted names, people focused in on the names that they knew, even though there was some on that list that might have been, higher examples to chase in terms of short squeezes that you could come see through just because of the short position. But there was kind of this weird confluence around those names that were popular with consumers. Just one last point for me, though, in terms of where valuation goes. We'll see what happens when shares start trading. But you're right. I mean, it's going to be a pretty big jump from the $3 billion valuation back in 2019 to potentially $6 billion. That's a double right there. But of course, as we've seen on day one of trading, shares pop brings that valuation quite a bit higher. But we'll see what happens. Exciting times as we see another big consumer name, as you say, come to market. We'll keep you updated potentially around Valentine's Day is when that debut could come through.
How fitting, right? We can talk about dating in COVID times with a Bumble IPO on Valentine's Day. And of course, Zach, you will be at the center of that conversation. That's going to wrap it up for us here in the 2 hours of Yahoo Finance Live. But coming up a little later on our show, we've got Ed Bastian, the CEO of Delta Airlines, in an exclusive interview you see right there, 3:30 p.m. Eastern. That will happen right here on Yahoo Finance Live. Certainly a lot to get through to on that front, especially with the struggles with travel overall. Much more to come here on Yahoo Finance Live. Kristen Myers is going to pick up our coverage on the other side of the break.
Welcome into the 1 p.m. hour here on Yahoo Finance Live. Taking a look at the market action right now, as you can see, all three major indices are in the green, rallying today, continuing that rally that we had seen yesterday, as those Reddit-fueled trades, however, are reversing course and are absolutely sinking today. So let's take a look at some of those. As you can see there, GameStop down about 50%, AMC also in the red, down about 40%, Express, Bed Bath & Beyond, and BlackBerry also in the red. It had been a little bit of a mixed bag yesterday, but all of those trades are in the red, sinking. GameStop actually had been down below $100 a share, obviously paring back some of those losses, now down about to $120 a share. Let's take a look over at another thing that we'd been chatting about yesterday, which was silver. Silver had been in the green, soaring up over 8% yesterday, just in this hour. Yesterday, as you can see there, down almost 10% now, completely reversing course. We had seen some highs in almost a decade in silver yesterday. As you can see there, silver taking a huge hit. I want to take a look right now over at some two stocks. Let's start with Alibaba. Alibaba right now in the red. However, despite beating on both top and bottom lines in their earnings report, down about 3% right now. Want to take another look over at Harley-Davidson, also in the red. The company missing on both top and bottom lines for its fourth quarter, sinking over 19% right now. They reported a loss of about 63 cents per share on over $700 million in revenue. But I want to keep talking about that speculative trading that we've seen continue as those Reddit-fueled trades are tanking today. We've got Yahoo Finance's Jared Blickery here with the latest. Hey, Jared.
Hey there. Well, let's look at our famous heat map now, which is flashing the wrong colors largely. Lots of dark red here. We can see poster child GameStop down 47% still. And this may not look like a big day, but these moves are huge from the close of yesterday into the bottom today, which we had just before 11 a.m. That was good for about 2/3 wiped off of its value. And then it rose about 100% from that low to this high and just kind of going sideways right now. Now, in the context of what it's done over the last 5 days, we can see really had that breakdown yesterday. It began in earnest, and we're getting some follow through today. Where does it end? Nobody knows. But for what it's worth, here is a 1-month chart. It would look to me, just based on this simple chart here, $100 could be a battleground. So we'll keep an eye on this. But there is some green. And if we sort by performance, some of the smaller names still holding on to some gains today. A lot of these centered in biotech. Again, these are very small companies that we're highlighting, but it does give you a sense of what's going on here. So here's Artello Biosciences, up 30%. You can see holding on to gains of 85% over the trailing month. And then we have another name like Vine. That's up nearly 9% today, up 59% for the month. So we've seen this daily rotation in the trades by the Wall Street Bet and Redditors. Silver was kind of du jour yesterday, kind of some conflicting information, whether it was really Reddit or hedge funds. Regardless, we're just seeing this daily rotation. And today seems to be about biotech and not so much those names that were high flyers last week.
Which, of course, makes you ask, what is going to be it tomorrow? So, Jared, you're going to stick with us for this conversation. I want to bring in Mark Rosenberg, CEO and co-founder of GeoQuant, to chat with us about this. So, Mark, you were hearing Jared talking a little bit about that, what's been going on with some of these Reddit-based trades. I'm wondering how you see investing in general changing going forward. If you think that this populist method of investing via Reddit or some other social media platform is really here to stay.
Yeah, I think the general kind of chaos-driven challenges to establishment institutions, which we've seen throughout our political economy, frankly, whether it's in the political arena or now in the markets, is here to stay. Now, how that plays out specifically, I think no one can tell, but the idea that how things were and the expectations of the kind of established players in these markets will be shaken up by kind of bottom-up, internet-driven groups, I think is probably here to stay.
Well, I want to follow up on your firm's work where you kind of go through and you highlight, according to your website, that you combine political science and AI to measure and predict geopolitical risk at high frequency. How does your firm assess this? And do you get into regulatory responses? Do you think the SEC is going to respond in a particular way? Are you trying to handicap things? I just want to understand your business and how you're approaching this.
Sure. So what we do is quantify country risk, really, which is largely unquantified and kind of narrative-based currently. But what we do is basically try to measure various country risks, including regulatory risks, the kinds of things you're speaking about for a sector, say, like financial sector, which would be regulated by the SEC in the United States, and then try to, once we quantify that, look at those measures directly against market outcomes and get a sense of how much of a role politics is playing in various asset movements, whether that's on the upside or the downside.
So, Mark, then speaking about that risk, how would you advise some of your clients to kind of manage some of the risk that we're seeing in the markets based on some of these Reddit-fueled surges? As Jared was saying earlier, yesterday, silver was the trade of the day. Today, it's biotech. Who knows what it's going to be tomorrow? If you're an investor in this, how do you manage some of those risks?
I mean, most of our clients are larger asset managers, and I think for them, for the most part, they are observing but not necessarily participating in these kinds of volatile trades. But broadly speaking, what we advise them, again, this is based on our data, which is really showing a significant increase in institutional risk in the United States and social risk in the United States. Is that again, you know, the same forces that are driving kind of our wacky and seemingly unpredictable politics of late, including what we saw, you know, on 6th January and the Capitol riot, et cetera, are of a kind with this kind of activity in the market, which is effectively that large segments of the population are losing faith in our traditional institutions. They believe certain institutions, whether it's the political system or the market system, are rigged. And they are increasingly using internet-based tools to take power to try to fight, you know, that impression. And of course, just like in politics, there are elites in the markets and in kind of the social space that will take advantage of that fervor to try to use it to their advantage. And I think that's what we've seen in politics, and that's what we're going to see in markets. And so what we advise our clients is really to pay attention to those underlying social and institutional dynamics in terms of thinking about, you know, where things could go pear-shaped.
Well, I want to ask you about an asset class that's seen hot money flows recently, but not over the last weeks. Certainly speaking about cryptocurrencies, Bitcoin in the news. We have a new administration, lots of potential new regulatory influence there. Gary Gensler at the head of the SEC, very knowledgeable on blockchain. How do you see this playing out over the coming year?
I think crypto, and particularly Bitcoin, is going to see increased regulatory scrutiny over the coming year from the U.S. government, and in particular because, you know, ultimately, the cryptocurrency is a challenge in a sense to kind of a key prerogative of the sovereign, right, which is managing its own currency, particularly the U.S. dollar, which is the world's reserve currency. And so, to the extent that Bitcoin starts becoming a you know, credible and lasting store of value that's an alternative to the dollar, the government is going to take more and more of an interest in kind of checking that competition. And I think with Gensler at SEC, I think that becomes higher on the agenda than it might have been otherwise. And whether that's because the government starts taking greater steps toward things like their own digital currency, like a digital dollar, as we've been seeing in China, or whether they start regulating the Bitcoin mining, which we've also been seeing in China, where, you know, in general, I think the government is going to take a bigger role in trying to kind of maintain its comparative advantage here, right, which is the ability to manage currency in this economy.
So you're talking about a lot of regulatory risk that could be coming down the pike, but I'm curious to know where on the other side of things you see a risk. So I think about this populist rage. I think back to Occupy Wall Street, for example, and then several years later, we now have this movement, right? These huge swings in the market underpinned by that class range. What's next? Then, do you think? What is the next big thing that could potentially happen? Where do you think this movement inevitably goes? Does it stay here and making huge swings in the market on some of these trades, or does it go somewhere else and do something else?
I mean, I think, you know, that's a good and also a very difficult question. I would think effectively the next place this goes is to the platforms themselves, and that, you know, a lot of these technology platforms, whether it's Twitter or Reddit or Facebook, have been the kind of mechanism by which this kind of resentment or this kind of, as you say, populist rage has kind of filtered up into core institutions, the political system, the markets, et cetera. But those technology companies and platforms themselves, ultimately, whether it's, you know, banning the president of the United States from tweeting or Robinhood cutting off trading in GameStop stocks are ultimately, beholden to those institutions. And so I think what you'll see is growing pressure on the platforms, whether those are alternate platforms, whether that's kind of growing movements like the cancel Facebook or quit Facebook movement. I think you'll see the platforms, which are the mechanisms now for a lot of these movements, then becoming the targets.
All right, Mark Rosenberg, CEO and co-founder of GeoQuant. Thank you for joining us. Of course, thank you as well to Yahoo Finance's Jared Blickery for giving us all of those updates and participating in this conversation. And coming up, we'll be bringing you the latest in the coronavirus pandemic. Welcome back to Yahoo Finance Live. Let's chat now about the ongoing coronavirus pandemic that has grown to over 26 million cases here in the United States. We're joined now by public health expert Dr. Howard Foreman, Yale Professor of Radiology and Public Health. We also have Yahoo Finance's Anjali Khemlani here with us now. So, Doctor, I want to start on the news that the United States is lagging behind when it comes to finding those mutations and strains of coronavirus. I'm wondering how much that impacts the United States' ability amid our push to really increase vaccinations to really fight this pandemic here at home.
Yeah, look, this is a problem that has existed since February. I mean, in February, we didn't have enough test kits. We didn't know that we already had widespread community infection in New York and in Connecticut, Massachusetts, and so on. And then eventually we got our test kits. And now in some ways, we're in the same position when it comes to genotyping. We're genotyping at a rate that's probably around 15% of what the UK does. And even that is up substantially over the last few weeks. We're just not good at this historically. And we need to get good at it if we're going to stay ahead of this or even catch up to this. We need to know what variants are in what locations. We need to learn more about the variants, how they're responding to vaccines, and we're going to be able to have to manage this proactively as opposed to reactively.
Speaking of those variants, we're already talking about booster shots to help protect us against those, but we can't even figure out the initial supply. I know that the administration has talked about expanding doses to the pharmacies, and largely it seems like we're relying on the 2 initial authorized vaccines from Pfizer and Moderna right now, with J&J possibly on the way. But with that in mind, we look at the efficacy results of these, and there's already debate among the general public about which vaccine is better. better. So can you lay that out for us? Does J&J's lower efficacy rate hold any water?
Yeah, look, it's unfortunate that we've had 3 vaccine trials come through, 2 of which the FDA has reviewed, 1 of which we've only been able to review via press release, and Novavax as well, only by press release. But when you look at them, there's so many differences between them that it is unfair to say that Johnson & Johnson has lower efficacy compared to Moderna or Pfizer. There are so many reasons why that's the case. We're basically we're saying how good is J&J's protection against infection at day number 28 and comparing it to Moderna at day number 56. It's just not a fair comparison. We're also looking at different populations. J&J looked at populations that included those that have been widely infected with the UK variant, South African variant, and probably the Brazil variant. And the Pfizer and Moderna were probably too early to have a significant number of those variants. We've got to do a apples to apples comparison of these trials. And this is one of the problems with the United States right now is we rely an awful lot on the private sector to do things. This is the type of thing, doing a comparative trial, that really requires coordination from the federal government, preferably from the NIH or CDC or both.
I want to ask about something that we see a lot of folks doing already, and we now have some more comments from Dr. Fauci, which is around double masking and how this might be a critical move really to help fight against this virus, at least as you've been inoculated and you have yet to be inoculated against coronavirus. I'm wondering what your thoughts are if we really now need to just everyone be double masking as a matter of course in order to prevent the spread.
I think anything that reduces our ability to spread to others is going to be helpful. So remember, the masking argument is much more about me spreading to you than about protecting myself with the masks, although it's probably in both directions. You know, there's a lot of arguments about what 2 masks mean. If I'm wearing N95 surrounded by a general surgical mask, that's very different than if I'm wearing 2 cloth masks. But anything that you're doing that is going to be protecting your ability to either spray or aerosolize your own air to others, I think is doing a little bit of help at a time that we don't have enough information. And I think we continue, even 1 year into this, to need to be humble. Humility is our friend. We need to acknowledge that we don't know all the answers, but if we try to do sensible approaches, we're at least on the right track to reducing hospitalizations and deaths.
Dr. Furman, I want to ask you a little bit about the going back to the vaccine supply for a second, because I know that there's a lot of discussion around places holding back some of their supply for second doses, not being able to trust the government rollout. Meanwhile, we just got results out of AstraZeneca saying that a 3-month gap resulted in still positive protection. So is there something to be said about that? Should sites not be concerned about holding reserve for second doses?
Yeah, so I'll say the simplest thing to me is any dose that's being held in a refrigerator for more than a couple of days with the hope of giving it to somebody a week from now is denying somebody or even the population protection and presumably saving lives. I mean, we should get it in arms now to save lives. Now, I personally think the best evidence we have right now is that we give the second dose as soon as possible, but there are arguments that could be made that if you stretched it a week, there's going to be no harm from that. The AstraZeneca trial that we just talked about might even suggest it even gets better by delaying it a little bit of time, but we don't have evidence from Moderna and Pfizer. So let's just put that aside for a moment. But the low-hanging fruit that we do have says if somebody has been previously infected with coronavirus, they might only need 1 shot. We have some evidence about that already. That might be one way to expand the supply. Another is to say, get them into the arms now. And if you have to cancel any type of shots, don't cancel the second shots, but cancel the first shots. Now, that's going to disrupt state and local distribution plans, but far better to cancel shots a week from now than to be holding back shots this week when we know we're going to be getting increasing supplies over the next few weeks. So I'm in favor of getting as many shots in arms as you feasibly can, as quickly as you can.
All right, Dr. Howard Foreman, Yale Professor of Radiology and Public Health, Yahoo Finance's Anjali Khemlani. Thank you both for joining us for this very important conversation about this ongoing pandemic.
Thank you both. Take care.
And coming up, we've got some big tech earnings coming up after the bell. We're going to be giving you a preview next. Welcome back to Yahoo Finance Live. Checking market action right now. All three major indices are in the green. The Dow, the leader right now, up over 1 0.8 percentage point as we see the markets rallying today. The second trading session of rallies after we had seen those markets selling off last week. As you can see there, financials is the leader today, up about 2 7/10 percentage point. As we look at the laggards, real estate is lagging right now, up. It is in the green, up about 0.5 percentage point. Now, investors will be paying attention as Amazon and Google report after the bell today. So we have Emily Bowersock-Hill, founding partner of Bowersock Capital at Sanctuary Wealth. Emily, thanks so much for joining us today. So let's start there with what you're anticipating from these earnings. We have seen other tech companies doing well throughout this earnings season. What are you anticipating?
You know, I would expect something similar to what we saw with Microsoft and Apple earnings. Both of them had blowout earnings, but the market reaction was relatively muted. And I think that's because people expectations were high, and these both companies have appreciated so substantially in the past year that there just wasn't as much upside in either name. I would expect something similar with Google and Amazon. I think they'll have fantastic earnings. And, I think the one exception could be with Google. Google now reports earnings in 3 different segments. And if Google Cloud actually ends up with margins that are less negative than the market expects, I think you could see a big bump in price.
Google. Alphabet right now is in the green, up about 1.5%. I want to ask about those expectations that you were just mentioning. As we've long been discussing, 2020 really pulled forward a lot of growth for a lot of these companies. I'm wondering if you think that they can really maintain that throughout 2021. And if they don't, how do you think investors are going to react?
I do think that there is a bubble forming in parts of the market, and those parts of the market are all beneficiaries of this pandemic. So tech names, anything related to automation, AI, online retail. And so I don't see much significant upside potential. This doesn't mean, I think one of the things we're seeing is that there's such a massive amount of liquidity in the economy due to both fiscal and monetary stimulus that, we could continue to see appreciation for years. We could see this bull market continue for years. But I definitely see that there is more upside potential in the value side of the market and in international and emerging markets.
So if we have a bubble forming, does it pop in 2021, or do you think it keeps on inflating for a little bit?
Frankly, as I said, I think that this could go on for a very extended period. And if you look at the money supply and the increase in the deficit in this country, the liquidity is truly unprecedented. We have never seen a year like this. And I think that money is seeking returns. And there are no returns to be had in low risk assets like money market funds or bonds. And so the cash really has nowhere to go other than into higher risk assets like stocks. And then I think the second factor we've seen has to do with the increase in retail investor activity. It used to be, in terms of equity volumes, that at least before pre-pandemic, equity volumes were made up about 14 to 15% by retail investors. That now exceeds 20%. So I do think that retail investors in general and an entire generation of traders learned a very interesting lesson in the last bear market. It was extremely short, and the Fed stepped in to turn it into a major opportunity. So there's a lot of cash on the sidelines waiting to jump in any sort of correction. So no, I don't think that the bubble popping is imminent by any stretch.
All right, Emily Bowersock-Hill, founding partner of Bowersock Capital at Sanctuary Wealth. Thanks so much for joining us.
Thank you.
And some quick breaking news right now. Mayor Pete Buttigieg has been confirmed as the Secretary of Transportation, sailing through his Senate confirmation hearings, becoming the first openly gay member of a presidential cabinet. Well, that's all for us now. We have Time for Change coming up next. We'll be hearing from the NAACP President and CEO, Derek Johnson.
Welcome to A Time for Change. I'm Jen Rogers here with Sabeel Marcellus and Kristen Myers. Black History Month has been a national celebration since 1976, when Gerald Ford became the first U.S. president to officially recognize it.
It's a time to recognize the history, struggles, and progress of Black Americans. As we consider strides that still need to be made, it's a time to recognize and celebrate Black excellence.
Now, the NAACP has been doing that all day, every day, for more than a century. And today, the prestigious NAACP Spirit Award nominations are out. And I sat down with President and CEO Derek Johnson to ask whether this year, after the turmoil of 2020, if those awards were more important than ever.
It absolutely have taken on a special significance. It's an opportunity for us to not only celebrate the art and entertainments that derives from our community, but it's also a recognition that we need to really drill down on more people using their platform for social justice. As we pursue a better future that can only happen if all of us use the tools available to empower people to be engaged, because 2020 did show that if we're not engaged, there can be some consequences that none of us would like to see.
So then, speaking more broadly, because we now have the start of Black History Month, do you think a month like this is needed now more than ever, given all of the events that happened in 2020?
Well, for some of us, Black history is all 365 days of the year. For others, it's an opportunity to learn and appreciate the contributions that African Americans have made to society. We have a history in this country that have a very unfortunate blind side where it is not inclusive of the contributions that we have made. And it also allowed for a level of white supremacy to exist, which is a fallacy. And so this month is a stopping point for some to begin to recognize the sacrifices made, the contributions that were given, and the opportunities looking forward. For the NAACP, we recognize that every day is Black History moment for us to make, to celebrate, and to share.
Now, when we think about Black History Month, and when I think about the NAACP Image Awards, I think a lot about Black excellence. And I'm curious to know what the markers are for you when we're not going to need hashtags like Black excellence anymore, not because Black excellence doesn't exist, but because it is so normalized, so entrenched in our society that it is not necessary to really call it out as such.
Well, I taught at undergrad at Professor at Tougaloo College, my alma mater, and every semester I would bring in 5 Harvard law students. In this particular year, there was a law student who had gone to undergrad at Hampton. One of her colleagues asked her, why do we need HBCUs if we want everybody to be equal? And she gave the perfect point here. She said, when she was on the campus of Hampton, all she had to do was worry about succeeding, going to class, and enjoying that experience. But while she was on the campus of Harvard Law School, she always felt like she had to defend and to justify her existence. That's when success exists, is when we can have that Hampton or that HBCU moment in society, where all we have to worry about is pursuit of our vocations, our careers, and to be excellent, and not have to defend or justify our position.
Now, we have a new administration. We have this Democratic trifecta, at least for the next 2 years. What bold plans need to be enacted, to really have measurable impact on Black lives in America?
Well, we came out early with this administration to talk about the need to have someone exclusively focused on racial equity. If we are unwilling to address the barriers that exist and identify opportunities for the future, we will continue to be on this treadmill of racial inequality, a caste system. We need to blow up the caste system and open up an opportunity for true diversity looking towards 2030 and not constantly trying to revisit 1950.
So there's obviously a huge role that the private sector is going to have to play in that. It can't all just be done by the federal government. As you see it, what role do businesses have in being part of the solution instead of being part of the problem?
Well, they have to reflect their customer base. They have to ensure that decision makers are at the table at all levels, whether it's on the board, in the C-suite, in middle management, in management. That it is that a business imperative as this nation continue to evolve in their demographics, as the globe have already evolved quickly. For the business community, you cannot truly open up new markets and maximize profits if you have huge blind spots around race and race inequities. And as we turn the corner, we must remove the structural barriers. We have a student loan debt crisis that's going to cause harm to our economy. It is economic stimulus if we figure out how to address that crisis so more individuals have money to put into the stream. That's a stimulus. We have too many barriers in place when it comes to housing and housing stock based on antiquated practices of redlining or disinvestment. We need to invest in targeted community with place-based strategies so home values can go up and individuals can participate in the greatest wealth generator in this country, and that's home ownership. We need to ensure that corporate barriers that have been put in place are removed. There's one thing to have mentors in the corporate setting. There's another thing to have sponsors. We need more individuals with tools and skills to get sponsors and be able to oversee portfolios with profit and loss sheets so that we can grow the pipeline of executives. They exist. They just need sponsors within the corporate setting to move them along the way. And if that happens, it can bring much shareholder value.
I'm wondering if you think we need more awards as well to award Black Americans in fields like science and health and mathematics and engineering outside of the entertainment and media space.
Well, over 40 years ago, we established the AXO program to honor and celebrate 9th through 12th graders through a set of academic awards in the sciences, in the STEMs, 32 categories, because we also recognize that those young, talented critical thinkers were being underdeveloped and underappreciated, so we wanted to create a space for them. At the end of the day, it's less about awards and more about outcomes. We need outcomes that best reflect society and the needs to create holistic communities and a more productive economic system in this global economy.
I'm wondering when you would consider the work of the NAACP to be finished, or when would you consider that you've worked yourself into obsolescence?
When race is no longer a consideration for individual decisions, when individuals recognize the caste system that has been created for not only decades, but centuries in this country must be abolished once and for all, when my children and your children are able to exist on equal footing without the soft or hard barriers that's put in front of them, when individuals who are born in zip codes are able to realize the same quality of existence as anyone else in this country. Those are the things that we need to be fighting for, that one's zip codes, one ethnic background, one's race, one's gender is no longer a barrier to an individual being able to contribute all of their gifts and talents. And their gifts and talents are being developed through the systems that we put in place.
Do you think that we'll get there anytime soon, where the NAACP is no longer needed?
We will continue on this struggle until we get the freedom. And freedom is not about bondage with change. Freedom is the bondages that the limitations of structures put in front of our communities because of our race.
And that was NAACP President Derek Johnson. As we mentioned, the NAACP Image Award nominations are out. They've been coming out over the last couple of minutes. I wanted to mention one, Beyonce, Outstanding Female Artist. She also got a nomination for her song Black Parade, that receiving a nomination for Outstanding Soul and R&B Song. And coming up after the break, Sabeel and Jen will be chatting with Mahisha Dellinger, CEO and founder of the hair care brand Curls.
Welcome back to A Time for Change. Real talk. Natural black hair can be a hassle to manage without the right hair care product. Seriously. Now, our next guest, Mahisha Dellinger, left a marketing job she had at Intel to focus 100% on developing a natural hair care brand called Curls. Inking a deal with Target transformed it into a multi-million-dollar business.
Sabine, she has also helped other women launch their own small businesses and cross the $1 million threshold. But if you want her help, be prepared for some straight talk.
Megan, we have a responsibility, you and I. I'm gonna be harder on you because you are another black woman who is going to be judged on a higher scale and given less opportunity just because you're black. So go out and be the best you can be and show the world different.
And joining us now is Mahisha Dellinger. Now, you're the CEO and founder of Curls. Women, roughly only 2% of women-owned businesses will actually ever reach that $1 million in revenue threshold. What are three things that are holding women back, and how did you avoid those pitfalls?
Absolutely correct. It is really sad that that is the way that the environment we're in today, but the main challenges I see in our community for Black female-based businesses, lack of resources, lack of information, and lack of access to the right people, to the right seats at the right table, to be able to start their business off with even just supplemental funding, which I couldn't get to start my business. We are definitely at a disadvantage, and entrepreneurs overall are also at a disadvantage. Think about the statistic that 80% will fail by year 5. So if you already have that statistic standing against you, and then you're coming in as a woman of color, then you have even a double whammy. So what I did to kind of get past those struggles and challenges is, number one, I did get a mentor. But to get past the financial hardship, I had to start small. I used my personal savings, and every bonus I got, I put back into launching the business. I did not have the luxury of getting a small business loan, despite having exceptional personal credit. So I understand the challenge, and I know that it's a real challenge. So we have to become really creative and think outside of the box to find ways to finance your company. And maybe that's doing a GoFundMe for those in local communities. But we have to find ways to make it happen. And I think one of the biggest pieces that will take women of color over the top is to have that grit to get it done.
And in 2002, when you launched your business, Curls, there weren't that many natural hair care products at major retailer stores on their shelves. Now, then and now, many women fight their natural hair, straighten it by using sometimes damaging chemicals. Now, do you think that that's just a cosmetic choice, women choosing to take their curly hair and make it straight? Or is there more to it? Is there something deeper having to do with hair politics and the pressure to fit into office corporate culture?
I do think it's a little of everything for those who have issues with their self-esteem, because we understand the European standard of beauty is in our face. We can't escape it. So the straight flowy locks that you see all over TV and in media, and then also the men that like and clamor to those women, really can impact a young woman's self-esteem if you have the kinkier textured hair. So I think it's a little bit of the esteem, but also feeling the need to assimilate in corporate America. And some industries don't accept natural hair. Think of someone like in your position, reporters. People can't just go in and change a norm. It's hard to actually come in and rock your afro, and feel like you're going to be received and respected as much as your colleague with the straight tresses. It's unfortunate. It is unbelievable. And I believe it is just, for me, not relatable to say that I have to look like Becky to be received and respected in my job that I do phenomenally well. What do they have to do with one another? They shouldn't have anything to do with it. My performance in my job should be solely based on my output, not my kinks.
Oh, I want to keep talking about hair, and I almost want to grab Kristen and make her come talk about hair too. But I want to go back actually to that clip that we had from the show that you were doing on OWN, the Mind Your Business. And you're tough. And studies actually do show that women overall are hard bosses and women can be tough on each other. But in that clip, you were talking about why you were going to be tough on her because of her being a Black woman. Why do you need to be even tougher, do you think?
Well, you didn't see what happened before that. She is not a very nice person. She really did her partner really dirty and took money that she didn't pay back. And it destroyed her partner's credit. So I was totally livid with her because she's already in a position as a Black woman that she's going to expect to do things below bar. Her partner, by the way, was Asian American. So I wanted her to step aside because in that moment she was crying because I really came down harder than what you saw just now. She was crying. I pulled her aside to tell her why I was being that way with her. I wanted her to stop that behavior that's going to continue to cast a light on her as what people think we are. Stop it, control it, change the narrative, help be a positive story. So that moment I was shifting back from being hard, because I was actually much harder, and telling her why. And the reality is that we are going to be judged on a higher scale. We're going to be expected to perform 10 times higher and better than our colleagues just to be considered equal. So get that in your mind and excel, and don't tarnish our reputation as Black women. Please stop. Now, she has a reputation. She was on Bad Girls Club, so, go figure. But I wanted to mentor her to be and do better. Mm-hmm. And it's just a harsh reality. And what we have to do as women of color is take the lemons that we were dealt and make the best tasting lemonade money can buy. That's what I did. I came from the same environment that she came from growing up, but it's all about how you stick and move and change and redirect your life. And I want her to be on that path. And that's what I was trying to get through to her, to change your behavior. And I don't want her to be a typical Black angry woman who's irresponsible.
Talking about change, has anything changed fundamentally in the business world for you and people you talk with this year since the murder of George Floyd? I mean, we've had tons of people on here talking about what they're doing. Has anything actually changed?
Has anything changed? I would say that what has changed is that we're seeing more of it on media, all over social media and otherwise. I think that there are a lot of people that are proclaiming to be for the rights and civil rights of others are doing it just to check a box and to be a part of the movement, and just to not for purpose of intention, but really for press. I don't believe that everyone that I've dealt with that have approached me after this happened is really legit and they're really caring about it. So I don't think let's put it this way, the people that really cared and the companies that really cared before this year, before 2020, were doing things prior. They had initiatives in place prior, not jumping on the bandwagon now. Like I got a call from the Housewives of Dallas. Never have they ever, the Real Housewives of Dallas, had a Black woman on their show. Then when Black Lives Matter became big last year, guess what they called? Every Black friend in my community, including me, to potentially be on the show. Did they cast us? No, because the media kind of got quiet with it. So I see that, a lot of that with corporations doing it while it's cachet to do so. We're in season right now.
Well, we'll definitely have to continue the conversation. We definitely can't leave it at that. But for today, we'll have to leave it as is. Mahisha Dellinger, founder and CEO of Curls, thanks so much.
Thank you.
And coming up, do we still need to talk about Black History Month? We'll discuss that next.
Welcome back to A Time for Change. We've just heard from NAACP President Derek Johnson and Curl CEO and founder Mahisha Dellinger. So let's talk a little bit more about some of those conversations. Now, Sabeel, you decided to toss us off to the break with a hell of a question, which is, do we even still need Black History Month anymore? And I think based on both of those conversations, the resounding answer is absolutely 100% yes. We heard Mahisha talking about how difficult it was for her to really achieve any kind of success, and also even just getting started as a Black founder and a Black entrepreneur. And it made me think a little bit about what Derek Johnson was saying in our conversation, where he said, you know what, we need more than mentors. We actually need sponsors in the Black community to help turn around and lift up every single Black person behind you and elevate them to higher positions, whether that's helping them start their business or helping them rise in the ranks at a company or a business. But I'm curious to know your guys' thoughts as we think about Black excellence and we think about Black History Month. Sabeel, I'll kick it over to you first.
Absolutely. When it comes to the question of should we be talking about Black History Month, should we celebrate Black History Month? And Derek Johnson pretty much answered that in that interview with you, Kristen, where he said, for some Americans, it's Black History Month 365 days a year. And for other Americans, it's just 30 days, just 1 month. And what that question gets to is the fact that for Black Americans, when it comes to the history, the struggle, the advances, and all that celebration, it's pretty much all year round. And it's not just in the month of February. The month of February is really pretty much about acknowledging that, yes, there is excellence happening in the Black community and the feeling that sometimes those achievements can be overlooked. What do you think, Jen?
I mean, I think part of it is that when you go back to the top of the show, how we said 1976 was when the first US president had recognized it. And so we've been celebrating Black History Month, and what's changed? I mean, that's also what I was asking Manisha, like, what's changed? I think people want to actually have accountability this time. And when Derek was talking about looking forward, like, let's look to 2030 instead of looking to 1950 as well. Like, sometimes when we say history, it makes it seem that it was a long time ago. And to Sabeel's point, it's happening right now. And so trying to figure out how to bring all of that in, whether it's in schools, whether it's in companies, it's not just to look back at some black and white pictures, it's trying to figure out where we're all going together. And so not about getting rid of Black History Month, but how do we make it effective? Because obviously, if we've been doing this since 1976, maybe we need to figure out what we have been doing wrong to still be here and having this exact same conversation.
That's such a good point, because if we were to think about this as a business case study, right, we would say that these processes have been highly inefficient and that we're not getting the return on the investment that we should. The NAACP has been around for 112 years. 112, think about that. And as you heard Derek Johnson say, he doesn't think the NAACP, sadly, is going anywhere anytime soon, that organization is still going to be needed. But we are definitely going to continue these conversations, trying to move the needle amongst the three of us as much as we can with all of these conversations. Thank you all for watching our show. We'll be back next week in our next installment of Time for Change.
Hi, everyone, and welcome to Yahoo Finance Live for this Tuesday, February 2nd. I'm Alexis Christoforous. We have got major stock indexes in all-out rally mode right now, thanks in large part to strong earnings, which continue to support this market. The Dow Jones Industrial Average now up more than 550 points, right on the doorstep of 31,000 again. The S&P 500 up about 64, and we have the Nasdaq Composite rallying 230 points as tech outperforms the rest of the market today. Earnings so far have been very good, beating analysts' estimates. Of the 189 companies on the S&P 500 index that have reported as of late yesterday, 81% have beaten expectations. And still to come, we're going to hear from some more big companies, including Google's Alphabet, Amazon, and Chipotle. They are all out after today's closing bell, and as you can see, they are rallying into those reports. And for the fifth straight trading day, we've got stocks at the center of the social media frenzy, led by GameStop, doing the opposite of the Dow Industrials. We've got shares of GameStop tumbling here, that wiping out the gains from the past week, although the video game company up about 500% for the year. We've also got AMC, BlackBerry, headphone maker Koss, and Bed Bath & Beyond all lower right now. Also want to note silver is retreating after that Reddit-fueled surge that we saw yesterday. Jared Blickery has his eye on some other stocks that are moving today. And Jared, we're turning an eye to those travel-related stocks, which I guess are getting a boost on some encouraging vaccine news.
Yeah, so we got an interesting statistic, a very powerful header across today that got a lot of attention, and that is that the number of COVID vaccinations, people getting at least one in the U.S., has surpassed the number of COVID cases here. So there's other vaccine news as well coming out, but also the $1.9 trillion stimulus that is advancing. The House has finally set in motion the procedures to make that a potential reality. Would take 51 votes, which theoretically are possible here. But let's take a look at some of these names, and we'll sort by performance. Some of the better ones: Travel Zoo in the upper left, that's up 8%. Hyatt, Hilton, and then Live Nation, each up more than 4%. Wynn, right there with them, Booking 4%. So lots of movement in this space, and also looking at the gambling space. These destinations like Las Vegas Sands, that's up 6%. Even DraftKings, which is not a destination, that is up 9%. But I'll show you a sector that's not moving right now, and that is the movie sector. We see Disney and Comcast with their theaters, and those big companies are up, but AMC may be dragging down the entire industry. You look over the last 2 days, this is one of those Reddit trades, and it is down 43% here. So we're keeping an eye on this, but for now, travel names looking good, Alexis.
All right, want to get back to earnings and talk a little Alibaba, because it looks like their cloud computing division turned their first profit ever.
Yeah, and there's lots of focus on this because of Jack Ma, and there was precious little guidance, actually. I was reading through the earnings call, and they just went through major pains to, I guess, assure everybody that they were in the good spot. But you take a look at what Baba's done over the last month, and here we go. It's been trading sideways, basically, for the second half of January. So a lot of the fears over what the regulatory response from China was going to be have abated. You can see it's clawed back a lot of those losses from December. And then I also want to add in general that the Chinese government, which had been tightening, the PBOC had enacted some tightening measures in the prior weeks, is easing. So that's kind of producing a tailwind for a lot of these stocks here. You can see over the 2 days this week, a lot of green on the screen there.
And speaking of green, lots of green for some of the stocks that are going to be out with earnings later today. We've got Google's Alphabet and Amazon. I know the bar has been raised pretty high. What are the expectations there?
That's right. For Alphabet, and this is Bloomberg Intelligence is a summary here. They're saying that growth in their cloud segment that could be boosted by a faster migration of on-premise workloads to the cloud, and that would be companies that have basically been trying to adjust for the work from home situation. And then you have also travel and hospitality spending pulled back on ad spending in second quarter and the third quarter. That's coming back, and they're saying that they may see an acceleration in paid clicks, with consumers spending more time on some of their products such as core search, Maps, and YouTube. The monetization path for YouTube still has a long ramp, and Maps is just in its infancy. And you can see Alphabet here up 5.4% over the last 2 days, and it is at a record high, I believe, today. It has had several of those recently. Now, with Amazon, we are looking at a slightly different situation here. We are seeing here some notes by Bloomberg Intelligence. They're looking for revenue to gain 37% in the fourth quarter, aided by 50% growth in worldwide holiday party third-party sales and a 60% gain in Prime Day sales. That is now in the quarter that they are reporting here.
And of course, it's all about the outlook, right? What are they going to say about the next quarter? And that will determine where the stock goes. All right, it is day 2 of that surge we're seeing in biotechs. And again, this is something being driven by those Reddit investors, I guess is what we're calling them now.
Yeah, the Redditors. You look at the map here. This is the intraday on the Wi-Fi interactive heat map. Lots of dark red. You know, GameStop is down 53%. A lot of trading halts. You look over the past 5 days. Today's price action almost looks kind of muted here, but it is continuing the break of this trend line that we were tracking from yesterday. Draw that in a little straighter. But in general, the Redditors and the Wall Street bet trade have changed, and they've kind of morphed, and we call it rotation from day to day. And we're seeing some money in biotech, and we were on this beat yesterday. This is not a biotech stock. This is NTM bust time. It's up 75% over the last 5 days. But here's a biotech stock, very small. Artelo Biosciences up 21%. And also looking at Vine. Vine is up 14%. So not the mammoth gains that we've seen recently by some of the other stocks like GameStop, but a rotation nonetheless, Alexis.
All right, the rotation is on. Jared, thank you. Let's stay with the markets now and bring in Brian Levitt, Invesco's global markets strategist. Brian, good to see you as always. There's been talk for the past few weeks now, right, that valuations are too high. There's too much froth in this market. What do you make of the action that we're seeing this week?
Yeah, I think that whole concept of valuations being too high or too much froth in the market, investors should really think of their horizon. I mean, valuations are not timing tools. And I think that what you're finding is that in many ways, stock market looks overvalued until you get an economic and earnings recovery. That tends to happen after recessions. And so we're reporting a good earnings season. And so as an economic recovery unfolds, valuations start to look a bit better. With regards to some of these names, the Reddit names, look, the reality is these are, companies that are 10, 20, 30 billion in market cap compared to a U.S. market capitalization of $50 trillion. So it's a small component of it. It makes for great headlines. It's certainly been fascinating to watch, but I think investors should be cautious about conflating that to mean that the entire market is frothy.
Do you think, though, that we are primed for a pullback? A lot of the market strategists I've been talking to have been predicting a sizable pullback, somewhere in the 8 to 10% range in Q1. Do you think that we're still in for that?
Well, you just got, 4%? So you got half of that. I mean, there's always the likelihood of a pullback. You have to ask what drives it. It's usually policy uncertainty. It usually doesn't emerge out of nowhere. And so I don't think we're going to have significant policy uncertainty here, specifically on particularly on the monetary side, as well as likely on the fiscal side. So what could drive that is perhaps greater concern around new variants of COVID strains. I mean, it could be something that we're not even thinking about, but it's always possible. And the reality is you had a lot of the names trading above their 200-day moving average. That tends to be a perhaps correction zone, but very rarely consistent with a market top. So the important thing is, even if you get some type of pullback here, our larger narrative is that would be a pullback in what's likely to be a longer-term advance for markets.
Brian, what are you hearing from your clients right now? Is their appetite for risk growing here as we move into the year? I mean, earnings have been looking pretty good, and so have the outlooks.
Yeah, there tends to be a lot of skepticism, and I think that there's been skepticism in these markets for years coming out of the global financial crisis, and so I think a lot of investors really did not want to be back in from '08 through 2013, 2014, and beyond. We called it a very unloved bull market. We saw that a lot of investors bailed over $1 trillion into money market strategies last March. A lot of concern then about the election, and I think now concern that these markets have just gotten too frothy and there's parts of the market that investors don't understand. The reality is that tends to be a good contrarian indicator. I mean, by the time investors love markets and are euphoric about markets, that tends to be the end of the market cycle. So I would suggest, based on the conversations I'm having, that we are not there yet, and we're a long ways away from being there.
From being at the top of a bull market, you mean?
Yeah, we're a long ways away from being euphoric. Investors are still very skeptical.
So what area of the market are you showing a little love to right now?
I personally think it's a recovery trade. And so what that means to me is you want to own stocks over bonds and credit over treasuries. Within stocks, you want to be more exposed to the cyclical parts of the market. And dare we say the more value-oriented parts of the market. That doesn't mean that we go and we sell our growth stocks. I think this is a value and growth type of environment. You want to be more small and mid-cap, and you want to look outside the United States, in particular the emerging markets. So, if you're asking within the United States, it's cyclical names, and it's likely to be cyclical names through this recovery phase of the cycle.
When you look at what the phenomenon we saw with GameStop and those other heavily shorted stocks in the past week, and how social media and Reddit drove those euphoric gains, do you think that more regulation is the answer? And if so, what form should it take, Brian?
Yeah, I don't know precisely what form it'll take. I suspect the regulators will be looking at this closely, but I also think, as is often the case, the private sector will get ahead of it beforehand. And by that, I mean the hedge funds or any entity that has short positions will do a far better job of trying to, not make as clear what that position looks like, or more importantly, use things like AI or natural language processing to better understand what is going on within the chat rooms and to better understand what the retail folks are doing with their money. So we may see some regulation, but I suspect by the time you get there, the private sector will be far ahead of it.
All right. And lastly, outside of U.S. equities, where are you seeing opportunities? Because I'll tell you what, the international markets came out of the gate gangbusters for the beginning of 2021, especially when you look at what's happening in the Asian markets and the China market in particular.
Yeah, and that is a good story, and that should be a story that persists going forward. I mean, you find these cycles of U.S. versus international outperformance tend to last a long time. We just came through a very long one with U.S. outperformance, and the dollar got quite strong, and valuations in the United States became extended relative to valuations outside the United States. So the emerging markets come into this on a price to sales basis, still one standard deviation cheap to the United States. And so there's opportunity. You just need a catalyst. And that catalyst comes in the form of improving economic activity. China, certainly, and other parts of Asia have come out of this COVID environment better than the developed world. You have their currencies that were largely undervalued. And now you have a dollar, which of course in recent days has gotten a little bit of a bid, but a dollar that is likely to either be stable to somewhat weaker as a result of the amount of stimulus coming into the United States.
All right. Yeah, certainly the weak dollar helping the emerging markets there. Brian Levitt, global market strategist at Invesco. Always good to see you.
You too. Good to see you.
Coming up, NFL Hall of Famer Terrell Davis joins us to talk about his sports drink company and a little football, of course. We're back after this. Welcome back. Two-time Super Bowl champ and NFL Hall of Famer Terrell Davis is making waves off the gridiron as an entrepreneur. The former Denver Broncos running back and MVP is the co-founder of the sports drink company Defy. And in an interview you will only see here on Yahoo Finance, I am pleased to welcome to the show Mr. TD himself, along with Defy's CEO and co-founder Megan Bushell. Welcome to you both. Terrell, I'm going to start with you. Defy, for those who don't know, is a CBD infused sports drink company designed for athletes. Why did you decide to start this company?
Well, I decided to start it because, as a NFL player, I realized that there's a need for post NFL care in terms of the way we feel in our bodies. And so, many years ago, I guess when we tried CBD, I realized the effects of CBD and what it had on my body and how it allowed me to work out, repeatedly. It decreased the inflammation in my body. So the idea was born that if it can help me improve my quality of life, then there's thousands of people out there who can benefit from it. So we decided to launch Defy. And Defy is a performance brand. We're a performance brand. We do have CBD products, obviously, but we also have non-CBD products that are for people who have not obviously tried CBD. So that's why I started, and it's been 2 years now, and we're going strong and we're expanding. So we're pretty excited about that.
Yeah. Speaking of expanding, Meg, I know you guys are launching your Defy Water, your first high-performance alkaline water. Why do that? And also, what retailers might we find this product in?
Well, it was a natural extension of our brand. And to TD's point, it's our first non-CBD based product, but it's still in that performance lane. So it's an alkaline 9.5 water. It's really superior hydration. And we're rolling out nationally as we speak. We'll be available in retailers beginning this April, especially in the Sprouts national chain. So you'll be able to find us in over 30 states nationwide. In the next 3 months, we're adding 1,000 new stores to our accounts. So we're very excited right now. And from a timing standpoint, it makes perfect sense. Especially we're very excited to be able to announce this during Black History Month, because a portion of the proceeds of this water will be going back to support the Black, women, and veteran communities.
Yeah, I wanted to talk a little bit about the whole paying it forward thing. And Terrell, how did you guys choose? I mean, there's so many charities out there, right? How did you choose these particular charities, if you can share with us where some of these proceeds are going to be going?
Yeah, I mean, Megan talked about it. Our company is uniquely formed in terms of we have Black ownership, it's woman owned, and it's veteran owned. And so the idea was to give back to those communities. And for us, it's still about Black, about health, and the charities that I will be supporting all deal with Black health, and whether that's mental health, whether that's dealing with chronic illnesses and, things from a physical standpoint, and really getting things where in the Black community, a lot of times we don't go to the doctor unless there is a problem. And so it's all about, doing things that are, before you get something, right? Preventive measures to make sure that people are aware that there's help for whatever ailment they may be dealing with. So that's why we got behind that cause, I guess.
And Meg, who is the customer here? I mean, I know it's sort of, geared toward the athlete, but there are only so many professional athletes out there. So who is sort of your core customer?
Sure. Well, the beauty about water is that everyone needs water. Everyone can drink water. Of course, with an alkaline water, it's a 9.5 pH, so it's superior hydration. So it's still for that person who is perhaps dehydrated, that person who needs to increase their hydration and level out their pH for health and inflammation reasons. So there's really a broad audience. I mean, every age can obviously drink water. So we're very excited to be able to kind of expand our portfolio to be able to serve more people.
Interesting time to be launching this during a global pandemic, guys. Terrell, what are your thoughts as you see the NFL season unfold, and of course the big event coming up on Sunday with the Super Bowl? How do you feel the league has handled these challenging COVID times?
I think they've done a really good job. Obviously, they're the only league that I know of that hadn't canceled a game since they started. They've played every single game on their calendar and their schedule. And obviously, if they're able to complete this last game of the season, they would have that unique honor of saying that. So big ups to the NFL. They've gone through the protocol, the players and the coaches and, the members of the team. They've all done what they were supposed to do in order to make this happen. So everybody made sacrifices to make sure that this game is finally played. But I mean, the game is the game. And I think it goes to mention that there's been all the frontline workers who have played a huge role in the NFL getting to where it is. And that's why the NFL has given 7,500 tickets to frontline workers free of charge by, that is, to go attend the Super Bowl. So they recognize that without them, they wouldn't have gotten to this point.
You know, Terrell, you're one of the best running backs of all time. You've had a phenomenal career, but you were the 196th pick back in 1995. You know, what's that saying? It's not where you start, it's where you finish. What's the lesson there, do you think, for entrepreneurs?
Yeah, I think that's it. I mean, you can't, don't worry about where you come from, where you start. It's all about where you're going. And sometimes, we might start off differently. You might have a 10-yard head start. You might be behind somebody 10 yards, but to me, it doesn't really matter. If you're in the game and you're competing, it's all about that focus on that goal and doing everything you can to get to that point. And listen, Tom Brady was 199, so I didn't quite have the distinction of being drafted lower than Tom Brady, but Tom has been phenomenal. He's playing in his 10th Super Bowl, and so if you need motivation, man, look at that dude for a guy who just is defying the odds on everything.
Right. He was another late round pick, and he hasn't done too badly. So speaking of the Super Bowl, I want to get both of your predictions. And Terrell, who are you calling here for the Super Bowl? What's your pick, and what about the score?
I can tell you I don't feel good about my prediction, but I'm going to give it to you anyway. I'm going Chiefs 38, Bucks 36. I think it'll be one of those high-scoring games, and I think the Chiefs make one more play than the Bucks to win it. But I have the right to change my pick as the week progresses, so I have the right to change my pick. But that's my
okay.
pick.
Those big rules will be just for you, Terrell. And what about you, Meg?
Well, I never like to bet against Tom Brady, but as a Kansas native, I have to go with my hometown Chiefs.
Oh, absolutely, absolutely. What are you guys most looking forward to, Terrell, for 2021? I mean, as we start to come out of this pandemic, hopefully the vaccine rolls out. What's the one thing you really want to get back to doing?
For just traveling and seeing people, just doing the normal stuff. I think we've taken for granted just simple things like just going to a restaurant and sitting down and eating, being around family a lot. I miss those things. From a company standpoint, we're looking to grow. We're looking to do really big things in 2021, expanding across the country, and hopefully being in thousands of doors. And so we are really stoked and excited about the future of Defy.
All right, we're going to leave it there. Terrell Davis and Megan Bushell, thanks so much for being with us, and best of luck with the alkaline water.
Thank you. Appreciate it.
All right,
Thank you,
still
Alexis.
to come, we're going to sit down with the CEO of the LiDAR company, Innoviz, about their upcoming Wall Street debut. The Israeli LiDAR startup Innoviz is going public next month in a $1.4 billion reverse merger with Collective Growth Corp. LiDAR sensors, of course, allow autonomous vehicles to see and safely navigate their surroundings. Joining me now from Israel is Innoviz's CEO, Omer Khalaf. Omer, good to see you. There is a lot of money pouring into the AV space, rather. Innoviz was going to be the fourth LiDAR company to go public in just the past year via SPAC. What do you plan to do with the money you raised from that sale next month?
Yeah, thank you. Innoviz is now moving into the next stage of going into high volume production. So that's a big part of our need to expedite our process. We have been working on a BMW program to go public in a couple of years. And we are now engaging into additional several programs, which requires us to grow. We already have our first product available, Innoviz One, which you actually can see on the screen, which is a very high performance product. But we are now also launching our next generation product, which is even higher performance and at a lower cost. We want to penetrate a bigger market.
Yeah, talk to me a little bit about these new use cases for LiDAR. I know you're planning things in different areas, campuses, I think school campuses, agriculture, even outer space. What are some of the other use cases?
Yeah, I think the opportunities for LiDARs are, beyond imagination. Every time I meet with different companies, I learn about new uses for 3D sensing that are, fairly small and automotive grade. But to say we are very focused on automotive, this is really, our advantage to be part of a serious production like BMW. There are many cases like level 3 and level 4 and shuttle businesses that we are involved with. But as you said earlier, that there are really endless opportunities for such a sensor.
You mentioned BMW. In addition to that automaker, do you have other supplier agreements in place?
Yeah, sure. So we are currently working with 4 tier ones that we work with in order to adopt the technology in different programs. There are several car makers that we are now in advanced technology programs that we are involved with. I expect to be able to announce a few in the coming months.
All right, that's exciting stuff. We also saw at CES this year, which of course was all virtual, that Intel's Mobileye announced they want to start making LiDAR sensors in-house. What does that mean for the overall space? And I'm thinking specifically in terms of cost, because we know these LiDAR sensors can be quite costly. Will having somebody with that much sort of manpower, deep pockets like an Intel, help to drive the overall cost lower?
So I think everybody realizes that the auto space is now taken over by technology. You see Tesla, everybody's asking about their valuation, but their valuation is not based on being an auto company. It's actually a technology company. You see companies like Intel and Apple realizing the opportunity in this market, and I'm not surprised to see that they are trying to get a bigger portion out of it. Intel is talking about the LiDAR that is going to be available in 2025. There is today no other solution but Innoviz that is going to be available in the market in the coming months, that will be able to be already embedded in serious production. And by the time of 2025, our product will be even at a lower size and lower cost and higher performance. So I think that eventually the wide adoption of Innoviz One technology would be well accepted by many.
Omer, when you look at the timeline, and I know this is a tough question and you're asked it a lot, but I'm going to ask it anyway. How close are we, do you think, to seeing passenger self-driving cars on the road? Because we keep hearing about this technology. When might we actually have it?
Yeah, so the biggest program today that is in development for serious production for passenger car is the one of BMW. It's a program that has been running in the last few years. We've been working with them for that long, and you can see on the screen our actual product running with our computer vision. The target is to become available in 2022. and you will start to see some cars in the coming, in the very near future.
Okay, we'll leave it. We'll leave it there with the very near future. We're looking forward to it. And finally, a lot of people are talking about the space being crowded, the LiDAR space. Do you think that consolidation is inevitable? Might we start seeing these companies combine, or maybe some automakers buy up the LiDAR sensor companies?
So consolidation already started. So 2 years ago, there were about 80 companies. I'm not surprised to see 4 at this time. At some point, there will be only about 2 or 3. And in the auto space, there is always consolidation. I think the companies that are today public are quite different than each other, although it looks the same from the outside. It looks very noisy and very difficult to understand. But really, there are big differentiation between these companies. We are very much focused on the consumer vehicles with a product that probably has the highest fit in this area. Others are working on kind of last mile deliveries, drones, robotics. I think that Innoviz today is the leader in passenger cars, and I think there is room for several.
All right, Omer Khalaf, CEO of Innoviz. So we look forward to talking to you next month when you become a public company. Thank you.
Thank you very much. Appreciate it.
Coming up, why international stocks could outperform the U.S. market this year. Welcome back. We are learning just how bad 2020 was for the big oil companies and the challenges they're facing this year. Jared Blickery is back with a look at the day in oil, plus some big earnings reports. They're very telling, Jared, from ExxonMobil and BP.
Yeah, and we'll get to those earnings in a second here. Let's check out crude oil, which just settled at $54.76 per barrel. That is an 11-month high. You'd have to go all the way back to January of last year to see those prices, and you can see up 9% over the trailing year. Haven't seen that. So really, not only, we've been talking about this trading range that it is now broken out of. That was from about $52 to $54. So this is very positive. And by the way, we do have the Joint Technical Committee for OPEC Plus meeting today. We're going to have more meetings throughout the week. These are on a monthly basis. So we're going to want to be paying attention to those as well. Now, here's our energy heat map, and we can see Exxon is up almost 2%. Now, this is despite posting the biggest annual loss, the first annual loss in 4 decades, and also posting a record $19.3 billion write-down. That is a lot of money, but it was well telegraphed. And why is the stock up right now? Probably because they are maintaining their dividend. In fact, they are going out of their way to make it clear that the $3.7 billion per quarter that they pay out to investors will be there no matter what, even if crude prices drop to $45 a barrel. They say they would simply slash CapEx, and that's what they've been doing. Now, we can also take a look at the BP. They just posted a really terrible earnings report. There's really no other way to go about it here. And let me just get the stock up, because the foreign majors, they were quick to cut their dividend and then they reinstated them, but they haven't been defending them as aggressively as the U.S. majors like Exxon and Chevron. You see over the last year, BP is still down 42%. When you take a look at it compared to Exxon down about 26%, but just a little bit better off here. So watching the energy sector here, and OPEC Plus really going to be the focus this week.
All right, that's for sure. Thanks a lot, Jared. All right, it looks like international markets could be outperforming U.S. markets this year. At least that's what my next guest believes. So far this year, we have developing markets and also EM markets, emerging markets, outperforming the S&P 500. And joining me now is Eva Ados. She is COO of ER Shares. Eva, good to see you. Tell us why you're so bullish on international stocks this year.
Well, there are many reasons to support this. First of all, we saw in 2020, China was the only economy to outperform and actually grow in terms of GDP by 2.3% when the rest of the world economy shrunk. The IMF and others are projecting that this is going to be the case going forward. China is going to lead the way in 2021 and the future. And in addition to that, if you look at relative valuations, those are much more attractive when it comes to international. We see PE ratios in the US at 23 and PE ratios in international at 16. This is a 50% differential. It's an appreciable difference. And in addition to that, we're also seeing great growth potential with projections of earnings growth of 32% for international, whereas for US, the same is 23%. So you have much higher projections for earnings growth when it comes to international and much lower valuations. In addition to that, of course, we have a strong case for the US dollar to continue to slide. That will mean that investors investing overseas will benefit from the US dollar sliding and the appreciation from that, and the appreciation for the stock itself going up. And the year-to-date data also support this. Year-to-date, the Hang Seng Index is up 6%. Our global entrepreneurs are up 16%. Our international entrepreneurs are up 10%. And the S&P 500 is close to zero.
So, you certainly ticked off a lot of reasons why we could see the international markets outperform U.S. this year. But underneath that basket, or in that basket of international stocks, where do you see the most opportunity for growth, especially when you look at it against a backdrop of a weak dollar?
Certainly. So by far, the biggest opportunities are going to be in Asia, and there's a big focus in China. China's economy is growing at a very fast pace, especially when it comes to technology. We see great innovations there. For example, a great example is EHang. This is an AAV, autonomous aerial vehicle. I know your previous guest spoke about electric vehicles. Those are actually giant autonomous drones, and they can used for air passenger transportation, but also air logistics. They're already working with the Chinese government on experimental air zones, and the European government, including Paris, that they just signed a deal for experimental tests, and with DHL too for smart drone delivery. So there are great innovations coming from China. Their valuations are very low compared to the US, and I think this is a great opportunity for people to look into.
You know, there are not a lot of opportunities for yield in the U.S. fixed income market, and there's no real reason to believe that's going to change anytime soon. So what are the dividend opportunities overseas as you see them right now, Eva?
when it comes to dividend, we're very focused, especially in the U.S. We think there's, as you said, there's a strong case for increased spending with the new administration. This is going to push interest rates higher. As a result, many people are concerned that this is going to be detrimental to the stock market. We respectfully disagree. We think this is actually going to be beneficial for the stock market. It's going to encourage a further shift out of fixed income into equities. If you look at the period between 2003 and 2007, the Fed increased interest rates 18 times, and during the same period, the stock market went up 50%. So you can have interest rates going lower and the stock market appreciating. So we think that with an increased spending and interest rates going higher, this is going to put back monetary policy to the table and be beneficial to the stock market, since money will move out of bonds and fixed income into other asset classes, including the stock market.
And then finally, what is your expectation for U.S. markets this year? Do you believe we will still end the year higher? And if so, which sectors within U.S. equities do you like right now?
Definitely, clean energy will be a big thing. We know that the new administration is going to invest $2 trillion in clean energy within the next 4 years. For example, Enphase is an entrepreneurial company that we really like when it comes to clean energy. We also think that there is, as we said before, a move to international, so people should be looking at it. And there are great opportunities still in technology and healthcare. Small cap healthcare, the genomic stocks are disrupting their healthcare industry. This is going to continue. There are great opportunities, even though some categories might be fully priced. We see, especially in small caps and healthcare, great opportunities going forward.
All right, we're going to leave it there. Eva Otto, COO of ER Shares. Thank you. Lots of actionable stuff for investors to take away there. Good to see you.
Good to see you. Thank you.
Next up, Impossible Foods cuts prices at the grocery store. The company's president, Dennis Woodside, joins us next. Welcome back to Yahoo Finance Live. The Impossible Burger just got a little more affordable at your local supermarket. For the first time, the plant-based food maker Impossible Foods is cutting prices of its faux meat at the grocery store by 20%. Joining me now is the president of Impossible Foods, Dennis Woodside. Dennis, always good to see you. So why the price cuts at the retail level and why now?
Yeah, well, our goal is to replace all animals as a part of the food system. It's very harmful for the environment. There are much better options with plant-based meats. But to do that, we need to have a product that tastes great, is nutritious, and is affordable. And this is the first step for us getting down to the price of commodity ground beef. That's the goal, compete with the cow. And to do that, we have to price like the cow. And we've grown so fast over the last year, our production's up like 9 times in the last 2 years, that we've been able to get economies of scale out of the business and efficiencies in our production footprint. And we're just passing those along to the consumer with this 20% price reduction.
So I understand you want to sort of find parity with regular beef prices out there. With this latest price cut, how do Impossible Foods products stack up against those in terms of price?
So with the latest price cut, we're around the price of organic beef, right? But there's a whole nother layer of demand at even lower price points. So commodity 80-20 ground beef, that's what many people purchase. And so we're going to have to go below even the current pricing at some point. As we scale up, as demand grows, we'll reinvest that efficiency back into our pricing. And people are moving to Impossible from animals. 80% of our consumers are switching from pork or beef or chicken or fish. They're not switching from other plant-based products. So we have to compete with the cow.
I know that in addition to this price cut, you had cut prices for food distributors twice prior to this. I'm curious what that business is like for you, also the restaurant business, given the pandemic and all of the dining related closures that we've been seeing. How has demand been for you?
Yeah, it's really a tale of two worlds. There are the small operators that are working, they have 1 or 2 restaurants. That's been very hardly hit, very, very hard hit, especially those that don't have drive-through or digital delivery platforms. And then you have the larger operators like a Starbucks or White Castle or Burger King. Our business skews towards those larger operators. They've done quite well and probably have gained share in the pandemic. People are still eating. They're just getting their food delivered or they're going through the drive-through. And we've been able to launch new products in that environment. We launched the Impossible Breakfast Sandwich in June with Starbucks, and that's done incredibly well. Even in a day part breakfast that you wouldn't think would do that well with people not commuting as much as they did pre-COVID.
That is interesting. And I know that there's just been explosive growth over there at Impossible Foods. You were in about 150 retail stores just a year ago, and now you're in 17,000. What's 2021 going to bring? Or will you be in any more retailers, any more partnerships like the one you have with Starbucks that you can share with us?
Yeah, well, I would just say on 2020, we didn't expect to move as fast into retail as we did. When the pandemic hit, we focused all of our effort on retail. In the beginning of last year, 97% of our business was in food service. So we were fortunate that we've built up this great brand and reputation among consumers who got used to us at a Burger King or White Castle or their local restaurant. And so when we went into retail, the consumers showed up. And that enabled us to get into places like Trader Joe's and Kroger and Safeway and Walmart very fast, much faster than most products. For 2021, it's about continued expansion, getting the right price on shelf, getting more products on shelf. So there's a whole set of new products that are coming down the pipeline. We've shared our pork product in a small scale last year. We can expect that will scale up this year. There's many other products in the pipeline that we're excited about. So it's going to be more about new products, more products, as well as international markets that we see coming online this year.
You think we're going to see fake fish anytime soon? Is that in the plans at Impossible Foods?
Well, it's interesting that science at the molecular level, the way we do it, has not really been applied to engineering the taste of food. There's no reason we can't engineer the taste of any food over time. And our product is going to get better year after year. We're going to improve things like saturated fat, sodium content, so that it's actually healthier for you. So it needs to get cheaper, needs to get healthier, but the cow's not going to get any cheaper and the cow's not going to get any healthier. So we think we have a very large opportunity ahead of us. About 1 trillion pounds of meat are consumed every year. It's a crazy big market. And, we're talking right now in the US, plant-based meat is less than 1% of all consumption. So very long way for this to run. It's a little like the early days of electric cars. Everybody's going to go to one degree or another towards plant-based in the future. Everybody's going to have an option on their menu. And we're really just starting.
Definitely a long runway there. The competition in your space is certainly growing, but now you have the emergence of cell-based food makers out there, especially coming from Asia. How does that change things, or how does that change the addressable market for you?
Well, it doesn't right now. It doesn't really have any impact, and because most consumers they're all moving from animal products, right? That we're not competing so much with other plant-based manufacturers as much as we're competing with the cow. And so you have to match the cow on taste and nutrition and so forth. We keep an eye on lab-based meat. Right now, it hasn't really made much of an impact, but it's certainly something that we follow.
All right, Dennis Woodside, president of Impossible Foods. Lots of exciting stuff going on at your company, as always. Thanks for being with us.
Thank you.
Coming up, Uber breaks into the alcohol delivery business. We've got the details coming up. Uber is making an even bigger bet on delivery. The ride-hailing giant buying the alcohol delivery company Drizzly for $1.1 billion in stock and cash. Our tech editor Dan Howley is here now with those details. I guess this is just an extension of things for Uber Eats.
Yeah, essentially. And look, Drizzly has had a great year. I myself may use the app every Friday and Saturday and Sunday. But it does do incredibly well, the service. You basically are able to launch it and then reach out to any participating liquor stores in your area and have anything from hard seltzer to actual alcohol, bottles, wine, even some convenience stores are on there that also sell alcohol. So it does do an incredibly well service. And, according to them, They've had profitability and gross bookings of more than 300% growth year over year. So they're doing something right here. For Uber, they're just doubling down, as you said, on the Eats platform. And that really has been the driver for them throughout the pandemic, is people haven't been getting into cabs because where are you going? On top of that, there was the fear at the outset of the pandemic of getting into a car with someone because of the virus. So I think this is really the smart move for them. I reached out to Drizzly to see what would change. Right now, essentially what you do is you pay a small fee. The business gets to charge what they want for the alcohol, and then you can leave a driver tip. The question then is, though, will that drive prices up for Drizzly? Because Uber Eats, like Grubhub, takes a lot out of deliveries because of the fees that they have. So you might see those prices go up. They said that everything's going to stay the same for Drizzly. So you'll still be able to use the same Drizzly app, but you'll also be able to order alcohol through Uber Eats now.
All right. I know you're a happy man about that. We're not going to ask how frequently you use the app, but I want to get to Uber Eats and their Super Bowl ad. They're going to be on the big game with a little help from the guys at Wayne's World. Check out this teaser.
We just wanted to say that we'll see you soon for the game, which for legal reasons cannot be named.
We'll see you on the big bowl.
The gigantic bowl.
Totally legal.
Yeah, completely legal.
All right, good teaser.
Yeah, I feel good about it.
I'm so excited. Dana Carvey, Mike Myers, they look really good, don't they?
They look incredible. Look, they also did, Uber Eats did Jean-Luc Picard of Star Trek against Luke Skywalker of Star Wars. So I really like what they're doing here with these commercials. And, it's not going to be a big year for Super Bowl commercials. They're not going to have the Budweiser Clydesdale, and I'm not going to cry about a dog from a Budweiser commercial. But, I'll take Wayne's World.
I'll take Wayne's World for sure. Also, DoorDash, Uber Eats' rival, also has a Super Bowl ad. So there will be some cool ads to look at. By the way, $5 million for a 30-second spot, but I think Uber can handle it, right?
Yeah, at this point, yeah.
All right. Dan Howley, go enjoy Drizzly. Thanks a lot. Coming up next here on Yahoo Finance Live, we'll be speaking with the CEO of Delta Airlines, Ed Bastian. He's going to be joining my colleague Shauna Smith and Adam Shapiro. Another quick check of the markets shows things still up and away. All three major indexes higher. We've got the Dow up by nearly 2%, a gain there of 585. The Nasdaq up more than 240, and the S&P 500 gaining 66. We're back with more Yahoo Finance Live right after this.
The Reddit craze is taking a break as GameStop and AMC come crashing down. GameStop is off nearly 60%, while AMC is off more than 40%. We're going to break down exactly what's going on. Airline stocks among the winners today as the sector struggles to recover from the pandemic. Delta Airlines CEO Ed Bastian joins us in an exclusive interview later on this hour on some of the biggest lessons that he's learned from the downturn and also whether another round of government funding will be needed this spring. And it's a big afternoon for earnings. We've got Amazon, Google, and Chipotle all set to report after the bell. We're going to bring you those numbers as soon as they cross the wires. The broader market rally is holding up as we head into the final hour of trading. Welcome back to Yahoo Finance Live. I'm Shauna Smith.
And I'm Adam Shapiro. And as Shauna said, the markets are rising, but some stocks are taking a hit. For instance, GameStop down more than 25%. Let's bring in Jared Blickery for what's going on here, because now it's below $100 a share.
Yes, it is. And we've seen this play out over the last few days when you really see what's going on here. I'm just loading the Wi-Fi Interactive, having a little bit of a connectivity issue, but I will be there in a second. We have GameStop off as much as 2/3, at 67% today. And now we can go back to the Wi-Fi Interactive and see the price action for today. On an intraday basis, now the swings haven't been as big as previous days, but this is 67% down. This is 100% up here. We are just drifting now towards session lows, but kind of a different story for some of the other stocks in this basket here that we update from day to day. And we have a few new names, and these are mainly in the biotech arena. We have Artello Biosciences. That's still up 22%, although well off of its highs. And this move got started yesterday in biotech, has now spread to some of these names. Artello wasn't the biggest recipient of that yesterday, but really getting juiced today. Vine is another one. Vine Therapeutics, that's up 5%. And I just want to add it in general on the Robinhood front. We just learned that they took in $3 billion of emergency capital last week, and that was actually the margin call amount. And in a letter today, it seems to be an open letter, and I'm just going through it now. The Robinhood CEO is saying it's time for real-time settlement. And this is a big issue. This is something that the industry has known for a long time. Robinhood got caught with the pants down because they ignored it when they were trying to juice their profits, and they organized their business model around this premise that they didn't have to worry about these kinds of things. Well, it caught them, and now they're pushing for change. I think they're just talking their book, but this is something that's probably going to happen down the pike, that will probably get real-time settlement in securities instead of having to wait for these 2 days and then avoid similar situations in the future. But you always know that something else crops up, right, guys?
Certainly is. All right, Jared Blickery, thanks so much. We want to continue this discussion. For that, we want to bring in Kevin Nicholson. He's the Chief Investment Officer of Global Fixed Income at Riverfront Investment Group. And Kevin, great to speak with you again. We have to get your reaction, though, to really what we've seen play out over the last several trading days. And today, for the second day in a row, we're seeing pretty big gains. We have the Dow up nearly 600 points. When you take a look at some of the buying action in the market today, do you think some of that worry that we saw initially over the speculative trading, that has worked its way through the market?
I think so. I think that the market is really focused right now on stimulus. The market is reacting to the potential of a bipartisan stimulus package coming out, and you've seen that today with the rotation in the marketplace. You're now seeing cyclicals back leading the way again, like they were a few weeks ago, and you're even seeing tech react strongly as well today. And we believe that, it's going to continue to be strong going forward, especially with the Fed being so accommodative and the potential for fiscal stimulus.
Kevin, I want to turn to some fixed income, and it's good to see you, but we see the 10-year now above 1%. There are some people say it could go higher, maybe 1.5% by year end. That's really not going to be a hurdle, though, for the economy or for investors, is it?
No, I don't think so. I see the 10-year being kind of range bound right now. Our thesis was that the 10-year was going to finish the year around 130. You have a yield differential with the 30-year Treasury between 10s and 30s right now that is will lead us to believe that the 10-year has about 20 more basis points to go. But as far as the market is concerned, the market will continue to rally, I believe, going forward, as long as we don't get the 10-year having runaway yields. I think the closer you get to 2%, that is going to start to weigh on equity markets a bit.
Kevin, I know it's not in your near-term forecast, but when you talk about 2%, I mean, is this something that we could potentially be talking about in 12 to 18 months, or is this something you don't even see on the horizon anytime soon?
No, I mean, I think that we could see 2% in 12 to 18 months, definitely. I think that the big thing here is whether or not you're going to get inflation and whether or not inflation will be sustained. Obviously, we know just from the calculation that you get in CPI and PCE that we will see a bump in inflation in March and April of this year. But the big thing is, will it be sustained? And if it is sustained, then, I definitely believe that we will see yields much higher.
One of the things you point investors towards are the energy sector and financials. And I just want to point out that today energy is up about 1.5%, but year over year, it's down 26%. Why should an investor consider the energy stocks?
Well, I mean, a lot of people are considering energy stocks right now because they think that once the economy reopens, that you're going to have a lot more demand. Right now, people are sitting in their homes and they're not driving nearly as much. So you don't have that demand for, gasoline and things of that nature, or oil, that you would normally have. So I think that that's why people are looking at it right now. For us, we've been underweight energy for probably the last year or so. But it's definitely has made a move up, and it's something that, you have to start to consider, especially as the vaccines come on board. And as more and more people get vaccinated, you definitely will consider the potential for the demand for oil to go higher and for energy to do better.
Hey, Kevin, what about tech? Because we heard from Facebook and Apple last week. We've got Google and Amazon after the bell today. A lot of these names were the leaders when you look back at 2020, a lot of them continuing to lead here in 2021. Any reason to still buy some of these large cap tech names?
Well, I mean, I think that what we've seen through this pandemic is that tech itself has been very durable, and that tech will lead the way. And I think that that's going to be is going to continue, because a lot of what we're seeing is that people are no longer going to be forced to go to the office. There's going to be more working from home. And so I think that that is going to play in the hands of tech companies. And for us, we continue to like tech in our portfolios. We think that you have to have a blend between a healthy blend between tech and some cyclicality in your portfolio, such as industrials and a little bit of materials, because we think that the infrastructure play will be huge going forward, as that is something that you could probably get bipartisan agreement on down the road.
Kevin, what about stay-at-home stocks? We've got a guest coming up in the next 30 minutes who's going to say, be careful. Some of them are starting to show a little bit of technical exhaustion. Would you agree with that? Have you had a chance to even review that?
Yeah, I mean, some of them are getting exhausted. Well, in especially those that will that stood in the way of your traditional platforms that will eventually reopen, and that will allow their customer base back into their facilities. I can't speak on specific companies for compliance issues, but you can only imagine where I'm headed with that. But so you have some companies that have benefited from being able to exercise from home, and they may come under some pressure going forward.
All right, Kevin Nicholson, Co-Chief Investment Officer of Global Fixed Income at Riverfront Investment Group. Always great to talk to you. Thanks for taking the time to join us today. We want to get to the latest down in D.C. Congressional Democrats are moving ahead with President Biden's $1.9 trillion COVID relief package. We want to bring in Jessica Smith for the latest on that. And Jess, where do things stand at this point?
Well, this afternoon, the House and Senate will both vote to move forward on that budget resolution, which is the first step in the reconciliation process, which would allow Congress to pass legislation, President Biden's $1.9 trillion plan, with just a simple majority vote. So they wouldn't need Republicans on this. We know that President Biden did meet with Senate Democrats and Treasury Secretary Yellen today, and he told them that the Republican plan that a group of 10 Republicans presented to him last night, that $600 billion plan, he told the Democratic senators that plan was way too small. The White House and those Republican senators have said that their meeting was productive, that they would continue to engage, but the White House has made it clear their price tag is still $1.9 trillion. The White House press secretary was asked about this just in the last hour or so, and she was asked whether or not this week's jobs report could influence their price tag, what they're looking for in a package. Here's what she had to say.
If there was a jobs report that there were 10 million jobs created, that would be great news. I don't suspect that will be what the outcome of the jobs numbers will be. So no, it will not change. As we saw from the CBO numbers, which projected, I should say, that there would be growth this year. That's obviously positive, but we're digging out of a massive hole. And the challenge right now is that it's going to take years to return to the pace of economic growth that the country needs to be at.
Now, Republicans, of course, are pushing back on the nearly $2 trillion plan, saying that the next coronavirus relief bill needs to be much more targeted. Even Senator Joe Manchin, a very moderate Democrat, a key vote in this 50-50 Congress, said today that while he will vote for the budget resolution today, going forward, he wants to make sure the focus is more targeted. Adam and Shauna.
Jess, what about the minimum wage? Where do we stand on the debate over increasing the federal minimum wage?
Right, because that is something that President Biden wants to see in this next relief package, but that's going to be tricky. We did hear from Senator Manchin today saying that he does not support the $15 minimum wage hike. He said he would like to see something like $11 in his state. And then we also heard from Senator Susan Collins of Maine, a moderate Republican, who said she doesn't support the $15 hike either. She would rather see something lower. She said she could support a minimum wage increase, but not $15 and not in the COVID relief package. She wants to do that separately. So Democrats are definitely going to face a lot of hurdles if they want to get that done, especially if you're trying to do it in the relief package.
All right, Jessica Smith with the latest from DC. Thanks as always. Coming up next here on Yahoo Finance Live, we'll discuss the latest on the pandemic. We're back with that in just 2 minutes.
About 45 minutes to the closing bell. The indexes are all up more than 1.5% on this day that we learned the Biden administration will begin shipping vaccines for COVID-19 directly to pharmacies next week, but there's much more going on. Let's bring in Angelique Amlani, the Yahoo Finance correspondent who covers COVID for us. Angelique.
Thanks, Adam. Yep, we know that the vaccines are coming out, but in the background, we also have the issue of testing. We know that at-home testing is also supposed to hit retailers, with Illumina Health being the first to receive that authorization from the FDA. But as it stands right now, it could be a slower rollout than expected. I spoke to the CEO of Illumina Health, Dr. Sean Parsons, and here's what he had to say.
So the short answer to that is yes, product is being shipped both to QIAGEN for the QIAreach products, which we're very proud to be in partnership with QIAGEN around, and also the home COVID. So the first batches of those are now on their way to the US. You're quite right. We did receive support from the National Institutes of Health, the RADx program, for which we're very grateful. That helped us scale our production capabilities here in Australia. And on the back of that, we achieved an emergency use authorization for our home COVID test, which is now in manufacture here in Australia. This money that we've had was announced yesterday by the White House COVID Task Force, is really about supporting a US manufacturing base in addition to the Australian one to make COVID-19 home tests for America. To help America respond to this COVID-19 pandemic, and to have sovereign capability to manufacture these products for future pandemics as they might arise, for flu or for future strains of COVID.
Yeah, tell us about that and the ramp up of the manufacturing here in the U.S. So as of right now, I know you were able to expand in Australia, adding 500 jobs. Here in the U.S., looking at starting a new plant all on its own. Where is it that you're looking to do so? And is it going to be a start from scratch, or are you looking to build out an existing facility?
Existing facility, fitting out as swiftly as we can. We'll be looking to fill it with the automated equipment to scale our production there and ramp as quickly as possible. We will be looking to employ north of 1,200 people in Americans to manufacture this world-class technology for America to respond to the pandemic. So we're very pleased to be able to work with the US government, the Department of Defense, to be able to execute a big program like this to bring this capability to the US.
And have you identified a location, or are there parts of the US you're specifically looking at?
We're in late stage discussions around that. There'll be an announcement shortly. I don't think there'll be too many surprises of the kinds of areas that we're looking where there is the skilled workforce necessary to execute a big program such as this. So no definitive location to announce just yet, but there'll be further to talk about that in the near future.
Let's talk about the at-home test. We're looking at initially announcements of 20 million in the U.S. by mid-year and 100,000 per day, but that has obviously increased with the new infusion from the federal government of $230 million. What is the goal right now for the initial ramp up? Because I know you're looking at about 19 million a month. Is that correct?
By the end of the year, 19 million a month coming out of the American facility is the target. That's what the funding program is all about. That's obviously in addition to the production capability coming out of our Australian facility. So, combined, they will be north of 25 million tests a month.
And where are we looking to get these tests? Are we already shipping them out to homes per se? Are you waiting to get them through the retail locations? I know initially targeting CVS and Walgreens. Are you looking at online retailers like Amazon as well? Where are we going?
So we've been forced to prioritize around military and essential services. We have been inundated with expressions of interest for the product, which has been terrific from our perspective, although it's created some allocation challenges for us to ensure that we make fair decisions about where the product is going. We have looked to prioritize essential services and military as part of that. The discussions with the major retailers has commenced, and we hope to be able to announce in due course the approach which Illumina will be taking to commercialize the product through those retail channels. We do fully recognize that many Americans would like to be able to use this product in their day-to-day lives We are working as hard as we possibly can to deliver that, and we look forward to talking about that commercialization pathway in coming weeks.
So as you can hear, a lot of focus on retail pharmacies like CVS and Walgreens, and with not just the vaccine, but also with these COVID-19 tests, and yet a limited supply of both to go around. Back to you guys.
Anjali, thank you. Let's keep this discussion going with Dr. Payal Patel, infectious disease physician, joining us now. We want to talk about the importance of all of us to get, in-home testing. But the news today is that the administration also sending vaccines to pharmacies, Walgreens, CVS, Rite Aid, Duane Reade. How important is the commercial pharmacy going to play as we ramp up not only the testing, but inoculations?
I think that's huge. I've been waiting for this moment. There's two parts of the equation as we try to ramp up vaccinations. It's access and it's confidence in the vaccine. And if we can really build upon those two things, I think that would be the biggest part of getting more of the country vaccinated.
So, Dr. Patel, I guess the question then is, how do we go about doing that? That has been something that we've been talking about for months. We need more confidence in the vaccine. Yes, education is one way to do it, but what other programs or what other methods do you think should be deployed at this point?
Yeah, I don't think there's a quick fix. If you think about the healthcare system and some of the disparities that are in healthcare, they've been around not just for years, but for decades. So, we got to think about it that way. That means that we know a lot about what the disparities stem from, and just acknowledging that they're there is really step one. And so the next step is really trying to focus on the communities that we know, even before we do any studies, are often left out. And trying to build confidence in those communities. And I think that there is an active push from different parts of the government as well as hospitals to focus on that area. And then, of course, increasing access just overall. That will really help all sorts of people get better vaccination rates.
But the current model requires everybody to essentially make an appointment. Some of the elderly, some of people in the communities we're watching, at least in New York City, get hit hardest, may not have internet connection or may not even have access to the type of computer so that you can get through the Byzantine registration requirements in a place like New York. Would it make more sense then to just have teams go out and be knocking on doors?
Yeah, and I think actually New York has realized that, as they look at their early numbers of who has gotten the vaccine, I think they are seeing this disparity and are focusing on interventions just like you mentioned.
Dr. Patel, I want to ask you about something that came out from Dr. Fauci, and he was saying that the CDC could potentially recommend double masking. And of course, this is a result of those more contagious strains that we're seeing coming from the UK and Brazil and South Africa. I'm curious just to get your perspective and what you're advising patients to do right now when it comes to masking. Does double masking make sense?
Sure, that's a great question. I think, the biggest thing at the end of the day is, are you wearing a mask and are you wearing it properly, right? As long as you're covering your mouth and your nose, that is the most important thing. And, if I had to choose between everyone wearing double masking or getting vaccination rates up, I would say everyone wearing a single mask properly and getting vaccinated is going to be the most effective strategy to get everyone in a safer place. Now, is there a better, protection from wearing a second mask? The studies are still out, but wearing a mask at all properly is the way to go.
You wear glasses. I wear glasses, so I'm sure you have experienced the glass fog when wearing your mask. Can you help defend me when I get a dirty look on the street outside? Yes, I drop it below my nose. But of course, I'm going to, as I'm passing somebody, put it back up. When you're outside, the below the nose, are you really, I'm more concerned about spreading to other people. Is there a danger? Help me here, because the dirty looks in New York sometimes.
I want to give you a hot tip that I've learned, and that is if you dip your glasses in some water before you put them on, you actually might be able to stop yourself from getting those steamed up and can avoid this issue altogether. And the face shields as well seem to be really helpful. We often wear those in the hospital. And so those are two hot tips to kind of avoid the not being able to see out of your glasses.
I will try all of what you just said. I know about the face shield. It looks too Battlestar Galactica 1980s to me, but thank you very much, Dr. Payal Patel, infectious disease physician. Good to have you here. When we come back, we're going to take a look at news on the move, and then at 3:30, we've got an exclusive interview with Delta CEO Ed Bastian.
We've got just around 30 minutes to go in the trading day. You're looking at gains across the board with markets rallying for the second day in a row. You can see the Dow up 572 points, not too far from the highs of the day. S&P up just around 1.5%. The Nasdaq up just around 1.7%. In terms of some of the outperformance that we're seeing in the market right now, Goldman, Caterpillar, and American Express, those three names are leading the Dow. Sector-wise, all 11 of the S&P sectors are in the green. We have financials, consumer discretionary, and industrials leading the way. Adam?
It's time for news on the move, and 2 FBI agents were killed, 3 others wounded this morning in Sunrise, Florida. The 5 agents, along with Sunrise police officers, were attempting to serve a warrant at 6 a.m. on a defendant who had barricaded himself inside an apartment at an upscale gated community. Police say the shooter is dead. A new law in Oregon decriminalizes possession of small amounts of heroin, methamphetamine, LSD, and other drugs. Instead of being arrested and charged with a crime, users will face a civil citation, a $100 fine, and a health assessment that could lead to addiction counseling. Billionaire Jared Isaacman bought an entire trip aboard a SpaceX rocket to raise $200 million for St. Jude Children's Research Hospital. He's planning to take 3 everyday, regular, normal people on the flight to orbit the globe later this year. Anyone who donates this month to St. Jude is eligible for a drawing to win a seat aboard the space mission. And in an hour, he's going to join us here on Yahoo Finance Live to talk about it.
All right, Adam, well, coming up next here on Yahoo Finance Live, we've got an exclusive interview with Delta CEO Ed Bastian. We're back with that in just 2 minutes.
Welcome back to Yahoo Finance Live, 30 minutes roughly to the closing bell. We want to talk about what's happening with the airlines. And to do that, we invite into the stream Delta Airlines CEO Ed Bastian for an exclusive interview. Ed, it is always good to see you. Thank you for joining us.
It's good to be with you, Adam.
I want to put in perspective, because we know it's been a tough year for all the airlines, but I want to put in perspective in a different way what's happened at Delta. In 2019, you made history when you awarded $1.3 billion in profit sharing to your 90,000 employees. Then 2020 happened. I'm curious, you can't learn how to deal with this in a business school. As a CEO, what are the lessons you've learned that you want the people who will one day replace you in the C-suite? What are the lessons you've learned that you want to share with them?
Well, you're right, Adam. It's been a remarkable year, unfortunately, for a lot of the wrong reasons. We went from our highest highs in 2019. In fact, we distributed $1.6 billion on Valentine's Day in 2020, only to find us a month later where we're down to probably about 5% of our revenue base. I'd say the number one lesson I learned and leaned into was the purpose of values, reflecting on what you do every day, and ensuring that you're living by our rules of the road, the values by which we stand by. At the start of the pandemic, Frank Blake, who's our chairman at Delta, told me that something I already knew, but it was good to be reminded of, that crises don't build character, crises reveal character. And it's a statement I listen to and think about every single day in managing through this. The decisions I take are going to be a reflection on the character and the values of Delta. And I want people to know how well, the job we're doing to protect everyone in that same way.
So when you talk about the values to manage through this crisis, Savi Saith over at Raymond James, after your fourth quarter earnings report last month, said that Delta's cost execution remains impressive. And we should point out, no layoffs. You did have 40,000 of your then 90,000 employees at some point last year taking leaves of absence to help the airline get through this, the unpaid leaves of absence. I'm curious what the airline will look like after the pandemic. It's going to be smaller. Will it be on the global scale it was heading into the pandemic?
It's going to take some time to get back there. I think domestically, we're going to come back first, before international will return. I think international is probably a year away from seeing how that's going to shake up. It's going to be about the virus. It's going to be about the success we have as a world in containing the virus and putting it into a position where it's not inhibiting people's desire and ability to travel. I think, again, it's going to be first and foremost in the U.S. The vaccinations are a key determinant as to how it's going to come back. But over time, and it may take 2 years, it may take 3 years, I see us getting back pretty close to where we were back in 2019. It's going to have a different mix. Might be a little more domestic, a little less international, a little less business, a little more leisure. I don't know. And, by the way, our business always changes. The mix is always, it's a pretty dynamic world we live in. So I think, I like the hand we're holding. I like the cost execution. As you said, our costs are substantially better than what our peers have been able to do. And that's why our cash burn is the best in the industry.
Hey, Ed and Shauna, as we talk about getting to the other side of the virus, we still have a very long road ahead. We heard from American last night talking about that they could potentially have to lay off more workers. We heard that from United last week. I'm curious, just from your perspective, what you think is needed right now, whether or not another round of funding is needed from the government, and if that was presented, whether or not Delta would accept more funding if it was available.
The number one thing we got to do is contain the virus. And I would encourage our government to do everything within their power to commit whatever resources they have to containing the virus. That's the most important thing we need to get our business back. I'm not going to comment on a third round of stimulus. I'm not sure if that's the answer. At Delta, we have not furloughed employees all year. We're not going to furlough employees this year either. So it's not about, for Delta, saving jobs. It's about containing the virus and having people feel safe getting back out into public life.
want to look at what the recovery looks like as far as scheduled for Delta. And I realize there's still some unknowns, but Helene Becker over at Cowen pointed out that, quote, the recovery in demand and bookings has yet to materialize for the industry. I realize January might be a bit of a slow month traditionally, but you've said in past interviews that you expect end of March Delta is cash burn neutral and that revenue starts to pick up. As we get to the halfway point in the first quarter, what do the bookings look like, and are you headed still on that trajectory?
The second quarter is still a long ways away, as you can appreciate, Adam, with the vaccine just starting to roll out. I think when I looked this morning, we've got about 8% of the population of the United States has at least one shot of the vaccination. It's going to be dependent upon that. By the time we get to the spring, March, April, May, into June, I think you're going to find the vaccination starting to build some real critical mass. And when you couple that with what we already know about the numbers of people that have the antibodies that have already been infected with the disease, we easily could see at the start of the summer our country starting to approach an early form of herd immunity. And that's what we need. We need confidence back. We need people feeling safe in travel, and it's going to build. I do think the spring is when we're going to see the bookings start to build in anticipation, and that's why I think we're going to get to that cash break-even level as soon as we're talking about. I know some of my competitors have said I'm optimistic. I'm always happy to be accused of being an optimist. This is a serious business. We're very realistic in terms of how we're thinking about it. But we took our cash burn from $100 million a day in March down to about $12 million a day in the fourth quarter. So with a little help of revenue, not a huge help, I think we can get there. And remember, Delta is still blocking 30% of our seats. So that's another factor for you to think about as to when we eventually decide to unblock the seats. We haven't made that decision yet, but when we do, there's going to be a pretty significant amount of new revenue Delta's going to receive.
And another thing that you need to consider at this point, we heard reports that the CDC is now considering mandatory COVID testing for domestic flights. Some of your peers have been outspoken saying that they don't think it's feasible. I'm curious just to get your thoughts on this.
I don't think it's practical at all for lots of reasons. First of all, we're carrying millions of people as an industry domestically already, safely and reliably, safest form of transportation there is. Secondly, testing resources, while they're growing, are still very precious. It still takes, in many parts of the country, 2, 3, 4 days to get results back from testing. To divert those resources to cover the millions of people that are traveling domestically, I don't think would be a wise trade-off. It would significantly harm the U.S. airline industry and push us back, not just by the way the airlines, travel and hospitality more broadly would take a big hit. So as the government on the one hand is considering whether we need another grant for PSP, I certainly think we should have a do no harm policy and ensure that we at least keep the revenue streams we've got coming in.
And when you call yourself an optimist, the airline is bringing back 400 pilots in anticipation of an upturn this spring. Still planning to do that, correct?
Yes, we have called back 400 of our pilots, which would bring us down to about 1,300 left. And we're looking at our plan over the next 6 to 12 months as to how to get those 1,300 people back to.
Ed, you also started with us talking about character and managing through a crisis like this. And I want to shift to something that you've been involved with at Delta before, some of the terrifically horrible experiences the country witnessed this year regarding race. But you said on MLK Day of this year to your employees, the global reckoning over racial inequity and injustice spurred us to take a deeper look at our own record on diversity, equity, and inclusion. And you've got concrete steps at Delta that you've taken in the hiring process to reduce bias. Can you tell us a little bit more about how that's going and some of the deadlines you've set for the airline?
Well, we're looking across the entire spectrum of our people, both the hiring standards, as you indicate, Adam, what the skills that are required, the qualifications, ensuring that there's no implicit bias in any of those standards. And we've redesigned them, and I've gotten a lot of support from people like Ginny Rometty at IBM, who's done it quite successfully there to learn from. One of the things I've learned this year is that in order to reach the underserved, you've got to give them a hand up and give them the opportunity to, and realize they may not come through the normal channels. One of the reasons we joined 110, which is the organization founded by Ken Frazier from Merck, to create new jobs for Black Americans. So it's starting at the entry level all the way up through the senior most levels of management. We currently have about 7% of our the top 100 people in the company, who are Black. That's not good enough. I expect to double that over the next 3 to 5 years in terms of, on percentage terms, in terms of closing the gap. And then it's a continuing journey to continue to get better.
And we should point out to folk that for 5 years in a row, Delta has ranked among Glassdoor's best places in the United States to work. And this year, you were number 7 on a list of 100 large companies. So congratulations on that. We wish you the best. And a lot of us want to get aboard a plane and go somewhere warm just to get out of where we've been locked down. Ed Bastian, Delta Airlines CEO, always good to see you.
Thank you, Adam. Thank you. Look forward to getting you back out in the sky.
We'll be right back after this.
The Biden administration today announcing direct vaccine shipments to pharmacies. It's expected to start next week. But our next guest is the president of one of the companies that's helping to store Pfizer's vaccine in those ultra cold freezers that we've been talking about. We want to bring in Laura Steiner. She's the president of Horizon Scientific. And Laura, your company plays a key role when we talk about vaccine distribution. I guess first, just tell us about these units that you make and the demand that you've seen for your freezers.
Sure. So Horizon Scientific, we manufacture and distribute medical and scientific grade refrigerators and freezers. And it's not just for the Pfizer vaccine. So the Pfizer vaccine requires a minus 70 Celsius freezer, but we also manufacture freezers for the Moderna vaccine at minus 20 Celsius and the pending vaccines, the AstraZeneca and Johnson & Johnson vaccines that would be stored at plus 5 Celsius.
really curious because we're going to start the national rollout of vaccine via CVS and the different pharmacies, Walgreens, and those are predominantly your clients. So the demand you've had has been 10x over the past year?
It's been a massive increase, a significant increase in demand, and it's across all of our product categories. So not just those ULT freezers, those -80, -70 freezers, but also -20 freezers for anyone preparing to store the Moderna vaccine for long term, but also those 5C refrigerators as well for the short-term storage of Moderna and the Pfizer vaccines.
Laura, it's a tough time to have to ramp up your production that significantly. I mean, a lot of companies are just trying to meet what they were doing before the pandemic. How have you been able to do it?
So as soon as the Warp Speed project was announced, we immediately started planning. So that was last spring. And we immediately started planning our infrastructure improvements and inventory, a spike in our supply chain, and also an investment in our personnel too, so that we could plan. And we're in an excellent spot right now. We have seen that spike as of a few months ago, and we're continuing to support our customers. We communicate with our customers daily to make sure that they're on track and they're getting the equipment they need in the time that they need it.
A lot of us, not just your customers, are counting on the ability to deliver these freezers. But I'm curious, long term, once we're past the national inoculations and vaccinations, what happens to your business? Because the demand won't be as great.
That's a great question. So we do see that the demand right now is at an all-time high, but we don't know how long that will last. So we know that the Biden administration would like to have everybody vaccinated by summer or fall, but it could take longer, and there could be boosters associated as well with the vaccines that would require additional vaccine storage capacity. So we don't see that this would be an immediate decline in the business. It could be a spike that we see for some time to come.
Laura, going off of that, I guess that begs the question then, is the U.S. at this point, doesn't sound like it, but is the U.S. meeting demand for cold storage, or what does that timeline look like?
Are we meeting the demand? So absolutely.
Yeah, more on a nationwide scale. So outside of your company specifically, just in terms of what's available and what's needed today and what's going to be needed in a month from now.
Sure. So I would say, yes, we are meeting that demand, and our products are shipped nationally and internationally. And we've been hitting that demand and meeting the demand, working with our customers daily. So it is an increase in that demand, but we've increased our capacity here to meet that now and going into the future. So we're in good shape, and we did start planning early, and because of that, we're in a good position right now to support that demand.
Laura Steiner, president of Horizon Scientific, thanks so much for taking the time to join us. Coming up next here on Yahoo Finance Live, Wall Street Bets and Reddit, they didn't start the internet message board as stock wars. We're going to talk to Brian Chung, who is here with a little history lesson for all of us. That's next in 2 minutes.
So instead of riding the GameStop roller coaster, perhaps you want to learn more about the history of Wall Street bets and other online messaging boards. Brian Chung is going to school us on that. Brian?
Well, Adam, it seems like everyone's interested in this new phenomenon of Wall Street bets and Reddit, but we have to remember that it wasn't much long ago that we saw something very similar with the advent of the internet around the dot-com bubble. There were many types of message boards, and I'm going to take you down memory lane, things like ragingbull.com, siliconinvestor.com, this website, yahoofinance.com. These were all message boards where people floated investment ideas at the time. Now, consider an example of a company called Zytel. This was a company that a lot of people on siliconinvestor.com and the Motley Fool had tried to pump on the promise that this was a tech company that was going to deliver a cure to the Y2K bug. You remember whether or not computers were going to explode when the calendar turned from 1999 to 2000. Here's an example of one post that was on siliconinvestor.com in 1996. It read, at the end, the people who don't like that, which refers to the people that were trying to pump the stock of Zytel, are A, the shorts, and 2, those who are not long. For those of us who are long, I have a few shares at 19, let the good times roll. Again, this is coming from 1996, but you can see how the hues of this are very similar to what we're seeing in the Wall Street Bets subreddit. Very interesting to see how this is all kind of coming back into vogue almost 20 years later. When we look back at Yahoo Finance message boards, though, we see cautionary tales of the types of misinformation, though, that can come from this. One example being the Whole Foods CEO, John Mackey. He was using a pseudonym at the time on Yahoo Finance message boards, complimenting not only how he personally looked, but also trying to talk down his rival, which was Wild Oats. The FTC and the SEC end up investigating that, but a very cautionary tale that shows just how interestingly history tends to repeat itself. Shauna, Adam?
Well, Brian, I'm curious then to get your take on this, because when we talk about the misinformation and the fraud, like what you were just mentioning there, that begs the question then, what's going to happen as a result of this? And Fed Chair Jay Powell was asked about this last week. He kind of brushed it off, didn't really give an answer, but I know you're closely following Fed is going to look like in the Biden administration, what it's going to look like, what the Treasury Department's going to look like under Janet Yellen. So what do you think, I guess, could potentially happen as a result of this?
Yeah, and obviously we've already heard the news-breaking headlines from the likes of Jay Powell, again, at the Federal Reserve, saying, I don't want to comment on this type of thing. And rightfully so. The Federal Reserve doesn't necessarily have purview over the regulation of information in the securities markets. Instead, that responsibility is going to fall on a name that's probably lesser known to the average person, especially the person that might have been following this story over the past few weeks, and that's Gary Gensler. He's the Biden pick for the top of the Securities and Exchange Commission. He has not been confirmed yet. He does need to go through the Senate confirmation process, but he's someone that formerly headed the CFTC, and he will be undergoing a hearing at some point in the Senate Finance Committee that is likely going to be taking on a strong tenor of what he's going to do at the head of the SEC within the context of what we were seeing in the stock market last week and into this week. That's going to be very much a large question. Is he going to require types of regulatory disclosures from people on Wall Street bets? Is he going to require more disclosure and transparency from the market makers, the high-frequency traders like Citadel that are involved in this, the brokerages themselves? There are so many different types of questions, but I think he is going to be a real fixture when it comes to who is going to be guiding the policy over the next 4 years.
Brian, appreciate the update. You are always welcome to take us down memory lane, but if you ever go back to the 1990s, you are forbidden to remind us of the Macarena. We're going to hit the closing after this. heading to the closing bell, and his Spinal Tap would say these markets go to 11 and much higher today. Let's talk about this with Sam Stovall, Chief Investment Strategist at CFRA, and Jeff Yasteen, Wealth Press Senior Investment Strategist, all joining us right now for the closing bell. Let me start with you, Jeff. You're telling people to buy oil. Why?
I feel like it's still a very under-owned asset. It's gone through this huge down cycle. It wasn't 10 months ago or so that we had negative oil prices for at least a very short time. And as a consequence of all these things going on, it's pushed so much of the supply side basically into bankruptcy on the shale oil producers and those types. And as we move out of the pandemic, and we will move out of it, as time goes on here, it just means that oil demand is going to increase, and there's going to be, something of a bottleneck. And I think that's why we continue to see oil prices move, higher and higher here, despite the fact that the economy continues to sort of lurch along in low gear with lots of stimulus.
And Jeff and Sam, stand by. We want to bring in Jared Blickery quickly. That's hard to say back to back as we head into
My mother's good at it.
And Jared, there's a lots of buying action here today. We've been talking about it for much of the trading day. All 11 of the S&P sectors are in the green. What stands out to you?
Well, I'm looking at Alphabet up to a record high of 2%, and this comes right before its earnings. We're going to get those in just a couple minutes right after the closing bell. So we'll keep an eye on Amazon as well. Amazon's up 1.3%, not at record highs, but could be the breakout if we get a reaction in the right direction. But just remember what happened to Tesla and Apple in weeks prior. The reactions this earnings season, despite the high beats, have not been positive. Well, here's today's sector action. And yes, we will get to those Reddit screens in a second. Financials and industrials, discretionary and communication services, all outperforming up 2 or 1% respectively. And then healthcare and real estate to the downside. Now, also in the travel space today, getting a really nice boost on the reopening and vaccine news. We're seeing Booking up over 3%, Royal Caribbean up 4%. Even the gambling space on that reopening trade looking good today. DraftKings up 8%, Penn National up 6%. But guess what? Movie theaters aren't doing so well. We got AMC down big. Of course, that is a not Yahoo Finance. It is a Wall Street Bets Reddit trade here. AMC down 41%. And here is that closing bell.
And that does it for us today. All three of the major averages in the green, although well off the highs of the day. You're seeing the Dow close up just around 476 points, S&P up just around 1.4%, Nasdaq up 1.5%. All 11 of the S&P sectors are in the green. And some of the standouts here in today's action within the Dow, Goldman Sachs, the top performer, up just around 4.5%, Caterpillar and Dow Inc. rounding out the top three. We want to bring back in our guests. We have Jeff Yasteen. We also have Sam Stovall standing by. Sam, let me just go to you first. Just the buying action that we're seeing today, 2 days in a row now. What do you make of it, and where do you think we're headed this week?
Well, I think that people are basically breathing a sigh of relief that we are not going to be in the midst of a long-term capital management style of liquidity crunch, which drove us down almost 20% back in August of 1998. So I think that investors are saying, now let's go back, focus on the fundamentals, focus on the earnings that Jared just mentioned. Let's go and realize that expected to be off 12.6% in the fourth quarter, now only 5.6% lower, and with each of the quarters seeing upward revisions for 2021.
Jeff, Sam just brought up long-term capital management. Back then, the banks had to bail out the system, not the taxpayer. Fast forward now, we got this thing going on with GameStop and Reddit. I'm curious, you call this a canary in the coal mine. Why?
Well, it mainly goes to the whole thing of how much, let's say, a lack of concern, a lack of worry, sort of a tossing away of fear in the stock market. And, I'm speaking sort of broad ideas here, but, that's how the stock market moves, generally speaking, is in broad sweeps. And one thing that keeps the rallies healthy is when you have a degree of fear in the market. And so when you look at sort of how the activity has moved to this point with Wall Street Bets, and, we can sort of cheer on what happened to short sellers and all that. But at the same time, it shows that there's just a lack of concern, a lack of fear that investors of all kinds can essentially move with impunity. And just, my instinct at times like that is to draw back a bit and say, maybe you shouldn't get so comfortable, because, that's what happens at the end. And I'm not saying we're at the end here, but I'm just saying this is a time to be very careful, because when you're coming up on the end of these things, that's typically when people lose most of their fear. And, you take all your chips and you're pushing them into ever bigger piles for the stocks that you're going after, and it works until it doesn't work. And then you really get a lot of pain.
Sam, how are you looking at the speculative frenzy that we've seen play out over the last week and a half? Is this something that causes you to change your strategy or your outlook at all?
No, it doesn't cause me to change the strategy. Our year-end target is still 4080 on the S&P 500, which is a high single-digit price appreciation. But like Jeff, I'm a bit concerned that we are due for some sort of digestion of gains. When you have two nieces who have never invested before give you a call and say, I want to get in on the action, you can't help but think of Joe Kennedy and Bernard Baruch getting advice from their shoeshine person. Also, seeing advertisements on television for all of these trading systems that one can put on their phones and just start trading away really without looking at the fundamentals. Yes, that is a bit of a concern right now, but I think it's more of bubbles, pockets of bubbles, not the entire market itself being in a bubble.
Jeff, we're going to be getting Google and Amazon earnings any minute now, but I'm curious, you're telling people, big tech, yeah, stay there, but beware some of the stay-at-home plays that they're exhausted. Tell us more about that.
And mainly the idea is there is that, number one, the reason to own them is going to go away as we move through the back end of the pandemic. And secondly, I think that just in terms of valuations, they're just very, very stretched. And I think they're beginning to show that. And I think like these last moves we've seen over the last, 6-8 weeks or so with like, Peloton and Chewy and some of those, they have that look of exhaustion about them, considering the stretched valuations that they have. And really for a lot of the rest of the FANG stocks, with the exception of Google, and let's say Tesla, if we want to throw them in there as well, most of them have been moving sideways since like July of last year. And they don't appear to be able to sustain in advance. Now, maybe the earnings come out, and I could be completely wrong on this. But when these stocks go through this long sort of consolidation period, obviously at the far end of the consolidation, it's going to break up or it's going to break down.
All right, guys, hold on one sec. We have some breaking news. We want to get to Jared Blickery for Amazon earnings. Jared?
Don't say that twice. We got a new CEO at Amazon. The transition is about to begin. Jeff Bezos is going to become executive chair, and Amazon's own Andy Jassy is going to become the next CEO. That is the big news right here. And just checking on the stock price, you can see it is up 2.3%. So the market taking this transition of power pretty well right now. And by the way, the numbers are very good for the fourth quarter. Let's go over those now. We have net sales of $125.5 billion. That is up 44% year over year, and handily beating the estimates of $119.7 billion. Amazon Web Services, those revenues came in at $12.74 billion, and that is just slightly behind or roughly in line with the estimate of $12.77 billion. That is an increase of nearly 10% year over year. And then EPS came in at $14.09 per share. That is a jump from $6.47 1 year ago, and very much higher, actually almost double the estimate, which was $7.34. Operating income coming in very much over expectations, $6.87 billion. Estimate was for $4.5 billion. And fulfillment expenses, those were $18.5 billion, coming in roughly in line with the estimate there. So big news, Jeff Bezos transitioning to executive chair, Andy Jassy becoming the next CEO, and just beating on a lot of records. Oh, I do want to point out, we do have a first quarter forecast here I want to go through. They are seeing net sales of $100 to $106 billion. The estimate was for $95.7 billion. So another nice beat there on a key metric. Guys?
We have another nice beat, too, a multi-billion-dollar beat for Alphabet, Google. Inez Ferre is going to bring us up to speed on their earnings. Inez?
Yeah, that's right. Alphabet's fourth quarter revenue ex-TAC, that's excluding traffic acquisition costs, came in at $46.43 billion. The street was expecting $44.16 billion. Taking a look at the company's fourth quarter earnings per share, $22.30. The estimates were for $15.58. And also looking at Google Cloud revenue, that came in at $3.83 billion. The street had been expecting $3.8 billion. Alphabet's CFO saying our fourth quarter performance with revenues of $56.9 billion, driven by search and YouTube as consumer and business activity recovered from earlier in this year. Very important that this year also, this quarter, it was the first time the company was breaking out its cloud unit, broken out as a separate segment. So you've got now Google Services, that includes the search, ads, Chrome, YouTube, and then Google Cloud. And that cloud revenue beat expectations. And then other bets, and those are the moonshot sort of projects, including Waymo. And analysts had really been expecting that the sum of the parts would be very valuable when valuing the company, so to speak, valuable information.
We want to bring back in our guests, Jeff and Sam. And Sam, let me just go to you first on that news that we got out of Amazon, not specifically talking about the company, because I know you can't talk individual stocks, but when you see a move like this, a name like Jeff Bezos making the transition from CEO to executive chairman, I'm curious just as an investor, how you're viewing this and what this potentially means for a big name like Amazon here going forward.
Well, Jeff Bezos is Amazon. So, the first question one asks is, where will he be in all of this shakeup? But with his being still as an executive in control, maybe not to day-to-day operations, but in terms of overall strategy, I would tend to say that investors will breathe a sigh of relief that his influence will still be very much felt by the company.
Jeff, I want to keep talking about Amazon here because that revenue beat was really spectacular. 125 billion, I think it was. But first quarter, it's above 100 billion is what they're forecasting. This would be one of those stocks when we were talking before the earnings, you were saying, be careful some of the stay at home, but Amazon, it's on fire.
It is. And again, that's why really, if you're going to make a case for, let's say being careful about buying the stock here, and even if it did fall, chances are it seems like it's everyone's safety stock. So really, you talking about a decline of what, 10, 15% probably at most. But still, it's really just a matter of how much of the growth that we're seeing is already baked into the price and already discounted into future expectations. And so, there's just no question the company will continue to outperform. It's a premium stock, and everybody knows it. So it's just a matter of how much is too much to own the shares, and at what point do people turn perhaps somewhat more pessimistic? Again, knowing that a lot of the valuation is already baked in, or a lot of the growth is already baked into the valuation.
Tim, at this point, we've gotten Amazon and Google today. We heard from Facebook last week. We heard from Apple. How are you looking at the tech sector right now? It was a leader last year. Many investors are still favoring it at this point. Are you finding reason to buy into some of these names now?
Well, on some of the names, absolutely. In terms of Apple, Google, Amazon, obviously Amazon is consumer discretionary. But in terms of technology expectations, we have a market weight on technology at this point. Our belief is that it'll probably keep pace with the market, but in the coming year will not be an outperformer. We look to earnings growth for next year, up 13.6% versus 21.3% for the overall market. But obviously, you can look below the surface at certain sub-industries and individual stocks that we think could do relatively well.
We have been paying attention to some big tech stocks, but wanted to let you know that in just a second, we're going to go to Jared Blickery on Chipotle, because Shauna, I think you'll recall it was about 5-6 years ago when they got into trouble. That stock lost a great deal of its value, and today it's trading at $1,525 a share. But in the post market, it is down almost about 1.6%. And I believe that Jared Blickery is standing by for us with the earnings, and he's going to break that down for us in just a second. But Jared, what have you got?
All right. Well, it was a miss on the bottom line. So adjusted EPS coming in at $3.48. Estimate was for higher at $3.72. 1 year ago, it was much lower, $2.86. But comp sales here also missing. That is a key metric. That was up 5.7%, but it did not match the estimates of a little bit higher at 5.9%. Revenue coming in just in line, 1.61 billion. That was exactly what the street was expecting, up 12% year over year. And new restaurants coming in at 61. The estimate was for 48, 49. So that metric in particular, a little bit higher than expected. And then finally, restaurant level operating margin. That was 19.5% versus estimates of 19.7%. So a bunch of misses around the board here. A couple of numbers like revenue in line. Just taking a look at the stock, we can see it's down about 2.3% there on your screen. And just looking at a longer term chart, I mean, you want to check out what they've done over the last month. This year, they're up 10%. Over the trailing year, they are still up over 75%. But we've seen a lot of these companies really take it on the chin, even when they beat earnings this earnings season. So we'll have to see what this kind of high-profile miss means for the company in tomorrow's trading when we open.
Jeff, thanks, Jared. Jeff, how would you look at a miss like this? Because like Jared was saying, if we do see a company, even if they meet expectations and don't far exceed them, we see investors tend to sell some of these names. So I'm curious just to get your reaction to the action that we are seeing in Chipotle here after hours.
Yeah, you can't take these things too far in the immediate, after hours, or the pre-open, tomorrow, because, it's just not a very liquid environment. So, who knows really what's going on there. But yes, in terms of companies getting sold after, hitting their targets, again, you can make an argument there that it's basically investors saying, yes, that's fine, but what have you done for me lately? And basically looking to, they bought the rumor and now they're going to sell the news. It's just not good enough because the price already reflects all of that good news that's already built in. So that would be, a warning sign regarding, again, what I was saying earlier, valuations getting stretched. And it just takes time for this sort of thing to play itself out and see whether or not it really is a true concern, or we could be talking about this next summer or this coming summer, and you might still have the same concerns. We've been talking about this stuff for years now, and we've yet to see any sort of real meaningful correction, and certainly no bear market. So.
Sam, I know you can't talk individual stock, but I'm looking at the prices of these stocks for which we're reporting earnings, anywhere from $1,500 to $3,300 a share. And you had mentioned your niece earlier. How does someone who I'm assuming is young and might be early into investing deal with pretty common stocks that are that expensive? What is the message that's going to be sent to the next generation of investors?
Well, interesting, but I remember when I was their age, her age, stocks typically split once they hit $80 to $100 a share because people didn't want to pay that much for a stock. They didn't want to invest that much capital in and only get one share out of it. So typically, you would have reverse splits below $20 and splits above $80, et cetera. So yeah, they end up really only buying one share or possibly buying fractional shares because that's the new thing that is available to them. But I think just being able to claim that they are owners of the companies that they deal with on a daily basis, that they subscribe to, that they use in their everyday activities is really what they're looking for.
Jeff, as we wrap up here, just your final thought on what you're going to be focusing on as we turn our attention to tomorrow's opening bell.
It's going to be more of the same as far as looking to see whether this advance can continue. And of course, I think everybody's looking at the progress of the latest stimulus proposal as it makes its way through Congress, and where that compromise is. I think that's the biggest thing, the closest thing on the stock market's plate right now.
All right. First, want to say thank you to both of our guests for being here today, Sam Stovall, as well as Jeff Yasteen. Good to see both of you. And want to let everybody know that tomorrow at 9:20 a.m. on Yahoo Finance Live, Chipotle CFO Jack Harton is going to be on to talk about the earnings that we were just going through. And maybe one of the questions we can ask is, why not have a stock split at $1,525 in the post-market a share? That's tomorrow, 9:20 a.m., CFO from Chipotle. But coming up, we take a deep dive into Amazon's big report with Moody's analyst Charlie O'Shea, what he's listening for on the earnings call right after this.
We want to stick with Amazon because we got the big headline out that CEO Jeff Bezos, he is going to be transitioning to the role of executive chair. Andy Jassy, he's the head of AWS. He will be taking over as CEO. Amazon also reporting a pretty strong quarter. When you take a look at some of these numbers, we want to bring back in Jared Blickery for a closer look at some of the numbers that we're crossing. Jared? Jared, I think you might be muted.
My goodness, sorry about that. Well, I just want to focus on the CEO transition because Jeff Bezos taking a backseat to, it's a really big story here. So here's what Bloomberg Intelligence is saying about it. And this comes from Matt Day. He's our technology reporter. So this guy, he's a longtime Amazonian and former technical advisor, a sort of chief of staff role to Jeff Bezos. Colleagues say that he's Jeff Bezos-like in his preference for data-driven decision-making and customer focus. And also about Andy Jassy, the unit he led, Amazon Web Services, which we know is AWS, this reshaped how companies buy technology. It is far and away the leader in rented software services and computing power. And one final note by Matt Day here is after the retirement earlier this year of Amazon's consumer unit CEO, Jeff Wilke, Jassy was the natural heir apparent. This makes that official. So it looks like this was somewhat expected here. And here's another note by analyst Poonam Goyal, also from Bloomberg Intelligence. Andy is very well respected. The question is, why now? What's next for Amazon? The cloud business is obviously where the profit is. Is that why Andy was the person chosen to run this company? And I think the answer to that is yes. Now, the stock is now down about 0.5%, a third of a percent in after-hours trading, as you see there on your screen. Had been up 2% initially, but not a lot of market reaction given the stakes of this CEO transition, guys.
Sawsey, I want to bring in Brian Sawsey, forgive me. But Brian, what we know about Andy Jassy, is this a surprise for a lot of people, do you think?
No, this isn't some rookie executive guys pulled out of thin air or was formerly leading the dying J.C. Penney brand. This is a guy that's been at Amazon since 1997, is fully ingrained in the Amazon culture, and has led the growth juggernaut that is Amazon Web Services, a business that has absolutely taken the fight to what Microsoft has been doing, what Salesforce is doing. This is a company that knows this is a guy that knows the culture of the company and that will likely keep it going. So I think while you're seeing that, not seeing the stock plunge here, which is what you perhaps would have thought when you see a Jeff Bezos, perhaps one of the best businessmen of our generation, of our time, is because this is a well-seasoned executive. Also, too, obviously lost in all of this is the quarter that Amazon put up here, guys. You look at Amazon's holiday season, sales up 44% year over year at $125.6 billion. Now, I have an article on Yahoo Finance before this earnings result suggesting that UPS's results out this morning were a tell on how strong this quarter was, and it was. Amazon represents 11% of UPS's annual sales here. So I'm not surprised by this quarter. You had operating income almost a little less than double year over year. It was a blowout quarter for a company because we're all home buying goods. I suspect Andy Jassy will hop in the earnings call shortly and just continue to play up the fact that this is a company firing all cylinders, and he will lead it forward.
Yeah, we'll be very excited to hear what Andy Jassy has to say in a couple of minutes. But Brian, you mentioned the fact that you're not surprised that it's a very strong quarter. I think a lot of people were expecting this. But of course, the question is, what about going forward? I mean, how sustainable are some of these gains that we've seen Amazon take over the last 2 or 3 quarters?
Well, I would expect, at least in terms of the retail business, those gains are very much are sustainable, Shauna. Look what's going to happen as we emerge out of this pandemic. You're going to see thousands of retail stores have gone completely bust. There's no more stores open. They're barren wastelands. And where are all those sales going? They're going to the likes of Amazon. This company has poured in billions of dollars to improve its logistics network. And over the past 6 months, they have greatly improved how they're able to do same-day delivery services. That is a huge competitive advantage. And all you have right now in retail essentially is Amazon, Walmart, and Target. And Amazon is leading even those best-in-breed retailers. But what I do think is interesting, too, you could realistically see an acceleration in Amazon Web Services. Now, I still have to dig through the numbers there on how the web services business performed in the quarter. But you're seeing just so many companies right now, if they're not going to invest in building new headquarters, they're taking that CapEx, at least for this year, and investing it in cloud services and finally bringing the technology up to snuff.
Catch us up on what happened to Jeff Blackburn. He took that sabbatical in the summer of 2019. He was instrumental in the IPO more than 20 years ago. So, what is the deal with him?
Well, the deal with him, Adam, is just that he will not be the CEO of Amazon. And I don't mean to be flippant here. I mean, I just keep coming back to this, that this is not, Andy Jassy is not a rookie executive here for Amazon. He helped build the modern day Amazon. Just because he was siloed in the web services business doesn't mean he doesn't understand how the whole Amazon ecosystem works, from culture to the flywheel in the retail business. I would suspect that Amazon will not miss a beat. And also, let's keep in mind, Jeff Bezos is not completely disappearing. If I've learned anything from covering CEOs and executives, when they make this transition to executive chairman, are they as active as they were in the CEO role? Perhaps not, but executive chairman is still a guy who's very much active in a company. And also, let's remember this, a big amount of Jeff Bezos' wealth is still tied up on Amazon. So it's in his best interest to stay very, very active in the company's direction over the next 5, 10 to 15 years, as he also pursues a lot of his philanthropic interests, not unlike Microsoft CEO. I'm trying to put out a tweet right now, but I'm home with you guys. Microsoft CEO, Bill Gates, stepped down as CEO in 2000, and look how he's changed the world since.
All right, Brian Sawsey, thanks so much for jumping on here and bringing some of this down for us. We want to bring in Charlie O'Shea. He's at Moody's Vice President and Senior Credit Officer. Charlie, the big news of the afternoon, Jeff Bezos is becoming executive chair. Andy Jassy is now he's the head of AWS. He's now going to take over as CEO. What are your thoughts?
Seamless transition. Absolutely seamless transition. This has been, one of the things that we've learned about Amazon is that there's an incredibly deep bench there. They've turned over CFOs without missing a beat. And as Brian just said, it's not like Jeff Bezos is going to go sailing off into the sunset here. He's going to be still very much involved in the overall strategy of the company. He's the largest shareholder, et cetera, et cetera. I mean, there's a whole lot of things that will keep him wedded to this company. That said, he's bringing Andy over. Andy has done a terrific job with AWS. I mean, the numbers bear that out. AWS continues to be the profit engine of the company and supports the retail business as continuing investment. So I don't see anything here. This is just, a succession plan that's been in the works for a while, in my view.
What do we know about the relationship between the two and the way they work? And is there any concern that Bezos, still with so much at stake, might micromanage?
That's always a risk. I mean, we've all heard the horror stories about the CEO who moves upstairs and then stays, looking over the shoulder of the new CEO. I don't think you'll see that here. I think this has been in the executive levels, at least from my perspective, it's a very collegial environment. And, again, there's challenges and they push themselves and they push each other, but I don't see that as being an issue here. I think what Jeff Bezos is going to do is just let Andy run the show, and Andy will rely on Jeff for his counsel, which anybody would want to do. And it'll continue to run the way it's been running, which is pretty well.
Charlie, what do you want to hear from Andy, assuming he's joining this earnings call? What do you want to hear in the next hour?
I want to hear him basically say that there will be no change in strategy and it's going to be much of the same. And I think that's what we will hear. There's no reason to do anything here. I mean, the only thing, and we've said this a lot over the years at Moody's, is that, maybe they're light on brick and mortar. And when you look at 20+ billion in shipping costs for Q4, there's your brick and mortar substitute. But I don't think you're going to see anything. I think what you should hear on this earnings call is basically Andy's voice saying the words that everybody else has been saying over the last several years, because there's really nothing to change here.
Charlie, as I'm looking off, the shares are essentially flat in the post market. But when do we get a stock split? Is there a benefit to Amazon to do a stock split? I mean, we saw Apple do one last year. Why not Amazon? That's an expensive stock.
Boy, you're asking me to tread in uncharted waters for a fixed income analyst. I see a $3,000 stock price, and I see that a round lot is really expensive, and that's about as far as I'll go. I think that the company has managed its financial policy with a lot of conservatism. And I think you'll continue to see that going forward. What that does to a potential stock split is anybody's guess. And I'm not going to hazard to do that right now.
All right. Charlie O'Shea, Moody's Vice President and Senior Credit Officer. Thanks so much for taking the time.
Thanks for having me. It's great to be here.
We'll be right back.
with more than 9,400 customers, there's a very good chance that you know Okta, and if you don't, you will. And as we've learned from being folk who work from home, Okta can make it a lot easier to do. Let's bring into the stream Todd McKinnon. He is Okta's CEO, and we appreciate your being here. And you're also out with this year's look at how organizations and people are actually working, your annual Business at Work report. And because we're working at home, you saw a lot of new entries into your top 10 apps. Tell us about this.
Yeah, we're excited about our 7th annual Businesses at Work report. And just to familiarize folks with what it is, so Okta is an identity company that sits at an important intersection between millions and millions and millions of employees at companies and millions of consumers connecting to our customers' websites and mobile apps. So we take all of that aggregate information and release it in this report, which gives our customers and the market and investors pretty valuable insight into what's happening in the cloud and in technology in general. So as you mentioned, this year, the most interesting thing in the report is that 9 of the fastest growing apps and technologies in the report part are new. And I think that's because of the pandemic and because of remote work. And the number 1 fastest growing application, which is timely for the news of the day, is Amazon Business. So Amazon Business is an application that lets employees connect to a company Amazon store so they can buy work from home equipment. And we saw that application saw about over 300% increase in usage in the last year, largely powered by the work from home revolution that's going on.
So Todd, when we take a look at this work from home revolution, from the data that you're looking at, from the companies that you work with, how much of this shift to working from home do you think is going to be permanent?
Well, it's definitely has had a big impact. And I think you're seeing that companies are seeing really positive results from it in terms of getting work done. So I think a lot of the impact of this work from home is going to be permanent. And I predict that next year you'll see a lot of these new solutions that are new to the report this year, things like Figma or Miro, which is an online whiteboarding, Monday.com, which is a collaboration application. You'll see these things graduate from our fastest growing list to some of the top applications in our network. Because I think a lot of the habits and a lot of the productivity benefits people are seeing from this work from home during the pandemic will be long lived, and you'll see those applications and those trends continue throughout the coming reports in the future years.
Do you get a sense of apps that we may not be familiar with, but that might pose competition to, say, a Slack or to even Microsoft 365? I realize that's a high hurdle to cross, but are you watching anybody we should know about?
I'd call out a couple things. First of all, it's interesting if you look at the data, there's a theory that if a company chooses Office 365, that it chooses the whole Microsoft suite, which we couldn't see anything further from the truth in the data. In fact, 10% of customers that use Office 365 also use 6 or more of the competing products in that suite, including 40% plus use Zoom, 30% plus use Slack, over 20% use Box. So there's a lot of heterogeneity inside the use of Office 365 as a suite. And then also, if you just look at companies that use Office 365 plus Google Workspace, which is the direct competitor to Office 365, almost over 30% of companies that use Office 365 also use Google. So you're seeing companies really pick and choose the best of breed technology in all these different sectors and doing what you would expect these companies to do, pick the right solution that solves the business problem for them in the most effective way.
Todd, another focus of these businesses over the last several months, well, it's been a focus for quite some time, but I should say renewed focus has been security, especially with all these employees working from home. I'm curious just what you found on that front and what developments have been made in order to ensure that we don't see more cyber attacks.
Security is on everyone's mind, and it's a huge issue. And I think that for a long time, there was maybe a reticence to move to the cloud because people thought it wasn't as secure, you couldn't control it as much. And I think what people are seeing, especially after something like the SolarWinds attack and the SolarWinds issue, which really was an on-premise attack, a attack of legacy technology in people's own data centers, you're seeing a renewed birth in the cloud. But of course, with acceleration in the cloud, the attackers go to where people are going. So we see threats there as well. And one of the interesting things from the report is that if you look at our threat data, companies that are being attacked, there's certain industries that get attacked more than others. In fact, we saw that higher education had the highest ratio of threats against them versus the number of logins for all their users. So in fact, about twice the rate of banking or finance. So yeah, the security threats are real. You're seeing a shift to the cloud, like a lot of other things, and customers need to be vigilant. And which is why the reason they're using a lot of security technologies. We saw in the fastest growing and the highest used applications a lot of security technology, everything from securities that help people be trained about security issues. There's a platform called Know Before that's up about 40% in this report. That's a security awareness training. Things like VMware Carbon Black, which is an endpoint protection tools. There's a Fortinet has a next generation gateway or firewall product. So all of these security technologies are moving to the cloud as well, so customers can meet that demand and meet that threat.
Todd, I'm going to steal a line from you about what Okta does. It allows any company to use any technology at any time it wants to. We appreciate your being here, Todd McKinnon, Okta CEO and founder. All the best to you.
Thank you.
When we come back, he's the man that will command SpaceX's first civilian flight. Shift for Payment CEO Jared Isaacman joins us next.
Welcome back to Yahoo Finance Live. SpaceX announcing its first ever all-civilian space flight crew. And we've got the guy who is commanding this trip. We want to bring in Jared Isaacman. He's the co-founder and CEO of Shift for Payments. And Jared, it's great to have you on the program. This clearly is a very, very exciting flight that's expected to happen. It's expected to be a multi-day trip from what I gather. But what can you tell us about it?
Yeah, well, first, thank you very much for having me. I love talking about Inspiration 4 and everything that we hope to accomplish with this mission. So it's going to be the first all-civilian mission to space. It's the first step towards a world where everyday people can go and explore among the stars. And that's pretty significant. And recognizing the significance, we've tried to be like super thoughtful about the crew that's going to go on this mission and represent us, as well as the organizations that we hope to benefit, including kicking off the largest fundraising campaign ever in the 59-year history of St. Jude Children's Research Hospital.
Can I just say, congratulations. This is the coolest story in a long time. And the fact that you're going to be possibly, launching this fall with normal people, I'm cheering. I wish I could go, but I lose my cookies just looking at the TV sideways. But let's talk about the St. Jude element, because all you have to do to be eligible to be one of those people is to make a donation this month to St. Jude, right?
Yes, and that's like one of the most exciting parts about this mission is how we're opening it up to the public. So, as of yesterday, we kicked off the inspiration4.com mission website, and we are inviting people to go on the website and potentially join us on this incredible mission. So you can make a donation to St. Jude Children's Research Hospital, which is, an incredibly worthwhile cause, right? And at the end of the month, we're going to do a random drawing, and somebody who made that donation for that good cause might be getting fitted for a spacesuit. And we're also going to bring a crew member up who's going to represent, who's going to be an entrepreneur. And we're inviting anyone, whether you are currently a business owner or thinking about creating a business, to go on the Inspiration4 website. Create, we're going to go to the Shift4 shop platform, create a website, and then make a video and tell the world about your business and how it's going to make a positive impact and why it should be elevated to the stars. And then at the end of the month, there'll be an independent, judging competition to select our 4th crew member that will go up on the Inspiration4 mission. So you're talking about everyday people who in 30 days could be getting fitted for a spacesuit. It's super cool.
Jared, what's the training like for this? If one of these people are picked out, what can they expect over the coming weeks?
So it's a pretty extensive, training program. We're taking everything in phases, right? The next 30 days is all about raising over $200 million for St. Jude Children's Research Hospital. I'm trying to get us off to a good start with the first $100 million. Elon Musk yesterday said he's making his contribution. So we got to get through the fundraising and the crew selection process in February, but then we're rolling right into training, which is a pretty extensive curriculum. No one's reinventing the wheel here. SpaceX, Falcon 9 rocket and Dragon crew capsule are the first human-rated rockets to put people into orbit since the space shuttle was retired almost 10 years ago. That means NASA had to approve the rocket, had to approve the spacecraft, and had to approve the training program associated with it. And that's essentially the profile we're going to be following through the rest of the year leading up to launch.
Jared, I date back to the Apollo mission. So I just got to ask you, I believe you're a pilot. Do you get to fly the capsule? And real quick, aren't you a teensy bit scared?
Yeah, so I'm the mission commander, so I will be getting trained on all aspects of the Dragon spacecraft. As a pilot, I'm very much looking forward to it. My background, I've 6,000 hours flying jet aircraft, ex-military aircraft, experimental aircraft. I think with that kind of background, any pilot would look towards operating the Dragon in orbit as like the pinnacle of an aviation career. So I am super excited about it. No, honestly, I'm not nervous. You're talking about SpaceX here. They land rockets on ships in the ocean. They know exactly what they're doing. They've been fully blessed by NASA. Last year I was in Antarctica on Mount Vincent. If I got appendicitis, that would be a far bigger problem there than it will be operating the Dragon in orbit.
Jared, you're much braver than I think I will ever be. Jared Isaacman, great to have you. We wish you all the best. We're very, very excited to follow this story. We hope you come back on Yahoo Finance and tell us all about it. Thanks so much for joining us.
Will do. Thank you so much.
Coming up next, as stimulus negotiations drag on, we're going to talk to a former TARP director, Lori Bettinger. She says that the White House needs to go big or go home. We have that interview for you.
Got to turn our attention to getting the economy on track and helping millions of people who need their jobs restored. Let's bring into the discussion Lori Bettinger. She is a former TARP director joining us now. And we appreciate your insight because some of us who actually covered the last time Congress and an administration had dealt with saving the economy, it was too little, actually. And it was the roughly, what was it, 700 billion bailout. And it was, now President Biden, who then is vice president, had negotiated that with Republicans and Democrats in Congress. What advice do you have going forward about not going too small this time?
Thanks so much for having me on to discuss one of my favorite topics. I think it really feels like this administration has learned from some of the mistakes that we saw in 08, 09 with going too small and, worry about overheating the economy and trying to be very narrow and focused. And, the Biden administration, the planned stimulus seems to avoid a lot of those pitfalls. In particular, what I find really a very positive sign is this emphasis on benefiting individuals, not just corporations. You see that in extended unemployment, you see that in the direct payments. And I think having those, and then perhaps even more importantly, communicating about those benefits to the public, why we have them, why they're so important, could make this a very different stimulus in terms of both its effect and how it's perceived by the American public.
Lori, some of the critics say that this next round of stimulus, it needs to be more targeted. We heard that from the 10 GOP senators that Biden had a call with yesterday. I'm curious just to get your thoughts on that and whether or not you think that should be a top priority in this next bill.
Well, it's an interesting question because it does feel like the majority of the bill is aimed at trying to address the harms caused directly by COVID. I think then you also see some of the ancillary parts like raising the minimum wage to $15 an hour. And I think you can make sort of a knock-on argument that could help us recover from COVID, but that might not be directly something that's come directly out of COVID and the economic, depression resulting. And so I think it'll be interesting if that stays in the final bill, or if this bill sort of remains, certainly large and record-breaking on many fronts, but we see more of the focus on things like new aspects of stimulus, like helping state and local governments, helping them prepare school districts to reopen, and something like the minimum wage. Maybe it doesn't end up in this bill. I'll be interested to see what the final bill that passes actually looks like.
How important will it be, not only for Secretary Yellen to help communicate what is in place, but to help convince those opposed to large spending that this is a road perhaps to follow?
I think it's going to be so key because one of the, I would say you could say there are many negative things that came out of, the TARP program, but a lot of positives as well. But one of the things that was somewhat frustrating to me as someone who spent so much time on it was there was a lot of misperception in the public about what the program was and who it benefited. And, there was this idea that it only benefited sort of large corporations at the cost of, consumers. And I think with this stimulus, you have to really focus on the individual and how important that is. Because if you don't, when you look at, I think some of the anger that came out after TARP, a lot of that led to some of the Occupy Wall Street movements. And then, we've seen knock-ons from that, even up to the Robinhood trading app. So I think that the need to sort of concentrate on what's in it, how does it affect the American people? I don't think anyone wants to have a long discussion on the budget reconciliation process. That's not going to sort of win over in hearts and minds. But, even now, I think we're starting to see some Republican governors talk about, the need to really support their communities and their states. But that can only be done with a very clear communication about how this bill impacts people at a personal level.
All right. Lori Bettinger, former TARP director, we appreciate your insight here on Yahoo Finance. And when we come back, we're going to take a deep dive into Chipotle's business. We're going to talk more about what is going on there and much more after this.
Welcome back. We want to dig a little bit deeper into the big headline of the past hour. And that, of course, is that Jeff Bezos, he's stepping down as CEO. He's going to become executive chairman of Amazon. Andy Jassy will be replacing Jeff Bezos. We want to bring in Dan Howley for his reaction to all this. And Dan, this is something that Adam and I talked about earlier in the hour. But the one thing that stands out to me is the stock reaction. You would think that shares would be under pressure, yet shares are actually higher on the heels of this news.
Yeah, I think Brian Sanzi actually pointed this out earlier, but Andy is obviously someone who's been at the company for some time. And the big driver for Amazon is AWS, Amazon's web services. And he helped get that off the ground and has been steering it to the growth that it's managed to reach. It's the #1 cloud provider in the world at this point, public cloud provider. So I think people look at that and they realize that AWS has much higher margin than the actual retail site that Amazon operates. It's been the driver. And so they're happy with that decision. I think, Bezos is still going to be around. It's not like he's completely disappearing, but he's taking a step back. And I think the fact that we're having, or the company's going to have a new leader who has proven to operate well and managed to put a business like AWS out there and ensure that it's able to operate so well, I think investors are reacting positively to that.
Dan, in your tech journeys, have you ever met him, or at least, I mean, what kinds of things have you heard him say that, make your eyes open up wide?
I haven't had the pleasure of meeting him yet. Hopefully that will change in his new role. But I think, obviously the big to-do being that Amazon was able to basically take this service and make it a must-have for so many different companies. And as a result, we've seen other firms like Microsoft, like Google, like, older firms as well, IBM, the Cisco, all of these different companies recognizing the power of cloud computing as a result of Amazon really pushing it and recognizing that they need to get out there and have their own versions. And so I think that really is the big driver here now, knowing that Andy is going to be taking this spot. It really will be an important turning point for Amazon, but it could also help the company innovate in different ways. The fact that this was something that didn't exist and he was able to help push this into motion, I mean, who knows what we'll see now.
All right, Dan Howley, thanks so much. Again, Amazon shares up just over 1%. As we turn our focus to tomorrow, Adam, what will you be watching?
ADP, we're going to get the private payroll numbers tomorrow. This is setting us up. Then Thursday, we're going to get the weekly unemployment numbers. But Friday, the Labor Department, the employment situation report, unemployment numbers. So it's going to be important, especially with the negotiations in Congress, to look at those numbers, Shauna.
Certainly will be. I'll be taking a look at eBay and PayPal, both set to report earnings tomorrow. Again, 2 looks at the consumer as we discuss what Americans need right now to get back on track. That does it for us today on Yahoo Finance Live. Thanks so much for joining. We'll see you back here again tomorrow.